Hello, everybody. My name is Ryan Schul. This is my channel. It's devoted mostly to data science, machine learning. I also talk about deep learning, artificial intelligence, optimization routines. I get into some of that stuff as well. I have several videos focused on financial investment, asset management, portfolio management, back testing, forecasting, things like that. So I have a variety of things. I focus a little bit on financial topics in data science, but it can be anything from clustering, classification to regression to multiple regression and linear regression, random forest, XGBoost classifiers and regressors and all kinds of fun things. Okay, so today I have a really cool video for you. Now, I'll admit there's good ones and there's bad ones. I don't think there's any bad videos. I'm not putting out garbage onto my site and expecting you guys to waste your time with that. But I think some are better and some are pretty good, kind of mediocre, a little bit leaning towards decent, maybe a little bit mediocre, but some just have to be better than others. They can't all be phenomenal, right? There's got to be some good ones, slightly less good ones. But this one I think is very excellent. So through to the end, we're basically going to look at a bunch of economic indicators. We're going to fetch a bunch of data from the web and then do an analysis on this and try to use different economic forecasting data sets like unemployment, inflation, um, T-bills and T-bonds and T-notes and things like this to predict future stock prices. Okay, so it's going to get pretty cool pretty quick. Okay, so sit tight and stick with me to the end. We can dynamically retrieve a lot of information from the web. We can get 1, 5, 10, 30-year treasury yields. We can get GDP growth rates. That's exactly what we're going to do. Inflation rates, we got that. Unemployment rates, sentiment indicators, we have that too. We're going to get a lot of things from Yahoo Finance as much as possible. That's a great resource. You can pull that in right here. This one-liner will give you access to all the resources on that Yahoo Finance API. It's very cool, but some things you just can't get there. They don't cover inflation, unemployment, GDP. It's not that kind of um, site, but we can procure those data sets from other sites and merge everything together. So the first thing we're going to do, and I'm not going to run this, by the way, because one of these data sets requires me to import my Fred API. Let me skip to the end. It's probably better to show you this now rather than later. If I can, why is it getting stuck there? Okay, thank you. I love it when the computer does what you tell it to do. When it doesn't do what you tell it to do, it's kind of frustrating. So here's the Fred API. You can go here, get a free API key. So I would encourage you to do that. Once you get that, all this code will run perfectly fine. I am not going to run the code because I can't share mine with you. But when you go here, there's something here, API or something. Did I spell it? Did I spell it right? API. No, API. So you have the categories, related series tags, everything is in here. Okay, so go ahead and get that API key when you get a chance and everything will run fine. Now, aside from that, that's the only thing you need the API key. Everything else is going to come from Yahoo Finance. So I'm going to pull in some data here. This is GSPC. This is the S&P 500 index, right? If I go to finance by Ann, this should come up. There's Tesla. So I looked at that recently. So you're going to have a ton of information here, including some bond data, not a whole lot of bonds, mostly equities, ETFs. Whoops, what was that? What was that? ETFs and yeah, here we go. Had to wait. There was a delay. Pricing. The S&P 500 data going back 120 months, so it's 10 years, okay? And we're also going to get the TNX data. This is the macroeconomic indicator 10-year treasury yield, okay? So if we go over here, we can get this guy right here. We're also going to get that for 120 months, okay? 10-year yield. So this is one macro indicator that we're going to analyze. And we are going to merge everything together based on the date of the data set. So I'll show you how to do that. That's why I think this video is very cool. We're touching on a lot of very interesting, very relevant topics, and we're going to merge everything together based on the index, which is the date in the data frame, because some data frames or some data sets are a little bit older. One stops at December 31st or December 1st, I think, 2023. So it's a little bit older. We're in January 2025. So it's about just over a year old, a year and 1 month, a year and 2 months old, something like that. But that's the most recent we can get. And if that's all you can get, that's manufacturer date. I can't, yeah, I can only get what's out there. So this is the TNX. We have that. We have the S&P 500. We're going to merge these together in a combined way. PD merge will do this for us. We have the left and right index, right? So we're merging the date. So we have 1/1/14 and 2025, and oh no, this is 2015 because that's the head and the tail is at the end. Okay, but just trust me, we're going to merge together on the dates. That's what this is for. This one line of code will do the work for us. And of course, you can Google this. This stuff I think is very interesting. Okay, these videos are instructional to help you to learn and to help you to figure out what to do. So it's educational and informational too. Right, so it's excellent to know how these things work. If you just run the code blindly and you get the result, that's great, but how do you know it's right? You don't necessarily know. If you get a compile error and the code doesn't even run, then red flags are popping up. You can say, okay, there's an error here. I can't run the code. I have to debug it and fix it. If you run the code and there's a logic error, you might not know this is a mistake because the code will run and it'll spit out some kind of result, but it could be wrong, right? And if you don't understand the logic of what's going on here, you're going to have the wrong solution and you might not even know that, right? So it's good to really understand what these things are doing here. So I encourage you to do a little research. We have one data frame, another data frame, we're merging together on the left index, and we're doing an inner merge. So anything that matches is going to be merged together. Anything that doesn't match is going to be truncated off. Okay, if you do a left merge, everything on the first data frame is preserved. Everything that matches the second data frame is kept. Everything else dropped off. If you do it right, it's the opposite. Everything on this data frame is kept. All the matches are preserved. All the others fall off. And if you do an outer, then you get like more of a Cartesian product where you get everything. That's not what we want, right? Most of what we do is inner joins, but there are definitely scenarios where you need left, right, or outer, right? So we have the data pulled in. I'm going to create a plot right here. This is the S&P 500 versus the 10-year Treasury note. So the interest rate is on the left, 0.0525. 10-year Treasury yield. This is the interest rate that the bonds are paying. And on the left, we have the S&P axis. So this is a dual axis chart with the blue being on the left, right, and the red being on the right. You can see the axes are very, very, very different measurements. It goes from 0.5 to 5 and from 2000 up to 6000. So very different measurements, but we can overlay them because relative to each other, this is how the plot would look, okay? So we have a correlation plot here. We can see a lot of these high, low, open are all highly correlated because these are essentially the same thing. If you go back and look at these numbers, here's the high, here's the low, here's the open. So these things are going to be highly correlated, right? These are high-low is the difference or the fluctuation in the price throughout the day. Sorry about that. The light cuts off here. I am in a room that has a motion sensor, so if you don't move around enough, the light cuts out, right? So yeah, so we have the correlation matrix. This line plot I think is very useful. You can see the trend is from the lower left to the upper right. From 2016 to 2024, this is the last 10 years. The S&P 500 has definitely gained from 3,000 to almost 6,000, so 100%. And the 10-year Treasury has gone from about 0.96, you can see that on the plot there, to 0.6, so about 600% gain, right? And the S&P went from about 1.8 to 4, maybe 200% gain there, right? 100. Yeah. Okay. So here's the correlation matrix. Kind of useful, not essential to have that. This is the first machine learning training that we're going to do. We're going to say this is the independent variable. X is independent, Y is dependent. So Y is dependent on the X. This is anything. This has to be dependent on the X, right? So you can have multiple features fed into the independent variable. This is the X. You can have only one on the dependent. That's the target that we're trying to predict, okay? So I run this. Now, again, I don't have the the code for the what was it, the Fred data source. So I'm not going to run it just because I can't share my API key with people here for obvious reasons. But I reran this everything. I refreshed this yesterday, and you can see right here we're getting a mean square error of 88.5814, and an R squared of 0.26. So the goodness of fit is only 0.26. This is the coefficient of determination. Coefficient of determination, and 0.26 is not very good at all, right? We want at least a 0.7 or higher. This model is essentially useless. It's not able to predict anything based on the independent variable being the 10-year treasury and the GSPC being the S&P 500. And that's for good reason. Look, we only have one feature here, and we're trying to predict a feature, and you can see there's not a high correlation, right? There's some slight positive correlation here, 0.26, but as the S&P moves up and down and all over the place, the Fed is doing its own thing. The 10-year treasury note is doing its own thing. They're really completely almost independent of each other. Not quite. The correlation would be 0.0 if it was. So there's a slight positive correlation between these, but very mediocre, right? So now we can go ahead and pull in the 5-year or the 1-year, 5-year, 10-year, and 30-year treasury notes. Okay, and this is coming from, let me see here. Oh yeah, Yahoo Finance. Thank you, Yahoo Finance. It gives us most of what we need, not everything, right? So we have to switch back and forth between a couple different data sets to pull this data or to fetch this data from the web. But Yahoo Finance is very phenomenal. It gives us all the stock option data. You can see here we're getting treasuries, 1, 5, 10, 30-year treasuries. So I tip my hat to Yahoo Finance. They give us some good things. I'm always really blown away by the quality of the data and the breadth and the depth of the data that they offer. Sometimes going back, I think over 30 years, maybe 35 years of history for some of these stocks if they're around, right? If they IPO'd a few years ago, you're certainly not going to get that kind of time series. But if the stock was traded 30, 35 years ago, I'll bet Yahoo Finance has it. So here's the 1, 5, 10, and 30-year notes. Okay, so that looks good. Let us look for GDP. Okay, so GDP does not come from Yahoo Finance. They can't do everything, right? They have their limitations too, but we can get that from the World Bank. You can fetch that from here, go ahead and run it. This does not require an API. So I'm going to give this code to you. You can click this and run it. You will get all the data that you need from 2013 to 2023. I get 10-year time span, and I'm cutting off about a little over a year ago because when I go down here, this is the GDP data, GDP, okay, the inflation data. So we get this from Fred, the Fred API. You need your API key. I showed you where to get that, okay? So that cuts off at, looks like 2024, 11/1. So again, yeah, I wish the data was a little bit more current up to the end of 2024. We missed like kind of a year because now it's the beginning of 2025. But you know what, guys, it is what it is. This is all free. This is the best data we can get. We still can do a good analysis. We just won't have the most current data, but we have deep history. And for our purposes, it doesn't really matter. As long as we have enough history, 10 years worth of data is enough. We don't need yesterday's data or the day before. We have enough to make, to train our model and to test our model and to validate the model. You'll see that in a couple of minutes. So we fetched the Fred data up to the end of 2024. Okay, so we have that. So at this point, we are going to resample the daily data. This came from the S&P 500 and the 10-year, or wait, the treasuries, right? So here's all the treasuries, 1, 5, 10, and 20-year, right? So that's his daily. The S&P 500 is daily. We have to resample that data and basically roll that up to a month data and make that at the beginning of the month to match these dates, okay? So if this was month end, I would match that. It's month end, but it's month beginning. So I'm going to match that to the beginning date. This is month beginning. So all these dates have to match up, and we need this to sync up all of these different indices. So like if you imagine Microsoft Excel, if you start your data on row 1 and go to 2, 3, 4, 5, if the headers are all in row 1, it has to start in row 1. Everything has to sync up at a certain index, okay? So row 1 would be the index. If you're using headers in Excel, this is just an example. In this case, the index is going to be the dates in this data frame, and we just have what we have, right? We don't have any more recent data than this on December 1st, 2023. So everything has to end at that date, and then go back in time 10 years. Okay, so again, it's not ideal, but it is what it is, and it doesn't affect the analysis. So I don't really care about that, right? We'll go back in time a little bit, and we'll still have a decent model trained, tested, and ready to make predictions. So yes, so we're going to do the roll up here in the S&P 500, resampling by monthly, and we're going to take the first of the month, okay, and the monthly sequence, I believe that's what that means. So let's look at the example here. So here's a GSPC rolled up from daily to monthly, beginning of month, the beginning of the month. Okay, so we have that data. Now all the data is pulled into our Jupyter notebook, right? So we can start to align across the data frames. We have the S&P 500 resampled again for the beginning of the month, and we have the treasuries again resampled for the beginning of the month. We have the unemployment and the inflation, and those come in as the beginning of the month, right? So everything is going to sync up. That way we have the treasuries resampled. So 1, 5, 10, and 30 year. Okay, and we are going to have a start date with 2013 and the end date 2023. So we'll have a 10-year time span. Okay, and we're going to do the same for the treasury and the GDP and the unemployment. Okay, so everything is we concatenated together. Here's the S&P treasuries 1, 5, 10, and 30, and the GDP is resampled all on the beginning of the month. So this is what we get. So we did a lot of work, but I think this looks nice. So let me actually validate this. I'm going to put this in Excel. I looked at this yesterday just to prove that this works. Okay, and put this in Excel. Now here's the trick. When you delete it, you can't just paste it into Excel. Okay, it's going to go in horizontal. So that has something to do with the formatting. I don't know exactly why or what or how or where that works, but if you put it in Notepad, cut and paste, then put it in Excel, everything's going to work. Okay, so just go to Notepad, remove the formatting. Has something to do with formatting. I know that because Notepad doesn't allow any formatting. So when you copy and paste it and then pull from the Notepad, all the formatting is deleted. So again, I don't know what causes that exactly, but there's some funky thing in there that does that. So if you go back in time, let's look at the GSPC. I'll prove to you how this works. So this is GSPC, and we have a couple of days. So 12/1, 11/1, 10/1. So if we go to 12/1, 23, 12/1, 159462. Okay, got it. So we got that one. Then we go back. I'm going to put a little green thing on here. Oops, I hit the wrong thing. Okay, I don't have to prove this, but I don't have to do this step. I'm just proving to you how it works. When you run it, you can just run it because everything is set up. I already did this work for you. 4233785. 423785 right there. You see it? Okay. 428839. 428839. Okay, if a couple of are same, they're not all the same. So I have confidence that that's working. Let's go back to the 1 year, 10, 11, 12, 1. So 1 year, 10, 11, 12, 1. Let me find out. I think it's over here. 10, 11, 12, 1. Yeah, 5.24. 10. Oh, wait, sorry. 12, 1. So it's 5.215. Okay. Okay, got it. That's good. 11/1. 5300. Oh, got it. Okay. We'll look at one more. 5315. Okay, it's cut off. Okay, if two are fine, then they're fine. 4705, that's the neighbor. 4789, that's next door. 4975. So I can see those on the screen. Those are all fine. Okay, that's what we're looking at here. So if I highlight it, boom, we got that. 4975, that's the 30, right? So those match up. Good. 4156, this is 12/1. If we go back to 12/1. 5215, 4156, I see that there. Okay, I'm going to make that green. And next door, we have the 10-year and then the 30-year, 4226, 4418. So we are good to go. Everything matches up. Let's validate just one more. I know it's right because I checked this already, but I'll just prove it to you. GDP growth, I think this is down, I think. Let me see. GDP growth for 12/1. GDP growth right there. 12/123, 2.88756. So we got it right there. Boom. So we are good to go. And they don't give us the dates, all they give us the years. So we're going to assume it's 12/1. We force that to be 12/1, right? For 2.88756 matches this. and we are good to go, guys. And we're going to use the same one for all these dates because it doesn't change for the year. You can see this is the same, 288,756, the same. So I think we're in good shape. Excellent, excellent. We did it. Mission accomplished. So let's go down a little bit more. So we have our merge data frame. We proved that it worked. Everything syncs up. We're in a good spot right now. We need we need the final merge of merge data plus unemployment, and then get the inflation. I think plus. This is not equals. That can't be equals. That doesn't make any sense. Okay, so we're merging these three together. There's the S&P 500, unemployment and inflation. Okay, so this is what we had before, just about a minute ago. Now we have the unemployment rate and the inflation rate, and let's look at these dates again. 11 1 2024. Oh wait, do we even have that? Oh, we don't. We have 2023. Okay, but you can tell these numbers are jiving up. You can tell that. Well, 3.8. Oh, we do have it. Okay, so 3.8 for 12/1/2023. Oh, we didn't put it in here. Okay, well, whatever. Just copy and paste it. So it came from over here. Going back in time a little bit before that period, and this inflation rate is, we are looking at 308.74 for 12/1, and I don't see that here, but you know what, that's fine. I know it's fine. I validated that all yesterday. So I think we're good to go. So we can get the merge data. We're going to create a feature from an existing feature. This is a closing price. I want to look at the returns. We're going to look at the percentage change times 100 to convert that into a full number right there. And we are going to look at the lag one, so shift back one, GDP growth, and unemployment rate. We want to go back one just to create a couple new features. So in the data science world, you have features that you work with. If you have, or if you're missing features, or you have a need to generate features that you don't have access to, you can easily create your own features. This is called a feature engineering exercise. We're going to create features from existing features. So we have a closing price. We want to get the returns. We have GDP growth. We want a lag of one, and unemployment, and a lag of one, just to see if anything is changing over time. Okay, that's the point of this thing. So we have our numbers over here. There's S&P 1, 5, 10, 30, GDP, unemployment, inflation, and S&P returns. So that is looking good. Here's the S&P returns, and then we created two new features. Remember, I just showed you that half a minute ago. GDP growth lag 1 and unemployment growth lag 1, and then we plot everything, and we get this really cool looking chart over here. So anything that's orange, anything that you click on, it will disappear, and you click again, it comes back. Oh, here it is down here. So this is the inflation rate. Oh, this is the inflation rate, the red line. This is GDP growth. Okay, click, it disappears. Click, it comes back. This is the S&P 500. Here is the unemployment rate. Spikes up during COVID, right after 2020. Unemployment was off the charts. That was a crazy time. I'll never forget that. That was just an insane time to be in the United States. I don't know what it was like in other countries, but yeah, and Donald Trump was president back then, and he's coming back for a second term. Charting results in the plot, and everything looks plausible, looks very realistic here. I'm pretty happy with the outcomes here. Inflation is consistently going up, and you've seen inflation since the pandemic hit. It was probably two and a half times up, maybe almost 3 times inflation for groceries and everything out there. Housing prices, cars, everything is more expensive now. So we created our first line chart to plot everything together. I think that came out good. I'm happy with the outcome there. Here's a scatter plot of unemployment rate and S&P returns, just to say, is there a correlation between the S&P 500 either increasing or decreasing relative to unemployment? And I think there is. There is actually a correlation here. Here, inflation is 2.5, unemployment is 7.8, and S&P is returns is 7.04. Now, if we go over here, unemployment is higher. We have 7.8. S&P is 7.0. Here, unemployment is 13.2. S&P is actually higher. I remember at that point, a lot of people were at home day trading. So I think initially, a lot of people were making money in the market just because everybody was putting all the money in the market. They're supposed to be working during the day, but They're working from home. There's no supervision. People actually day trading like maniacs. So the stock market jumped up all through 2020. I made a ton of money. Everybody that I know made a ton of money. But then as employment spikes up, the returns dip down a little bit, right? So as unemployment goes from 13 to 14, the return on the S&P, it's actually increased. S&P returns, oh no, negative. So negative 20%, right? So negative 20% when employment is 14.8. When employment spiked up, I think there was a lag. So people were getting into the market when employment was increasing, but then employment got to an all-time high in recent times. And then the S&P suffered, right? Because people were, I mean, there's only so much money you can trade, right? Like you put all your money into the market, and if you don't have any more money coming in, then the returns are dipping down. That's exactly what we see here. Okay, so negative 20% return on the S&P 500 long term with heightened inflation. So let's look at this OLS ordinary least squared regression plot. We have the independent variables, GDP growth, inflation, unemployment, 1 year, 5 year bonds. You can put in a couple more, 10 and 30. I don't know if it makes that much difference. And then we're trying to plot S&P 500 returns. So let's see what the outcome is here. We can see here's the OLS statistical plot, or not plot, but the statistical printout result. The R squared is only 0.38, so it's pretty low. Only 3.8% of the variance of the S&P is explained by the model, so very low. P-value is 0.548, so pretty high. Again, not trustworthy. We want 0.05 or lower. We want R squared to be 0.7 or higher, so we're not even close to that. 1% increase in GDP is associated with a 0.93% of the S&P returns. But again, it's not statistically significant. The p-value is too low and the R-squared is too low. So there is a correlation, but very low correlation. 1% increase in inflation is associated with a 1% decrease in S&P returns. I think that makes sense. If inflation is increasing, stock prices are decreasing, right? Might help bond prices, but it's not going to help stock prices for a variety of reasons. Things are getting more expensive. It's going to impact the corporate bottom line, and their sales are going to fall, and their profit margins are going to dip too. Okay. So 1% increase in unemployment is associated with a 0.63% increase in S&P returns. But again, it's not significant, right? So we ran the model. All these numbers are pretty low. I want the T to be at least 1.96. This is kind of close, but not making a cut, 1.96. And all the P's are too high. We want this to be 0.05 or lower. This is kind of close, but again, not statistically significant. Oh, almost, but almost 0.52. And you can see that this P is pretty low. So lower is better, low is better. This is 1.96, 1.96 for the 5 year, but just barely significant, right? So we'll leave that alone. Let's look at another machine learning model here. So this is random forest regressor. Here's the independent variables. Here is the dependent. I'm saying 1, 5, 10, 30 GP, unemployment, and inflation could have an impact on closing price, or we could use this to predict closing stock prices in the S&P 500. So let's run the model. We get a feature importance printout right here, and I'm going to plot that. Okay, I've got other videos on feature importance and random forest regressors and random forest classifiers. So I'll share all this code with you. I'm not going to get into all of the details of all of the model here and the training and testing and the refining of everything, because I have other videos that talk specifically to that. So check those videos out if you want to know the details, but I will give you the code. So if you want to run it, you can go ahead and run it and learn from this exercise. So you can see here the inflation rate by far has the largest impact on the S&P price, right? So as inflation increases more and more and more, the S&P 500 price will probably depreciate. Unemployment, 530 1-year GDP growth have no impact on the stock price rates whatsoever. But the inflation rate has a pretty huge impact. It's 94%. So close to 100%. Inflation goes up, stock prices go down. Inflation goes down, stock prices go up. Okay, and you see that in the current inflationary environment right now. You see it. So we can use this to make a prediction. The model is trained and tested right here. I've done this in a couple other videos. I show you how to do it. The model is making predictions right here. You have this Y predict. Let me do a Control F to find it. Here's the mean square error. Then we go down here. We can use the prediction to load in new data into a new data frame. So we actually have a dictionary here with key value pair, 1, 5.2, 5, 4.29. So that came from over here, 1 year, 5.2, and the inflation is 306. Let me see if I can find basically where that comes from. So I probably took it from the first line right here. So 1, 5.2, 4.2, 4, 4.1, GP 2.8, 3.7, 3.06. I probably just copied this. Probably that looks like where it came from. And then you can see the S&P 500 is 457672. Okay, that's important. So I put that into the model. Oh, that's the feature importance here. 306, these are numbers I just showed you. Run it 4572. That would be the actual number. The model predicts 454751. So that is close. Let's see how close that is. Equals divided by 4576, 4576.72 and 0.99. Let's subtract 1. Okay, division happens first. That's the order of operations. And you have a percent return of close to 1%, but is off by a couple decimal places. If you put the decimals on there, 0.06. So 0.6% off, pretty accurate. We're making pretty accurate predictions based on these independent variables right here, 1, 5, 10, 30. GDP, unemployment, and inflation rate, that's a tongue twister. And we're predicting stock price to the tune of almost perfect. We're off about 0.5%. That's the deviation right here. So the last thing I'm going to do is pull in articles from Google News to check the sentiment analysis for each of these articles. So this is relative to Apple. I said, give me all the articles relevant to Apple. And I'm looking at polarity and subjectivity. So subjectivity is how non-objective something is, how subjective is it, and how polarity or the polarity of something, is it very positive? That'll be 1.0, very negative, that'll be negative 1.0. In between is neutral, this is nothing. So this article right here, Apple struggle, can AI regain market share in 2025? It's pretty neutral, it's not positive or negative. This has a little bit polarity, so it's kind of like polarizing people, I guess, in the jargon used in this article. Soft guidance to keep sell ratings, but pretty close to neutral. This has a slight subjectivity. Again, these range between -1 and +1. A lot of these are 0. You can see 0, 0, 0. This has a little bit negative right here, but just tiny, 3%. This is 0.5 positive, so a little bit subjective, and not polarizing really at all. Can we add the market share? So yeah, so now we're going to add sentiment to our data frame, right? So we had the closing stock price, that's what we're predicting, 1, 5, 10, 30, GDP, unemployment, inflation, S&P returns, that's a feature that we created, the lag, the unemployment lag, okay, so on and so forth. Sentiment, polarity, here we go. So we're adding the polarity to see if that adds any predictive capability or enhances the predictive capability of the model. So we have the original independent features that we fed in, 1, 5, 10, 30. I've said this so many times. The new one's sentiment, polarity. Now we're trying to predict stock price. We run it 0.99%. So we went from 0.98. What was this thing over here? Oh yeah, 0.98. So R squared of 0.98, which is pretty accurate. I'm loving that. Remember the original one was like 0.2 something, 0.25. Now we're up to 0.98. So very happy with the performance. I'm thrilled with that. This is 0.99. So this is how good the data fits the regression line. And we're almost right there. It's almost perfect, right? So the predictions that this model is making is close to perfect now. So we got 0.9902, 99% accurate, close to 100. You never really get 100, honestly. If you get 100, there's probably something wrong. The model is probably overfit, maybe underfit, or you don't have a whole lot of data. The data set's too small, right? So the model is not really learning and generalizing to unseen data, and it's not really able to make accurate predictions. This model is able to make accurate predictions based on the R squared here. So here's the website where you can get the API. Go ahead, create one. It takes less than 60 seconds. Plug that into here. I think we can look for Fred. Control F, Fred. Where are you, Fred? Yeah, there we go. So put your API key there when you generate it, and you're good to go. You can run everything, and just hit the run button over here, this little play button, that guy, or run over here. Should be a notebook. Run all cells, something like that, and you're good to go. So that's it. Hopefully I was able to drop some useful knowledge on you guys. I think this stuff is pretty cool. All this economics and financial forecasting, economic indicators, influencing stock prices. We proved it beyond a shadow of a doubt. Good stuff, guys. Good stuff. Thanks for hanging with me to the end here. I think you have learned a ton if you made it this far. If not, maybe some people need to tap out and they can swing back later and and pick up the rest of it at some future point in time. So that's it. Thanks for your time. Enjoy the rest of your day. Goodbye. Hey there, everyone. Welcome to my channel. My name is Ryan Schul. I talk all about data science, machine learning, deep learning, artificial intelligence, and things related to this. Okay. So a lot of my teaching lessons tend to be about finance. I got my MBA in finance about 2 decades ago, and it's been on Wall Street pretty much my whole career. So I know the stuff pretty well. Sometimes I deviate from finance though and discuss other topics. I like things like latitude, longitude, coordinate plotting, and optimization, and things like this. So sometimes I'll get out of the finance domain a little bit, but today I'm going to focus specifically on finance, and we're going to look at stock options and understand how we can go ahead and do options pricing, and then how can we find the best options given all the options that are out there. Okay, and it gets a little bit convoluted, it gets a little bit complicated. I'm not gonna um, I'm not gonna lie about that part. It took me probably the better part of a week to put this whole thing together, to do all the research and analysis and coding and debugging and get everything structured and organized and working in a logical fashion. So it did take a while. This is probably one of my more complicated videos, but I think it's very interesting too. And I think you're going to learn a lot if you stick with it to the end. So basically, options prices are influenced by several different things. Of course, the underlying instrument that it's attached to. But let me take a step back just for a moment. What is a stock option? It's an option to buy a contract. It can be a call or it can be a put contract. If you buy a contract and it's a call, you want the stock to go up in value and appreciate in value. And if you want to buy a put, you expect the stock to go down in value. So there's two main reasons why a person would do this, or maybe a company would do it. Basically, to try to generate profit, okay, on the volatility of a stock, either up or down, it doesn't matter, or to protect yourself, right? So it actually acts as an insurance, as well, not direct insurance, but a form of insurance and hedge and a type of protection. If you own an asset and the price depreciates, you're going to lose money, right? But if you buy some puts and the price of the asset will depreciate, but you'll make some money on the put, right? On a put contract, because puts are more valuable when the stock goes down. So you can offset your losses with the put, right? And the call is just the opposite. You can sell a call or buy a call. You can sell a call or, I mean, you can sell a put or buy a put. It gets pretty complicated. So if you know this stuff pretty well, congrats to you. That's fantastic. If you don't know this stuff, you're probably going to have to do a little bit of research. I mean, I know it pretty well. I had to do a ton of research to get up to this point. But anyways, it's pretty fun. And if you get good at this stuff, you can make a lot of money trading options too. You have to be careful. You can lose some money on these things too, right? So let me take you through my findings and show you how all this stuff works. And I'll share my insights with you. Basically, the steps for options analysis includes retrieving data from some source. We're going to use Yahoo Finance. And the way I set this up is you just enter a stock ticker. So it's going to be a symbol. It could be 1, 2, 3, 4 letters. And that's it. You can pick any symbol that you want as long as it's available on Yahoo Finance. You can go fetch the data, pull it back, as long as they have options. Not every single stock out there has an option contract traded on it, but as long as they have the options, you can get everything from Yahoo Finance. We can estimate the probability of profit. I'll show you how to do that. We can understand the volatility of the underlying instrument and how that impacts the options price itself, right? So remember, the option is a contract, either a call or a put, where you can expect the stock price to go up or down, and you want to, if you guess the right direction, you can generate a huge profit for yourself, right? Or you can create a form of insurance for yourself as well, right? So we'll discuss that. So let me show you some of the equations here that go into this thing. This is kind of a beast, so you have to kind of be prepared for this one. All right, this is easily the most difficult video that I've done to date. So the Black-Scholes formula for a call option looks like this, okay? And they break it down for you, so it's not too bad. I mean, you can look at this and figure it out. And there's all kinds of other resources how you can derive how this equation works, and you see the the function right here itself, and then you see all the variables in the definition. So C is the price of the call, S is current stock price, so that's the underlying instrument that the call or the put is written on. In this case, it's a call. We have the K, that's the strike price, the risk-free interest rate, the time to expiration, that's the theta, and then Euler's number, and then we have a few more functions down here, okay? So I'll let you chew on that for a little while and digest that. And it's not easy. It's not easy. Okay. So if you struggle a little bit, that's fine. I struggled with it and I know this stuff kind of well. But I'm not an options expert by any means. But if you do spend some time on it, you can get up to speed pretty quickly. Okay. So that's the sort of the inspiration and the motivation for what we're doing here. Okay. So this is all captured in these functions right here. So when we start off, I replicated the formula that you saw down there. So we have the theta, the K, the sigma, the underlying instruments, the call and the puts, right? Because it's two sides of these contracts. The call contracts, again, you want the stock price to go up or appreciate, and the put you want it to go down. But that's again, that's only true if you're long the call or the put. If you short it, then you want the underlying to go in the opposite direction. Okay, so it gets complicated, guys. It's kind of hilarious how funny or how complex this stuff is. But if you get good at it and you master it, you can actually make a lot of money in the stock market or protect your valuable interest in whatever financial assets you own. So I think it is worthwhile to learn this stuff and to kind of understand the all the inputs here and the outputs too, right? So I really did all the work for you, so you don't have to do a whole lot. Copy and paste the code and run this in your own Jupyter notebook, and I will share this code with you when I'm done with the video. I'll post the video and I'll post the code. Save and export notebook as HTML. So you will have a nice HTML file with all the code in the file. So all you have to do is copy and paste, okay? So I went through this pretty extensively. I don't think there's any bugs whatsoever. I think the code is fully functioning and it functions correct as far as I can tell. If you do notice an issue or a calculation error or something like that, please bring it to my attention, post it in the comments, and I will look into it and make any and all necessary revisions. But again, as far as I know at this point, I tested it pretty thoroughly. I think everything's fine, but it is kind of a convoluted process over here. You can see, right? So there could be a mistake, but again, I doubt it. I don't think so. So those are the functions to do all the calculations. Then we will need our standard Yahoo Finance library. So I call that, I import that right at the top of the code here. SciPy stats to do some basic statistics, Plotly to do the plotting, and we're using some pandas functions down here to go ahead and handle the way that the data is displayed in a couple of different data frames. Okay. So you saw the function above. Again, it should be all debugged and working fine. If you see an issue, let me know. And that comes from over here, right? And oh, let me get rid of that. That's the HTML. I'll download that later. That's fine. So where does the data actually come from? It comes from Yahoo Finance, and this is what the list of all the call contracts look like, right? So you look at this thing and you say, oh my goodness, what is this? What is going on here, right? There's really a lot. So let me go over to Microsoft. This is actually Microsoft. I was looking at Apple earlier, but I switched over to Microsoft for the actual live coding session. MSFT, is that it? I think so. Oh, Microsoft. Okay, and we'll look at the same options over here. Okay, let that run. But the look and the feel of this thing is going to be pretty similar to Apple, right? It's just written on the contracts are written on a different underlying instrument. It's on Microsoft stock instead of Apple stock, right? So this is what the list of all the calls look like. If you look really closely in the middle here, you'll see a C. That's how we know it's a call. That's identified by that C letter right in the middle of there. You have the last trade date, the strike price, the last price. You have the current price of Microsoft's right here. Okay, so 387 and some change. The bid that he asked. The bid is if you want to buy it, that's what you'll pay, and the ask price is a little bit higher. That's what it's selling for, and I believe the market maker keeps the difference between those. So the bid and the ask will never be the same. I think that's how the market maker actually makes his or her money by the spread between those. Okay, so that's my understanding of it. I've never been a market maker, but that's why the bid and ask will never be equal, right? Because somebody has to make some money somehow when they do this transaction for you. That's how they get paid. Okay, so then you have the change, the percent change, the volume of contracts, open interest, and the implied volatility. So 78%, that's pretty volatile. This is a little bit less volatile. This has zero volatility. This is 61%, and so on and so forth. So that's how we're getting our call data. You scroll down here, and at the bottom, you'll see the puts. So it's the same thing again. If you're long these contracts and you have a call, you want the stock to go up and appreciate in value, you'll make money. If you have a put, you want to decrease. But again, if you're short these contracts, if you sell it, you want the opposite. So if you short a call, you want the stock to go down. It's equal to, it's almost the same thing as buying a put. There's a small difference. I forgot what. I don't know. You can Google that. But if you short a call, you want the stock to go down. If you short put, you want the stock to go up. Okay. I don't know what the technical difference is between those, but it's got to be something, right? Otherwise, why would they have opposing shorts and calls? So there must be some reason for that. But I think they're fairly similar for the most part. So here's the functions that do all the lifting for us. All the calculations are described right there with my notes as well. So this is how we pull in the data. Okay, let me refresh this. I'll run this so you can see how everything functions in real time. The functions actually calculate very quickly here. So that is going to, oh, is it even going? Let's see, a little asterisk. I think it's fine. Okay. So refresh that just to make sure everything is up to date and in memory here. So the first thing I'm going to do is pull in the options chain, and I'm going to get all the calls and all the puts and append everything into a master data frame. Okay. So when I run this, it goes on to Yahoo Finance, fetches all the data, retrieves it into my Jupyter notebook, and then puts it in a nicely structured data frame so we can do some analysis on the options chains, the calls and puts, and start to do some pricing, and then figure out which are the best calls and the best puts. Remember, that's the objective here. So when I look at this thing right here, let me flip back to that other view. When I look at this, these are a lot of puts, okay? I don't even know how many are in here. Let me see if I just copy and paste it into Excel. This is pretty quick, okay? So let me copy 80 something, I'm guessing, 80, 90 contracts. Okay, where's my Excel? Right there. Okay, so I'm just curious to see how many there are. Okay, and Excel is starting up, I think. I hope. Maybe it's not. Okay. Maybe it's not. We'll give it a second. This computer's getting kind of old at this point, so I think kind of on the way out pretty soon. But you can see, anyways, you can see what this is right here, 387.82. That is the current stock price right there. And I think Excel is actually running because it's giving me a black screen right now. That's nice. Gotta love it. Gotta love the black screen. And I'm going to skip the Excel thing. The computer's getting kind of old, and some things just fundamentally don't work the way they used to work. Anyways, so when we look at this options contract, that's where all the data is sourced from. It comes from Yahoo Finance, right? And all the calls are going to be listed at the top. All the puts are going to be at the bottom, right? And if you look very close, you can identify all the calls with this little symbol right here. There's a C for a call, and there's a P for a put, okay? And the rest of the information in this identifier over here tells you about the stock. There's Microsoft, there's details about the contract, last trade date, strike, last price, bid ask, change, percent change, and so on and so forth, just like we did before. I guess my Excel just fundamentally isn't working here, and that's fine. I want to count how many contracts we have. I have about 313. About half, give or take about half, will be calls, half will be puts. So maybe 150-ish, 155 calls and puts. And my point, before Excel got me distracted here, is if you or I or your best friend or whatever starts looking at 150 call contracts and then 150 put contracts, are you going to be able to identify which one is the best? and which one has the highest probability to generate a profit for you as an investor. Probably not, right? 150 contracts is a lot. You have to understand the strike price, the bid and ask. You have to understand the implied volatility. Is the stock in the money? That means if you exercise this option contract right now, you will profit because the stock is in the money. So the calls have to be above the strike price to be in the money, and the puts have to be below the strike price to be in the money, right? So we can see they're in the money, but also like what's the probability of the payoff? You can't tell from this view. That's impossible, right? And how much money can you potentially make when you exercise your contract? You can't tell that from this view, right? So that's what the whole point of this analysis is, to understand basically how puts and calls work and how options contracts work, but also to pick the best one. You're looking for a needle in the haystack, right? You have 150 contracts at least right here. I'm going to show you how to find the best one, two, three, five. I think it's five. You do one or two. But just from this view, it's impossible to know that, right? So we have to do some analysis and run these calculations that we saw above, run these functions, right? And use that as leverage to be able to figure out which contracts are the most lucrative and which ones are the most profitable. Okay, so that's the whole point of this exercise. So I went ahead and pulled in the information. You can see this is Microsoft. Here's the ticker MSFT. And what I really like about this tool is you can use this for any stock, right? So for Amazon, for Walmart, for Verizon, for Visa, obviously Microsoft, any stock that has options on the stock. And again, not all of them do, but a lot of them do. All the big companies do have these options. So any company, you can put in the ticker here, and you'll get all the options data and all the pricing. And then the final recommendation is which one should you buy. I'll show you how to do that in just a few minutes. So we have to calculate a few things. Some things are given to us, okay? But some things we have to derive ourselves. So we have the time to expiration. That's the time to expiry, just short for expiration, right? If you look really close here, where is it? Oh, I think that's actually in the next view. I think that one was in the next view. Okay, so they don't even give you that, right? So you have to calculate that yourself. If you look at the original source data, so you don't even know. Okay, I know when this is actually expiring because you have the date over here. So you'd have to pick the correct date. The closest one is March 21st. Right now it's March 18th. No, March 19th. It's March 19th. So in 2 days, this is going to expire. I think this is always on the third Friday. I think that's how they do it. And let's see, if I go down here to my little calendar, 19/20/21, that is 2 days away. And I think that's going to be the third Friday of the month. Okay, so I think that's when these things expire. Okay, the calculator doesn't work, or the calendar doesn't work, and Excel doesn't work. So we'll just skip that. No, it's working. Okay, so 1, 2, 3, yeah, 7/14/21. So that is the third. This is the third Friday. So that's when these things are going to expire. And the point is, it's pretty close, right? So the time to expiration, or just kind of abbreviate it here, or just come up with a cool convention. Let's say expiry. The time to expiry is actually very short because we only have like 3 days, right? Today is the 19th. By the 21st, this contract is going to expire. And right now it's later in the afternoon, so the trading is all done for today. You only have 2 more days. And I don't even know if the contract even trades in the afternoon on Friday or if they finish up early in the morning. But by the time you get to Friday, you basically have no time left, right? So the time to expiration will be very short. The implied volatility is going to be pretty short too, because you only have a few days before expiration for these contracts, right? But if you pick a longer maturity date, you can pick all of your dates over here. Here's March 28th, right? So that would be the next week, right? So that would be the fourth Friday of the month, right? If that is the 21st is this coming Friday, and then April 4th, and then April 11th, and April 17th. Let me look at this quick. I think I might have made a mistake because I thought it was always the third Friday. But then if we go down here to April, let me see April here, 4th, 11, 18, 25, 4, 11, 17, 25. Okay, so they have all kinds of different expiration dates. So that's fine. You know, it is what it is. I don't even care about the expiration date. I'm just trying to demonstrate that the volatility will be less when you get closer to the expiration date because you don't have that much time to do anything. The stock is not going to make a huge move in 1 or 2 days, right? So if you have a longer time to expiration or the maturity of the contract, it's really expiration, but it's kind of like maturity. Um, then you have more implied volatility. If you have less time, then there's less volatility, right? So this is important to calculate the implied vol. We also want the delta, the theta, and the vega, and we want to calculate each of these because none of these are given to us. If you look at the original data, let me go to the most recent date here, or the closest date. So that's March 21st, right? So that's 2 days out, basically two trading days because it's at the end of the day on Wednesday. So you have the contract name, trade date, bid ask, volume, open interest. That's how many contracts are in the market right now, and implied volatility. All they're giving you is implied vol, right? So all these other metrics you have to calculate yourself. That's what this tool does. So flip back here. We are given the implied vol. That's nice. Thank you very much. Really appreciate that. And the time to expiration. Okay, we have that. But we don't have the delta, theta, vega, but we need that to understand which of these options contracts, both puts and calls, are going to be moving the most, which are the most volatile, and which are going to have the largest payoff, right? So that's why I'm calculating these. Over here, we have time to expiration, implied volatility. We have delta, theta, and vega, okay? And we have everything for the puts and the calls. So everything looks fine over here. And in my notes, I just have some explanation because this is very important. Just what the terminology is. The strike price is the price of the option. Okay, so if the call is in the money or if the put is in the money, you're going to make money on this thing, right? If it's out of the money, then you're not making any money, but it could go into the money, but there's no guarantee of that, right? So the closer it is to at the money, it's called at the money, or if it's just in the money or just out of the money, you have a good chance to make some profit. If it's way in the money, deep in the money, you're guaranteed profit. If it's far out of the money, you're almost guaranteed no profit unless the underlying stock moves very rapidly. It becomes very volatile and there's a lot of trading. Otherwise, if you're deep in the money, you're all set. Your profit is basically guaranteed almost. There's such thing as a guarantee in finance. There really isn't. If it's far out of the money, you probably are guaranteed not to make anything. But again, like in the financial markets, like anything is possible. There's really no guarantee of anything. But so anyways, back to this. So the strike price is the price of the option, the price at which the holder of the option can buy. The last price is the last traded price. We saw that for Microsoft. It was like 300 and what, 337 or something? 387? Okay, 387. The implied volatility is the volatility of the option. This reflects the market's expectations of how volatile the stock will be in the future. Okay, higher implied volatility means greater potential for a payoff. Okay, so if you have a stock that barely moves and you're out of the money, you're not going to make anything on that, right? If there's a lot of volatility and it moves up and down quickly, you can easily make money on that. And the nice thing with these options contracts is if it goes deep into the money very quickly, you can exercise the contract and walk away, right? You can make your profit and then get out of the market and basically lock in your profit, right? For some of these options, I think they're called European options, you have to hold it until the end. There is no early contract. There is no early selling of the contract, of the options contract, right? So delta measures the sensitivity of the option price to the price movements of the underlying assets. So again, remember, these options are written on stocks. You don't own the stock, you own the option. And by the way, if the stock pays a dividend, you're not entitled to that dividend. The stock owner gets the dividend. The option owner gets no dividend whatsoever because you don't actually own the asset. You own a contract, and that's it. But you don't own the assets, okay? And the delta measures the price movements relative to the underlying assets. So how sensitive the option is. Theta represents the rate of time decay. Remember, these are always going to mature. We saw some are going to mature on Friday, right? Here's the maturity date or the, what's it called? Expiration date. So here's Friday, that's in a couple days. That's the following Friday, so that's next week. So the theta is always decreasing over time because all of these contracts are going to expire in some amount of time, whatever it's written for. It could be long term, it could be several months, it could be I think up to 9 months. I think they can go up to 9 months. A lot of these are really shorter in duration. That could be uh, 1, 2 months, 3 months, but you could have some long-term options too, right? So, anyways, the theta is the time element and the decay of the options value to you as the option holder, and vega measures the sensitivity of the options price to changes in the volatility of the underlying asset. Okay, so remember I said a short time ago this gets kind of complicated. Well, I wasn't kidding about that. It gets pretty complicated. So, anyways, we did all of the calculations over here to get implied volatility, delta, theta, and vega, right? So that is very important to actually pricing of the option and understanding how valuable or how not valuable these are. So let me go ahead and run this and plot the results just so we can visualize it. I always say a picture is worth 1,000 words, right? When we look at this over here, this delta, this theta, this vega, does that mean anything to you when you look at that? When you look at this over here, does that mean anything to you? Doesn't mean anything to me. So I have to go ahead and chart it. And when I can visually see what the vega, theta, and vega, theta, and what else I did for delta, and then the implied volatility look like, then it makes a lot more sense to me. Okay, if I just look at the numbers, it doesn't make a ton of sense. I mean, I kind of understand basically what's going on, but I think the point is it's always nice to plot these visually so you can see what it looks like on the X and Y axis. And I like these plotly charts. You can zoom in, you can zoom out, you can see all the details. So you have the strike price, the implied volatility, and the delta is what we're plotting here. Okay, so these four plots represent, a little bit slow, represent the implied volatility. Okay, that's what's measured on the y-axis, and the strike is always on the x-axis. In this example, you could do this a number of different ways. I think this one makes sense, but there's a bunch of different things that you can plot. It's really up to you. Okay, so it's pretty dynamic how you create your charts and how you share that with your team or your stakeholders or whatever you're doing. So I'm looking at implied volatility, delta, theta, and vega. That's what these plots represent. Okay, so basically we can see what the strike price is relative to the implied volatility. The delta is the second chart, the theta is the third chart, and then the fourth is the vega. Okay, and again, I define all these over here. If you don't understand all the terminology, that's fine. Just do some research, Google it. It's very interesting to study this and to arm yourself with this information. And when you really understand it, you can make some pretty decent money in the market, or again, this way to look at that as a profit motive or as a type of insurance to protect yourself if you own Microsoft stock and you think that there's going to be a quick sell-off due to some market event or whatever, but it's just temporary, then you might buy some puts to protect yourself if you don't want to sell all of your Microsoft shares, right? And then obviously like calls, if you think there's going to be a big bump in the stock price due to some kind of event at Microsoft, or maybe some event overseas, or Microsoft, I don't know, Microsoft is coming out with a new product for Azure, and you think that there's going to be a short bump in the stock price, then you would buy a call, right? So there's all the plotting, and we got the Greeks. So we have the delta, theta, vega done. So this is good progress. Let's move down here. The next step, I think, is my personal favorite. I think this is probably the coolest part of the whole analysis right here. Now we're going to estimate the payoff, and we're going to use the Black-Scholes model and the assumption that stock prices follow a log normal distribution. This is pretty well known in the stock market. This means the probability of a stock reaching a certain strike price at expiration. Remember, the next one is going to be in 2 days. That is March 21st. And then the next one after that is March 28th. That's the expiration date. This can be approximated using a cumulative normal distribution. Okay, so this is how we actually get the probability of the option ending in the money. So I abbreviated ITM, in the money. You want to be in the money, whether it's a call or put. Call's going to go up, puts are, you want it to go down. So we can estimate the probability of the stock going into the money, because that is not given to us, right? If you look back at the source data, we have implied volatility, open interest, things like that, but has no information whatsoever about Oh, it is telling you in the money. Okay. So by the blue lines over here, everything is highlighted blue is in the money. Okay. And everything that's white is not in the money. So this is the call side. If we go down here to the puts, it's going to be the opposite, right? So all these puts in blue are in the money down here, but you don't have the probability of that option being in the money. So this metric I think is very useful. This is 1.0 in the money, because this is literally in the money. But then sometimes it's going to be, it's not going to be 1.0, right? Like if it's close to the call price or the put price, it could go into the money very quickly, right? If the stock price depreciates, these puts will go into the money, or these will go into the money because it's out right now, but it could easily go in. These could easily slide in. And on the call side, if it goes up, these calls are out of the money, but these could easily go into the money within the next couple of days. Probably not on a contract that's going to expire in 2 days, but for the longer term contracts, that could easily go into the money. So this actually calculates the probability of that event occurring. And then the next thing that I'm doing is calculating the expected profit and loss. So P&L is profit and loss. And we want to know, based on all this analysis that we did on the whole universe of puts and calls, what is the expected overall P&L, right? So we have that calculated as well. So let me go ahead and refresh that and show you what the view looks like. And get some water while this thing runs. Ah, love ice water. Love it. Okay, so the options chain is a little bit big and the computer is running extremely slow here. I just noticed my Excel finally popped up. How long did that take? Finally got that. Okay, now I don't even need it anymore. That's nice. But in the end, we get a nice summary of the strike price, the last trading price for the option, the implied volatility, the delta, theta, vega. These are the Greeks, the probability of this option contract going into the money, and then the expected P and L. So there you go, guys. You're welcome. These are the top 5 options right here in the whole call universe. And if I wanted to get the worst 5, I mean, I don't think you want to see the worst, right? Because these are going to be all losers. But if we look at the tail of the data, we can look at the worst. Kind of a moot exercise. And there you go. So the expected P&L is you're going to lose everything. And the probability of going into money is, it's actually not 0, but it's pretty low. These are pretty low down here, low, 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 low. So you want to focus on these that have the higher payoff. This has a 21 times payout, and it's a little bit complicated. I'll tell you in a minute just how that works. But this is guaranteed loser, 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 loser. These are all the winners, right? And you have the top 5. Honestly, this is just the best one. All you need is one contract. You don't have to mess around with 2, 3, and 4. I guess you can if you want, but really this is the number one. This is the only one you need. And I'm not giving you investment advice, okay? So if you buy options and you lose money, please don't come to me and try to sue me. This is not investment advice whatsoever. I'm just explaining mathematically how this stuff works, okay? So I've traded options before and made a ton, and I've traded options on some occasions and I've lost a ton, right? So it goes both ways. You can make money, you can lose money. You have to be careful with this stuff. And this is not investment advice. Again, I'm just telling you how the math works, how the statistics works, how the finance works. I'm telling you about the terminology. That's it. I'm just giving you facts and information. I'm not giving you any investment advice. Okay. But if you want to know which is the best contract, that's the one right there. Okay. So how do you actually convert this into a profit? Because is that $21? Is it 21 times? It's actually not really either one. You have to do a little bit of mathematics, additional math on this, because this stuff is like kind of from another planet. All these option stuff is very interesting, but it's not really normal finance. So it's just handled differently. The behavior is very different from like corporate finance or structured finance or something like that. So how do you get the probability in the money, first of all? Because there's 2 steps we did at the end, right? We got the Greeks right here, delta, theta, vega. So we calculated that, and a prior step just above with the other script above this. And the last part of this was the probability of the option going into the money. You can see here for these calls, it's basically 0. For these calls over here, it's 100%. And the expected profit and loss, basically the in the money calculation represents the probability of an option being in the money, okay, ITM, at expiration based on the Black-Scholes model, okay? So we need a couple pieces for this. Again, if you go back, this is really like the logic comes from here. This is the basis for this whole thing, okay? You have to look closely. You have a D1 variable here and a D2 variable, okay? So it's all part of this equation. So based on that, the D2 is calculated as part of the Black-Scholes formula, and it represents a number of standard deviations that a strike price exists away from the current strike price, okay? Adjusted for the time to expiration and the volatility of the stock. So this stuff gets a little bit complicated, okay? But stick with me. I think we're getting up to the end of this thing pretty soon, and it's going to be worth it, I can promise. So the cumulative normal distribution, okay, which we're calculating above, this is the norm dot CDF of variable V2 gives the probability of the standard normal random variable will be less than D2 for a call option, okay? So that's how we're getting the probability of a stock option contract going into the money. Here's more of the math, okay? So you could take that and study that. That's going to match what I showed you in the source data initially when I started the video. And then based on that, the expected profit and loss is calculated based on the probability of the option expiring in the money. Okay, so that should be pretty clear at this point in the video. I think we beat that horse to death. Given the intrinsic value at expiration and the option price. So this is how you do the conversion. If you have $10,000, you look at the last price, okay, the option price for the first contract. So in this case, we have a strike of $377.50. Oh, you know what? This moved a little bit because these are dynamic, right? And the prices of the options are changing all day long. So I ran this earlier in the afternoon. Microsoft stock moved up just a little bit. So when I ran it before I went for a jog, this was the number one best contract. It changed just a little bit. So now this one is actually the number one best contract. When I ran it previous, it was 335. So that's a different contract. And then, so that's what I'm looking at down here. So the first contract is the strike price of 335. Okay, so that's what I'm looking at. I'm looking at this contract right here. That earlier today was number one. Now it's number two. This one is number one. It's $46.80, right? So that's how much it costs. That was the last trading price. So you would take that. You would get you can buy the 10,000. No, wait, I lost my train of thought just for a minute. Let me expand this. 2.36 times 80 times 1 times 10,000. Let me see. Each contract each options contract represents 100 shares, and you would have to multiply the 4680 by 100. Oh yeah, that's it. So 4680 times 100 would be 4,680 divided by 10,000. So I think, let me get this calculator going. I think you could buy 2.1 contracts. 1 second. Oh, I'll just use Excel now. That's working. Let me use that. Okay, so 4680 was the price of the contract. Okay, and we have to multiply by 100 because every contract covers 100 shares, right? So let me see, 4680. All right, 46.80. That is the cost of the contract, right? Times 100 divided by 10,000. If we do this, okay, that divided by that times that. 2.13, yes. Okay, so I got the number. That's what I'm looking for. So 10,000 divided by 4680 times 100, because 100, one contract covers 100 shares, you get 2.13 So we went with 3 contracts. And the expected profit and loss for this contract is 7.18. Okay, so we calculated that. Oh, it's actually different now. It's actually different. 13.3. So these things are dynamic and volatile, and it's going to change constantly throughout the day. So when I ran it in the afternoon, I did this calculation. Probably shouldn't have pulled new data, but that's fine. You just have to understand the concept, right? So it's 10,000 divided by 4680 times 100. The expected profit and loss was 7.18. So before I went for a run to get some exercise today, the P&L was actually less than it increased a little bit, but this one actually increased faster because this actually became number one. Earlier in the day, this was the number one contract. So let's say hypothetically, the P&L for this contract is 7.18. So the expected profit would be 7.18 times 2 times 100 because it covers each options contract covers 100 shares. So the profit is $1,436.38. There you go. So it's complex, it's convoluted, it's not simple, but I think the stuff is very interesting. And if you really understand it and really master it, you can make nice return trading options. And I'm giving you all the metrics here, and a nice tool to do all the pricing and the evaluation, and then to find the best call contract is right there, 337.5. If we go back here and look for this, where's my 337.5? Let me try to find that. 337.5. I was probably gonna find a bunch because it's gonna have IDs and all kinds of things. Let me just scroll down here. 337.5. Oh, was that it? Let me see. I see a 335. I don't even see that one right now, but this would be the contract that we're looking at. 337. So that's the best in a whole bunch right there. Okay, based on all the analytics and all the metrics that we did. And then these would be the worst down here. And then I redid everything for the puts. Oh, I have one more chart down here I can show you. This is the payoff chart for all the calls that we're looking at, everything in the whole data frame that we pulled in from Yahoo Finance. Okay, so when we plot it, you'll see the payoff for the calls. It's not gonna give you some huge payoffs. To break even line is right here, right? You have this 21.86, and then the next best one would be over here, 13.33. So I have 21.86. That would be this guy right here, right? And then 13.33 would be this guy right here. So that is the second best. Okay, so that's represented here. And then most of these are basically worthless. And the reason for that is the option has almost fully decayed. It only has like one full day of trading, and then I think a half of a day. I think these things finish off on the expiration date like midway through the day or something. I don't even think it goes until the end of the day. So you have one full trading day. So not too many opportunities here unless Microsoft shoots up when the market opens at 9:30 tomorrow. You don't have too many opportunities to make profit, just like little tiny crumbs over here. And on the put side, I did everything the same for the puts. The math is very similar, slightly different because you want the put contracts, you expect the stock to decrease in value, right? So it's going to depreciate. That's how you make money on a put. If you're long, again, if you're short a put, then it's the opposite, right? So here's the Microsoft current price, 387.82. We see that over here, 387.82. So when we make this call to, I don't want to use like a call and a put, like a call to call. When we go fetch this data from Yahoo Finance, we get the same information right here, right? Because it's coming from the same source, 387.2. You can tell these are puts. This is the P over here, right? So those are puts. You saw the C embedded in the contract symbol or the identifier for the contract. So I can run that and then get the implied or the probability of the stock going into the money, and then the expected profit and loss for for these puts, right? And this is the head and this is the tail. So if I rerun that, we'll see the top and the bottom of the data frame with the probability of the put in the money. And then the expected P&L, we see that. And then down here, we have another chart showing you the same that we saw on the call side too. Okay, so here the puts have a few more opportunities to be in the money. We saw 74.35, and you have to do this conversion over here that I showed you before, right? So if you have, or I'm sorry, that would be the that would be the profit, right? You'd have to take the put sale price, this over here, so 86.75, and this would be the best contract right here. So 540, if we go look at puts, 540 should be down here, and the put territory, 540, right there, okay? So that's going to be the best one right there. And again, these things are very dynamic, changing constantly throughout the day as the underlying stock price changes. So just be aware of that. It's a fast moving sort of beast here, right? But I think, again, very fascinating, very interesting. And if you can really master this stuff, you can make a nice profit by trading options. And some people make a career of this, and they have very good income. Okay, so that is it. That's how to analyze stock options and to pick the best put and the best call on the whole what is it called, the stock on the whole put and call. It's called options chain. So that's how to find the best put and the best call in the entire options chain universe for Microsoft. Okay, so I'm going to go ahead and download this code and share it with you guys. I'm going to wrap up the video, and I'll see you in the next one. Bye.
Howdy everybody. In today's video I have yet another teaching lesson about how to do stock analysis, stock picking, investment management. I already put out several other videos related to this, specifically portfolio optimization, um, fundamental analysis, technical analysis, backtesting strategies. I put out a video about that. So this is another in this series, okay? And again, like all the others, sorry, this is not investment advice. Anything can happen in the investing world. You can certainly make money. You can lose money too. You have to be careful. It's a very dynamic market. It's very volatile. So this is not the gospel truth about investing and how to pick stocks and so on and so forth. But this is a strategy that you can deploy to help you pick the best stocks, right? When you have knowledge and information, you can make strategic, informed, intelligent decisions. So what is fundamental analysis? It's essentially looking at evaluating stocks, comprehensive overview of a company, intrinsic value. This allows investors to make informed long-term investment decisions. And we focus on a few things in the world of fundamentals, right? We look at the company's true value. We look at the balance sheet, the income statement, cash flow statement, price to earnings, price to cash flow, price to book, ROA, ROE, things like this, right? I've got a couple of videos about that. You can check it out if you want more details about that, right? We also try to identify long-term investment opportunities, which companies have sustainable growth over time. We look for consistency and persistence of earnings, right? We want to be informed of risks and reward potentials, right? Understand the risk and the expected returns of a stock. This type of analysis helps us build a diversified portfolio, right? We don't want a concentration of investments. That's going to create a totally different type of risk. That's called concentration risk. We want to avoid that. We want to understand our risk tolerance and focus on diversification, not concentration, right? And this also supports value investing. So we try to understand what companies are undervalued, and if we invest in these undervalued companies, we could potentially achieve above average market returns, right? And over time, this can be quite significant. Now, a different point of view would be shorting the stock. If you think it's overvalued, you could sell it, and if the value goes down, you can buy it cheaper, right? And then pay back that that money that you borrowed initially. That's a totally different type of investing. That's not what we're looking at today. So let's get into it. We have our Python code here, again, in a Jupyter Notebook. I do everything in Jupyter Notebooks. We have the necessary libraries to help us do our work. Okay, and we are looking at this website right here. I like this. Finviz.com has all of the fundamental features for you, right? So if we look at one, we can go to Apple, AAPL, and scroll down just a bit, and we have all our fundamentals down here. So you can see market cap, income, sales, cash, dividends, options, simple moving average over the last 20 days, simple moving average over the last 50 days, SMA for the past 200 days, ROA, ROE, ROI, margins, and shares outstanding, float, 52-week high, 52-week low, the beta of the stock. So they have about 70-ish, I think it's 71 or 72 different metrics. I think it's 72. So pretty comprehensive coverage of fundamentals. Now we can go into each company's filings with the SEC and calculate this ourselves, but if this is given to us, it saves us a lot of work. We don't have to do the effort, we don't have to do the labor to get all of these metrics right here. It's just given to us. So that's pretty nice. So we're going to pull that in from this website. We're going to loop through all the items in this list right here. I have an I as a counter. We don't really need this. I just put that in because it helps us see where we are in the looping process, especially if you are doing this over several hundred stocks. You want to know how far into the list you are, and probably with thousands. If you do this for thousands of stocks, you can certainly do that, but it's going to take a little bit longer, right? So if you know it's going to have to count through, let's say, 10,000 stocks or whatever, you probably want to know where you are in the process. You don't want to just kick it off and let the thing run, but you don't know how long it's going to take. So I just added an incremental counter right there. So we're going to loop through all the items in the ticker list. Here's the list right here. If I could do Control F for ticker, this is the, oh, here it is. So this is the base list right here, base list of tickers. And here's the loop right here, okay? So let me go ahead, close that, and kick off the process, Control Enter, and you can see it's starting to pull in all the fundamental features, all the fundamental metrics for all these stocks listed in this data set right here, okay? So it's almost done. We're coming up to the end here. I'm going to print the list just so we have a quick visual understanding of what this is composed of now. So we have the list of tickers here, AXP 19.87 for the price earnings. Let's go check that. Just do a quick sanity check here. Okay, P 19.87, EPS 13.6, and that's what I'm seeing here. And insider owned is 13%. Insider owned is 13%. And the last one here is the change over time, negative 92, negative 0.92%. Go over here, and for AXP, negative 0.92. Okay, so I think everything is working. Sanity check is done. I'm pretty confident this is doing what it needs to do. Okay, so now let's clean this up. If you look carefully in this data set here, you'll see a couple of things that might cause some problems. We have an M here indicating millions, shares outstanding, so 723 million. That's good to know. Here's 15 billion. But when you start doing your analysis, all these extra characters, these percent signs, we have some percents over here, these are going to be a little bit tricky to deal with. So I'm just going to chop those off, remove that, and we're going to have an understanding that these are all actually numeric columns, so we can do the analysis. So computers don't really like language and special characters and things like that. It's kind of screws up a little bit. But once we remove these characters and we know that a B is billions, we're going to take that number and multiply it by a factor of a billion. This is going to be multiplied by a factor of a million. All these percent signs are going to be removed. So that's just going to clean up the data and make things a lot cleaner for us and easier to work with. And anything that is potentially not numeric, sorry, I'm going to convert this to numeric data type. In Python, we have just a handful of data types. There's floats, there's integers, there's objects, strings, dates, things like this. There's not a whole lot. There's only a few data types, but we're going to convert all of these into numerics so we can do some analysis. So I'm going to go and hit Control Enter. Okay, these lines right here, do the conversion just to make sure it is numeric. It could come in from the website as numeric, but if you look closely at this right here, I can guarantee that's not. That's going to be an object because it has a combination of letters and numbers. This is going to be an object because, again, you have that percent sign. That is not numeric. If you strip out the percent sign, have 1.93, that is numeric. Okay, so that's what this code is doing. And by the way, you don't have to memorize all this stuff. You don't have to take notes here. I'm going to save this file as soon as I'm done with the video. I will save it as an HTML file, and I will post that when I post the video, so you can download the source code and you can go ahead and run it on your own Jupyter notebook. This would actually run in Spider too. There's several different ways to run these scripts. Right? I like Jupyter because if you're dealing with charts or graphs, you can have some very dynamic, interactive graphs to work with that can give you all kinds of useful information. In this video, we're not actually doing graphs, but I like to keep everything in Jupyter. It's pretty easy to use. It scales up and scales out very well. And again, if you have to do any graphing, it's excellent for any type of graphing, right? So now we're getting down to the real analysis part. So I created a tuple here. A tuple is enclosed with curly braces. A list is going to have square brackets, right? So this is a list, and a dictionary is going to consist of key value pairs, right? There's a few different data structures in Python. Lists and tuples and dictionaries are very useful to work with. This is actually a dictionary inside of a list, inside of a tuple, right? So here's the tuple with the square bracket, and here's the dictionary, here's the key, and here's the value. Again, a key and a value. So we're actually using all three data types here. I think list is probably the most common. That's what I use most frequently, but you can certainly use a tuple, and if you need a dictionary, if you have a key value pair set up like we see here, then a dictionary will handle that very nicely for you. So this is what we're looking at. So we have benchmark. I picked PE, EPS, income sales, PEG. This is price to earnings divided by growth. This is price to book, ROA, ROE, debt to equity, EPS, quarter over quarter, sales quarter over quarter, simple moving average for the past 20 days, 50 days, and 200 days. Now this is a little bit arbitrary. You can pick whatever metrics you want. I think this is a very nice way to get started. These are some of the main metrics, some of the most influential, I think, to driving a stock's price. So if you can certainly add to this, to the items in this tuple here, and create more, right? Because you have about, I think it's 72 over here total. If I copy and paste this to Excel, let me see if I can real quick. I think you have 72, and you can do this for any of these features, right? So, whoops, I think I have to put this into a text file first to remove the formatting. Sometimes they come in with some funky formatting. Okay, Control X, go over here. Just want to measure this, so this will go over because the index isn't indicated as an index. So that lines up, 77. So you can see a count of 77 down here. Okay, so we have 77 financial metrics. So this is a list of what, 10, 8, 10, 12, whatever this thing is here. So you can use all 77. It's really up to you. I'm just trying to showcase some things that you can do in Python here. This, again, is not the gospel truth, but I think this is definitely a good place to get started. And I think these are some of the most influential stats that really drive a stock's price, right? So I think this is definitely a good starting point. And again, some of these are a little bit arbitrary, like PE of 10. Is this the best type of PE? It's not necessarily. It kind of depends a little bit on the industry, the sector that you're looking at. Some companies will have higher PEs inherently, in some sectors will have lower PEs, but overall it is a good place to start. EPS equal to 5, again, is that the best number? I can't say it is, and I can't say it isn't. I think this is a good starting point, and again, you can play around with these and you can tweak it to match your needs. A PEG of 1.5, personally I think this is good. I've been in the finance sector for close to 2 decades here, so almost 20 years on Wall Street. I think this is good. I think ROA and ROE of 5 is good. If you have higher, it's better. If you have lower, it's not quite as good. SMA of 1, 2, and 3. I think these are I think these are good numbers here. Oops, I just noticed a typo. 1, 2. But again, it's up to you. You have to test these and see what really matches with your specific needs and see what works best for you. So this is just a starting point. I think this is decent. You could tweak it any way you want, right? That's what these things are very customizable and very flexible in terms of what you can do here. So I'm going to look at these metrics that I have predefined over here. The PE, I'm saying if this is less than my benchmark PE, this is going to be a buy, right? Because you want a lower price to earnings, so lower is better. It means the earnings is higher. If the price is $10 per share and earnings is 2, the PE would be 5, right? If the price of stock is 100 and the earnings was 2, the PE would be 50, right? So lower is better. It just means that the stock price is lower and the earnings is higher. If the stock price is high and the earnings are low, is that really something you want to invest in? If you have a stock that's $500 a share and earnings per share is $2, is that a good investment? Probably not, right? That's a pretty expensive stock. Now there's exceptions. Maybe that could be a good investment long term, but lower is typically better with the PDE ratios. It just means the price is cheaper and the earnings is higher, right? So it's a good combination to have. So I'm saying if that is lower, if the PE is lower than the benchmark PE, which is this right here, then that is going to be buy recommendation. And I'm going to take that and append that to this list here. You see the square brackets again. So this is a list object. Here's your dictionary. You have your key value pair, and here's your tuple. These are the 3 most common types of data types that you find in Python. So lower is better. Recommendation buy. If PE is higher, hold it. Otherwise, we're going to sell the stock. So it's the same logic for all of these down here. Okay, so if earnings per share, so this one's a little bit different. So you want higher earnings per share, right? And the PE you want lower is better. If the earnings per share is higher, that's actually better because it just means that the stock is earning more. The earnings per number of shares outstanding is higher. So you want a lower PE, that's cheaper stock. You want higher EPS, right? So here, if higher is greater than the benchmark, buy it. Otherwise, we have a sell recommendation. So all these follow the same kind of logic. You have to do a little bit of research. Sorry, you have to do a little research and understand what these financial metrics are doing, and then apply the right logic, right? So if income is higher than the benchmark, that's better. It means your company is is earning more. The income is higher than the benchmark, buy it. Otherwise, we sell it. Same thing here. If sales is higher than benchmark, buy it. Otherwise, sell it. So it's the same logic throughout. You really have to understand these metrics. That's the key here to make these decisions. But otherwise, the logic is pretty straightforward. Debt to equity, you want lower debt to equity. If the company has a lot of debt and not a lot of equity, that could be a ticking time bomb, right? So if it has no debt, that's really the best case scenario. So companies that are very rich with cash, Apple, Facebook, Google, Microsoft. I don't know offhand what the debt to equity is, but I'm guessing it's pretty low. Unless they're paying low interest rate, maybe they will keep some debt. Some companies keep debt on their balance sheet, but ideally you probably want lower debt and higher equity, right? And the difference is going to be the assets that the company owns, right? That's the whole balance sheet. So I would say to you, if you don't understand these metrics, go ahead and do some research, Google it, and figure out what these mean. And then, of course, you can change this logic to be anything you want. So I'm going to go down here, run the script, Control-Enter to run it, and here we have the final recommendation. So based on everything we saw before, the pre-E, the sales, the income, all this is the recommendation here. Sell these stocks. B of A, this is Boeing, this is buy. There's a couple holds. I see a hold there and a hold down here, and just a couple of buys. TRV. There's another sell there. There's another hold. A lot of these are sells. If we go look at this BA right here, take a quick look at this guy. So Boeing Corporation, and let's go over here. PEG, actually no PEG. Price of sales, that's good. You want that to be low. Price to cash flow, there's no number right here. That's interesting. We probably want to get that filled in. ROA, ROE, ROI. I have negative here. and then the beta 1.56. So this is 1.56 times as volatile as the market. The earnings per share actually negative, but next year it's supposed to be positive 1.8. Next quarter, yeah. So Boeing's had some problems. I'm sure you've seen it in the news, right? They had some major issues that they were dealing with about for most of 2024. I think early in the year they were plagued with issues, but I think they're turning the corner and coming out of that pretty soon. And TRV is going to look like this. Okay, so this looks pretty good. PE 12, price to book 1.9, price to cash flow 6.05. That looks pretty decent. This looks like quite a good investment here. EPS trailing 12 months 19.5. That looks good. Beta 0.63, so less volatile than the market. ROA, ROE, ROI, all positive, all looking good. This is a good return, right? Return on investment 12%, return equity 19%. Whoops, I didn't mean to click that. And ROA 3.84%. So I can see why this is a buy recommendation, right? This looks pretty good. Let's see one sell. Apple is a sell, AAPL. Oh, this is the first one we looked at, right? Let's go back there and look at this guy again. So price to book, price to cash. I'm seeing some big red numbers here. Not looking good, right? A lot of red down here. Current ratio. Let's see. Earnings per share 6. EPS this year 21%. That's pretty decent. Sales up 2%. ROA, ROE, ROI pretty high. Where's the debt? DBT. Debt to equity. Yeah, so they have a lot of debt actually. So I misspoke before. Capital should be pretty cash rich, but they actually have a lot of debt here. So they must be paying a low interest rate on that debt. You'd have to read the financial statements filed with the SEC to see what kind of interest rate they're paying. We're not going to get that from this data set, but I guess it's pretty low. Otherwise, it doesn't make sense to have that much debt. It's 2 times the equity, right? Debt to equity. But they do have some decent ROA, ROE, ROI numbers. But again, it doesn't match the logic over here. So it doesn't pass the test of price to earnings, right? Earnings per share, trailing 12 months, income, sales. This is not passing the litmus test here, so it's getting a sell recommendation. So yeah, that's pretty much it, guys. Just wanted to take you through that. I will share all the code with you so you can copy paste that, run that in your own environment. Modify the code, add, subtract, enhance it, embellish it, do whatever you want. I hope this was a good learning opportunity for everybody. I learned a couple things when I was putting together this script, and I hope that you will learn something too. So that's pretty much it. I'm going to wrap it up, and I will post this video very soon. Thanks for your time today. Have a great day, everybody. Bye.
Hey there, everyone. Ryan Schul here. So in the project today, I want to look at event-driven trading strategies. Okay, so these are events that come out in the news based on a certain ticker or a certain stock, which is the same thing. Ticker symbol is the representation of the stock on the stock exchange, and news that comes out about that company. And we're going to go ahead and determine, is the news positive, is it negative, or is it neutral? And based on a confluence of keywords and tickers and events that come out in the news, we're going to create a trading strategy and assign weightings to these different stocks and dump this into the portfolio based on the weightings and see what the investment allocation is, and then see what the investment performance is. So why would we even want to do this type of thing to begin with? Basically, to capitalize our market inefficiencies, to understand market behaviors better overall based on news, right, and events in the news, whatever is reported by the news, to generate alpha. Alpha is positive returns on your investments, diversify returns, right? We want to create a diversified portfolio. We want to allocate our stocks into different investments and thereby reduce the risk of investing in one concentrated area, just technology or consumer durables or something like that. We want to spread things around to to eliminate most of the concentration risk. Okay, we want to backtest and validate trading hypotheses. I'm going to show you how to do that. Manage the risk. I alluded to that just a minute ago. Automate decision making and eliminate influential or what's it called, like personal investment decisions or emotional decisions. You want to eliminate the emotion from your decision making activities, from your investment decision making activities. Okay, don't fall in love with a stock, because I guarantee that stock will not love you. If you fall in love with Microsoft or Tesla or Meta or Amazon, that is not going to help you. And I guarantee you 100% mathematical certainty the stock is not going to love you back. So don't love the stock. Okay. And we're going to build event-driven products. Okay, so we're going to look at the components of this whole strategy. Use some data science, natural language processing techniques, an event detector, and trade logic. Okay, to create a trading engine and trading system, and then an execution engine to go ahead and execute these trades as if it was done in real time. Now, this is always backwards looking. You can't go forward in time, right? But we're going to understand what happened in the past and use that to make intelligent, informed decisions into the future, so we can understand potentially what could happen next. Okay, so I have a list of tickers down here. So everything is put into a list, and of course this is dynamic, this is fungible, this is changeable. You can add whatever you want. Keywords here, again, totally changeable. This is what I came up with. By all means, put in whatever you want here. Okay, you need your API key. This comes from the news API client. Let me add a note down here. Actually put these at the bottom. I think I should start putting these at the top, because that's where we always start. We start at the beginning, we don't start at the end. Oh, I don't even have that. Okay, so that's interesting. I thought I had that, but I don't. So let me go ahead and find this just so you have a reference for that. This is News API client. Sorry about that. I thought I had that in there, but I actually did not. So let me see what this thing looks like, and I'll copy and paste the link. I mean, I think you can find it pretty easy, but let me just get it for you, save you a step. API key. Okay, that's what we want. So here's free news API. The thing I like about this is I can give you up to 100 news articles per stock ticker, and you'll combine that with the news event. Okay, so that's where you register for that, and go ahead and copy and paste that over there. So Yahoo Finance has free data as well. API. But they limit you to 10. So you only get 10 news articles per ticker. So how many do we have here? 3, 4, 5, 6. So they would give you about 60 news articles. Okay, so computer's frozen up again. God, this thing is like beyond annoying. Anyways, let me just focus on this thing. So you can get 10 free news articles from Yahoo Finance. I like this. I found this thing recently, like a couple of weeks ago, I think, and they give you, I think, 100 news articles per request, right? So this would be one request, this would be 2, 3, 4, 5, 6. So we can get up to 600, and we're going to focus on these words, right? So we're going to take the ticker symbols and the keywords that we're looking for and create, we're going to go fetch this from this free source and create a corpus of text. A corpus is a body. We're going to create a corpus of text. Now I can't run this because I don't have my API key. Mine is personal and confidential. It's assigned to me. You go get your own free one, copy and paste that in there, and it'll work. So I'm not going to run this in real time, but you can see when you do run it with your API key in there, you will get all these news articles, and it's a ton, guys. So if you look at all the stuff in here, and again, everything is mapped back to these tickers. So you have the 6 tickers: earnings, jobs, inflation, interest rates, Fed, that's the Federal Reserve, CPI is Consumer Price Index, and unemployment. Again, put in whatever you want to search for, you put that in there, and this is going to come back, right? So let's say we have our news articles. We can go down here and use some natural language processing techniques. I'm going to create a dictionary here. This is a key value pair. Here's the key on the left, and the value is on the right. Microsoft, Tesla is Tesla, and that guy, I don't even like to say his name. So whatever. Google, Amazon, and Google is Alphabet 2. I'm not even sure how that works. They have two companies with the same name or two names for the same company. Not sure what Alphabet is, but somehow that rolls up into Google, I guess. So we have the stock tickers. I do understand that. We have the key events, right? I understand that. So we're going to go ahead and fetch that from these news articles, do a sentiment analysis, right? So we're going to tell the computer, um, go ahead and assign a label. Is this positive? Is this neutral? Or is this negative based on the sentiment or the feeling of the news article? Okay, so the nice thing is we can scan through hundreds and hundreds of news articles. As a person, if you have to do that, there could be some bias based on who's reading the news. Does this sound positive or negative? It could be very different for different people. But the machine is going to go ahead and scan through these hundreds and hundreds of articles, and in a non-biased way, it's going to assign a label of positive, neutral, or negative. Okay, everything is going to be standardized into a data frame. And when we get this, we can go ahead and look at the timestamp because I want to know when this news article came out. So you can see the last time I ran this was actually today. Today is August 2nd, and it goes back a couple of weeks. So it goes back to July 17th. So we have about 2 weeks worth of data, 217 records here, and 4 columns. So the 4 columns is ticker, sentiment, title, and then the URL. We have the URL over here. So we have everything we need, right? So we have the ticker, sentiment, title, and then the news article where this came from. So this gets cut off a little bit. That's fine. We can find that thing over here. Google, and then there's I'm not great matches. Okay, well, you know what? Let me see if I can actually fix this because this is a little bit weird here. Because I do want the whole article displayed. Let me see. I'm gonna Google this real quick. Hang on. I do want the whole thing displayed because it's just a lot easier to see that. And I just realized it's getting truncated here with the ellipses. The ellipses is the 3 dots that you see at the end. So let me fix that before we move on here. So give me a minute, guys. Oh, that is. All right, give me a minute. Let me get this updated here. Yep, I know. Okay. Okay. You have to be very nice to this computer, very gentle, very grateful because this thing is going to blow up and it's not going to do anything that you ask it to do. ThinkPad T14, guys. T14. It used to be great, but lately it's getting so slow. It's like, uh, it's incomprehensible how slow this thing is. Let me just Google over here. Let me just try that. The other screen is just totally dead here. Okay, so and this doesn't that show data? That might be the one. Okay. That's that though. Max rows. I don't think it's max rows, but I can try it. Let me see. I don't think so. But it's like a similar command, I think. Let me search for this again because I don't think that's going to work. This guy's got an interesting question. Let me see what he says. That's it, though. I don't think this is gonna work. Yeah, there's a special. Oh, sorry, guys. I apologize. This is not me. This is a computer just going like retarded slow. I mean, like, sorry to use the word retarded. I mean, like, ridiculous slow. Like, I'm sorry. Can you actually work here? I mean, sorry. I tried to do a video earlier today. I had to delete the whole thing. The computer is going so slow. I couldn't even say the message I wanted to say. Like, this data science is a little bit complicated, but it's not that complicated. But you get on a slow machine and just nothing works, nothing happens, nothing gets done. Let me look at that again. There's like a special command here. And I don't memorize these things because I focus on solving. I'll admit, like, I don't memorize these things intentionally because I'd rather solve innovative problems that other people can't solve and, like, get things done that other people just get stuck on. So I intentionally don't memorize these things. I'm totally fine not memorizing, but then sometimes you get into a spot like this where you want to do something that's kind of simple and it just won't work. So well, I am resourceful and I am tenacious, so I'm not going to give up. If this computer refuses to work, that's fine. That is fine. That's the computer. That's not me. That's not me. Oh, that is not me, guys. That is not me. Uh, but I'm not gonna give up. I'm not gonna give up. If the computer doesn't do it, that's fine. I'm not gonna give up though. Not going to do it. I'm not going to do it. Let me ask Chat GPT. Maybe that thing isn't working. This other thing it's just not doing it. Okay, let me shut this down. Obviously, like this computer can just do one or two things. Um, and if you ask it to do three, it ain't gonna happen. So, I'm not gonna give up. I'm not gonna give up. That's it. That's it. I'm not gonna give up. Okay. ThinkPad T4D1. T14, sorry, T14. Oh, ThinkPad T14, for better or for worse. ThinkPad T14. I'm not giving up, guys. I'm not giving up. Not giving up. Okay, you can do whatever you want to do. I'm not giving up. I'm not gonna do it. I'm not gonna do it. I'm not gonna do it. It's the only thing on my channel right now. This is the only thing on my channel. Okay. This was a quick video, 10 minutes. Oh, that's fine. I'm not giving up. I'm not gonna do it. I'm not gonna do it. If the computer gives up, that's fine. If the internet gives up, that's fine. If Google gives up, that's fine. I'm not giving up. I'm not going to give up, okay? So you can do whatever you want to do. I don't care. get this thing over the goal line and start my day. I'm not giving up. So you can do whatever you want to do. I'm not going to give up. Not going to give up. Okay, okay, okay. That's fine. That's fine. That's good. That's good. Okay, if you want to give me a blue circle of death, that's fine. I'm not giving up. I'm not going to give up. Not giving up. Okay, I think something is moving. Something is good. Something's better than nothing. I'll take it. I'll take it. I'll take it. I'll take it. Let me see what ChatGPT has to say. Okay. Okay. Something. And then this thing just randomly goes over there. Oh, there's no work anymore. It's 2025 now. It's August 2nd, 2025. There's no work. It's just solving problems. That's all you do. Solve problems. You don't work. I don't know anybody who goes to work. Okay, nothing's there. That's fine. That's fine. I don't care about that. That thing is barely working. It's limping along. Uh, that's not it. We've already established that. Let me get rid of that. Let me get rid of that. Let me get rid of that. Let me get rid of. Oh, maybe this is the one. Maybe that's it. I'm actually proud not to memorize these things because I would much rather use my brain to solve innovative or do innovation and solve problems rather than just memorize things. I could easily memorize all this stuff, but then I couldn't actually do anything. Okay, that's kind of what I was looking for. Okay, so it's better. Okay, so now I can get the news article. I think we're in business. It only took what 25 minutes just to do a search. Okay. Uh, wait. All this stuff works, guys. On my machine, it's just like ridiculous slow, like ridiculous to the point where I can make a video. I can write the code and make a video in 1 hour, all in narrative. This is what I call the narrative. But the computer goes so slow; it takes an entire day to do something that should take like an hour. And when I say a day, it's like probably close to 24 hours just to do this, which should take less than an hour. So, anyways, wants to move forward despite the slow computer, trying to get to 365 videos in 365 days. This is like number 360. I think I've got 5 more to go with this. So let me just get over the finish line and then take a break. So you can see all the news articles. You see what we have here. We have the ticker, the sentiment, the title, the URL, and the timestamp. Okay, and in the with respect to time, I will move forward at a quicker pace. So we have 217 rows, 4 columns. These are the 4, right? The row is actually, the timestamp is actually the index. So this is like a unique identifier for all the rows here. This is kind of like a row counter, sort of. So here's the index, and we have 4 columns, right? So that's what we're looking at, and you have all the sentiment, the ticker, the title, and then the URL to get to the news. So over here we have buy, sell, and hold. If the sentiment is greater than 20%, then we buy. If it's less than negative 20%, we sell. Otherwise, we hold. So pretty basic logic. I'm not going to go ahead and refresh this and rerun it because I don't know what the computer is capable of. I know how these things should work. If I hit run, it could take 15 minutes. I don't know what this thing is doing. But we have ticker, sentiment, title, URL, and then the signal. So this is the investment signal, right? So we got the 4 from before, the previous logic, the previous step, ticker, sentiment, title, URL. Now we're introducing a buy, sell, or hold recommendation based on the sentiment score, right? So sentiment 0.10, hold. This is greater than 0.2, so that's going to be a buy over here. I see a couple holds. It's between negative 0.2 and positive 0.2. And this is 0.5, so that's positive and that's positive. So these are buys and holds. I don't see any negatives, so that's fine. If we have a negative, we get it. If we don't, we don't. So the overall event count, this is called aggregation. We aggregate everything to get a mean, and that's the average sentiment. So we're getting the mean of the sentiment and the event counts. So Microsoft has 68 news articles, Meta has 64, Apple has 40, Amazon 33, Tesla 5, and Google, Tesla has 7, Google only has 5. So Microsoft has a lot more news content. The overall sentiment is about 12%, so kind of close to positive, not actually positive because we're looking for 0.2 or greater. So this is the highest sentiment, so these have lower sentiment. Oh, that one is kind of high too. Okay, I think we are doing descending by event count. We could set that by average sentiment. Going out on a limb here. I don't even know if I should do this. Should I do this? Is the computer going to take 15 hours to run the process? Okay, so this is descending order by average sentiment. So Google here is a little bit more positive, but it only has 5 news articles associated with it. I'm going to go back to what I had before, kind of like that. So event count, just because we're sorting in descending order by number of news articles. We have 68 here. Here we only have 5. So the sentiment is higher, right? 0.20 and greater is considered positive. This is only 12, so this is neutral. So either or, I mean, take your pick. Do you want to sort it by event count or by average sentiment? Doesn't really make a huge difference. So this is the buy, hold, sell plotting by counts. So we have 3 holds, 2 buys. Okay, here we have 4 buys, 3, wait, what was it? Neutral? 4 holds, 2 buys. Microsoft has a bunch, right? That's the biggest. So hold 50, buy is 17, and sell just has 1. And over here, I think this is going to be 1. This is 1 for this. Almost froze again. Okay. 1 sell for Meta, 14 buys, and then 49 holds. Okay. So going down here, we have all the trade logic. So this is the cost at that point in time to buy this number of shares. We could buy 16 of Tesla at 302. 16 times 302 is 42 and 8 cents. We buy 19 of Microsoft at 524. So total is 4,716, and so on and so forth. So these are all the buy recommendations or sell. We have a couple sells of Apple down here. These are the proceeds down here for selling, and a couple sells and a couple more buys. So the portfolio value is 100,000. Final positions: Apple 40, Microsoft, Google, Amazon, Meta, and Tesla. You can see the investment allocation down here. So we're going to test if the investment threshold is greater than or less than 0.2. If greater than 0.2, then we buy. If less than 0.2, then we sell. So that's what this is doing. So the threshold right here is represented, and we see the buys and the sells, and then the actions over here on the right. To optimize the allocation, we are going to look at the value counts. We have the total buy counts, total sell counts, and then all tickers down here. And this is actually not displayed. Let me display this thing. Signal. It's looking for a signal. Okay, so I think I have to run this all in order. I have to go back over here. This should be fine. That is fine. I think something got lost in memory. Color equals signal. Okay, let me look at this. DF events. Why would it not? I don't get it. Okay. It works yesterday and doesn't work today. I don't get it. Okay. So they have the counts over here. It's not loaded in memory, I guess. I don't know. I mean, I don't know if my machine just has some problem with Alzheimer's or what. But it seems to forget a lot of things over time, which I don't really understand. Anyways, here's the buy, sell, the overall score, the weights, and then the allocation. So we're trading with $100,000. That is the assumption here. Let's see if I can find that. Okay, yes. So here's the weight. So the assumed value of the portfolio is 100,000. You can make this whatever you want. If you want to make this 1 million, you can do it like this. It looks a little funky when you have these underscores over there, but it's actually easier to read. There's two ways to do that. You can do that where you have 300,000 allocated there, 300,000. These almost have the same weights. Actually, they do have the same weights. This has slightly less weight, Tesla, Amazon, Google. So you can understand, pretty straightforward, right? You would put most of your investment into Microsoft and Apple. It's actually evenly allocated. And that comes from the buy sell score. So you have 70 buys, 1 sell for both of these. Just haphazard, just random. That's the way that it came out with the sentiment analysis that was done before. Here we have slightly fewer buys and same number of sells. That's why less is allocated to Meta. Now we have 3 buys, 0 sells. So a little bit positive, but this is way more positive. So you have a bigger allocation. Here you have 3, so same allocation, 0.05, so 5% of the portfolio. Here you have 2 articles from Google, or that mention Google, that have a positive sentiment, no sells. The score is 2.0, and we allocate 3% of the portfolio. And like I was saying before, you can represent the $1 million like this or like this. I think this is just slightly easier to read. You cannot put a comma in between, right? If you try to put a comma like that, it's going to blow up, okay? It doesn't like that, but if you put the underscore, it's actually easier to read, and it works, okay? So we are going to go ahead and pull in historical time series data from Yahoo Finance. I'll go with the same 1 million. It doesn't matter what you invest here. It can be 200,000. It's whatever you want to invest, 250, 100,000, whatever you have, right? These things are dynamic, and the time period that you pick is dynamic too. So you would have to input this, you have to input this. Everything else is just going to flow for you, okay? So you have the weights from this step over here. So you know 30% of the portfolio is going to Microsoft, 30% to Apple. So it's 60% right there. Another 24% to Meta. So what is that? 84%. This is about 90%, this is 95, and you round off at about 99%, right? This, you round up a little bit there. And you have the 1 million that you invest. It goes into these 6 stocks based on this weighting, okay? And we're going to compare everything to the historical performance of the S&P 500 for the same time frame, right? So we're going back to 2024. So January 1st, the market is closed, but your investment or your trades will be executed on the 2nd. So January 2nd, the money gets dumped into the portfolio based on these weights that you choose right here, okay? And the overall return is about 41%. The annualized is the same because we're returning for 1 year, right? If I put in a different time period, like 12,
0.06. So for the first half of 2024, I think it doesn't like this date, right? Because it's on 6:30. Okay. I thought maybe it would just do it anyways, but I guess not. It looks for that exact date. So the annualized return here is 53% because we don't look at 1 year, we look at half a year. But for that time period that we're looking at, the 24 months, the 6 months, for the first half of 2024 is 23%. Maximum drawdown is about 9.27%. Probably happens over here. That's the maximum drawdown. So we're looking for the maximum dip. But this strategy outperforms the S&P 500, right? So the S&P 500 has about 15% return. This has about 23%, 123. You can see that's the ending value divided by 100 minus 1. That's how we get the 23%. And the annualized is 53%. So like I said, you would have to choose the time period that you want to work with here. If I do 2023, Control Enter, the return is going to be slightly different now because different time period. So this strategy still outperforms the S&P 500, 93%, so almost 100% return on your investment in 1 year. Not bad, guys. That's not a bad return at all. Maximum drawdown is about 11.4%. Probably happens right over here. I could add more colors to the chart, like where exactly does the maximum drawdown occur. I didn't actually do that. I didn't think about that until now. But it doesn't always. This strategy doesn't always outperform the S&P 500. Really, it depends when you're invested in the market. Here, we actually lost 40%. So if you're invested in all of 2022, you lost 40% with this strategy. The very next year, 2023, you make 94% or 97, whatever that thing was that we just saw. And here, the S&P 500 does outperform the strategy that we picked. This is the event-driven strategy based on new sentiment. But if I go back another year, I think this will outperform. I think 2021 was a good year. Let me see what we get here. Yes. So the strat wins 41%, 141 right there. S&P is about 29%, so slight outperformance. 2020 was a good year. That was COVID. COVID was, you know what that was. And you know my opinion on that. I don't think I need to talk about COVID anymore. So that's 88% return, and the S&P was about 14%. So in most years, in most scenarios, the strategy does outperform the S&P 500, sometimes by a small margin, sometimes by a pretty wide margin. But again, guys, this is not investment advice. This is not my recommendation to you. I'm showing you the statistics, the mathematics, the finance, the data science, the analytics of how this works. Okay, I'm not saying that you have to invest in this. It's not investment advice. It's not a recommendation. I'm just showing you the fundamentals of how this stuff works in the real world. Okay, that's what this is. So don't get angry if you invest and lose money. Don't try to sue me. I have no money, by the way. If you want to, you get nothing. I have this channel that I've been doing for almost exactly 1 year. I'm almost at 1 year anniversary. Made zero on the channel, right? I'm gonna have to go back to corporate America. I thought the channel would be successful. I thought, okay, I'm gonna, I'm sitting on a gold mine here. I'm gonna just do YouTube for the rest of my life. Made zero, not even a penny on this thing. So I have to dust off my resume and head back into the corporate space. I guess not too thrilled about that, but whatever. I mean, my skills should transfer pretty effortlessly in many different ways. So that's it. Event-driven trading strategies. This is how you can outperform the S&P 500 in most scenarios, not every single one. I think 2022 was the 1 year that we saw that the S&P outperformed the strategy, but for the most part, I think like we saw 80% of the time, the strategy beats the S&P, which is very interesting. I think I looked at several strategies and I recorded all my thoughts on the channel. You can see it's kind of scattered around. You'd have to search a little bit for it, look for finance investing. I don't even know what the titles are, and there's so many of them now. I even get confused. There's so many now. So I have 360 videos at this point. This is number 360 exactly, I think. And there's just a lot of stuff on my channel and a lot on YouTube. If you look around, look at other channels by all means. Like I'm not saying like mine is the best or just focus on mine. Look at the other ones out there, and you can learn a ton. You can learn a ton about investment philosophy, different trading strategies.
There's so much information out there. There's no excuse not to learn. Okay. So, anyways, I'm going to wrap it up here. This is event-driven trading strategies. I think I already saved the notebook. Let me see if I save it again, I'll just get overwritten. So I'll share all this code with you guys, and I'll upload that when I upload the video. I'll drop the video a little bit later today, and you'll have everything you need. You have the whole narrative. This is what I'm recording right now. You'll have the whole video. Sorry, that's the same thing. You'll have all the code, and you have everything you need. Copy paste it into your own Jupyter notebook, run it, and enjoy. Let me know your thoughts, your comments down below. I'm going to wrap it up here, and I will see you in the next video when I post that, and that's going to be very soon. So keep an eye out for that. Thanks, guys. Take care. Bye. Hey there, everyone. My name is Ryan Schul. Welcome to my analytics channel. So in the narrative today, I want to talk about how I created this experiment to see if news that comes out during via different media channels has any impact on stock prices. Okay, does positive news drive up a stock price? Does negative news drive the price down? So I want to analyze that and go ahead and answer this question. So this was originally proposed to me, I don't know when, years ago. I met some guys at some investor conference, and we were talking about this. So I think it was a pretty interesting topic, and I want to address this. This is not on my channel yet, so I want to put it out there so everybody can see it. Okay, so I'm going to go ahead and import the regular libraries over here. Okay, so that's what that is for. That should be pretty standard. If you've seen my other videos, this is going to be very, very recognizable. I have the Dow 30 tickers in this list, and I'm going to pull in the Dow Jones Industrial Average as well as the S&P 500. Okay, so I just want some reference here to understand like how are all these stocks performing relative to each other and relative to the overall benchmark, which is going to be the S&P 500. And I want to look at the market as a proxy too. Okay, so I went ahead and created a data directory here. I have the start date as 2020, so that's pre-COVID, right? That's just before COVID hit. I want to pick that up, and the end is going to be basically today, right? So it goes up to current. I have my news API key in this file on my desktop, right? So you're going to have to go ahead and set that up. You can get that from this website right here. Get the API key. I already did that. You're going to have to do this for this thing to run. Okay, and then just drop it on your desktop. That's pretty much it. So I'm going to go ahead and open that file. Control F, or is it, oops, Control F. And you can see that the file is referenced right there. I'm getting that and opening that and just fetching it, and the API key is contained in there. So you don't have any spaces or trailing or leading spaces. Just make sure that's just the key, and that's it. Okay, that's all you want there. So I'm going to go ahead and download my prices from all the items in this list of tickers right here. This is my Dow 30, so I'm going to go ahead and run that. Control Enter to refresh the cell, and as always, I'll give you all this code so you don't have to take notes or try to figure out what's going on. You can just download it and copy and paste it and run it in your own environment. So we have the returns right here. So I'm looking at stock returns and market return. This is the market return down here, right? And these are all the stock returns. So pretty standard stuff. I've got probably at this point a couple dozen videos on my channel that describe exactly the same setup. So that's pretty normal, right? So I want to go ahead and create a small dictionary here with the ticker symbol. That's what you see here, and then the name of the company. Okay, so we're gonna have a key value pair. You see this all the time in a dictionary. Key values are basically the definition of a dictionary, right? And you see a few other data types as well. You can see I'm using a list over here, right? The list has these square brackets. Sometimes I use tuples. It's not very often because they're not mutable. You can't change them. I like lists much better, and data frames. So I tend to use these three. Okay, so at this point, so I'm creating the ticker, the title, the URL, the publisher, and the date. Now I want to go ahead and use Google search, and I'm going to go back 30 days. Okay, and I'm going to grab, I think this is a limit of 20. So 20 news articles per ticker going back over 30 days. Now you can see that the stock information goes back to early 2020, right? So we're going to have tons and tons of history. We're really just going back about 20 days for the news, or 30 days for the news, and 20 ticker news articles, okay? And we're going to go ahead and analyze all of these from this RSS feed, and then I'm going to try to determine the sentiment of the news article, right? We're going to do a quick sentiment analysis, and understand is this positive, neutral, or negative news, and then see what kind of impact that has on the stock price. Okay, so hopefully that makes sense. So we're going to get these news feeders, RSS feeder right here. Okay, so give this a moment to run. Oh, this goes pretty quick. It does take a few moments. And we have the pause button. I'll be right back. Okay, so it did take a couple of minutes, and I've got my news articles here. So I have the ticker, right? This is the stock ticker or symbol, whatever you want to call it. We have the title, and then we have the link too. So if I go over here, copy and paste this, you can see where that is coming from. I also have the publisher and the date of the news article. So that was 10/7, 2024. We have 10/11/2024. The date that the article was published, I guess that's what that is. Okay, so if I copy and paste that in here, just a quick sanity check. Okay, Honeywell debuts new technologies across the electric vehicle battery ecosystem. So that seems to be working fine. Let me look at this one over here. This one was for Boeing, right? So what's this article talking about? If we go over here, Boeing CEO message to employees on positioning for the future. So both of these seem kind of neutral sentiment, not huge positive, not huge negative. Definitely not negative. Doesn't seem to be. Let me just do one more quick sanity check over here. Control V to paste it. And Honeywell launches new generation of AI capable devices to propel workforce productivity and customer experiences into the future. Okay, so I mean, this one's a little bit positive. Is that going to drive the stock price? Probably not. I don't think the other two are going to have an impact either, but let's see. Okay, we'll do the analysis and we'll see. So, anyways, I have the data frame all set, so that looks nice. So let me go ahead and leverage some NLP techniques over here. So this is natural language processing. I want to look at the topic itself. This is what we're going to focus on. This is called title. Okay, so we're going to look at the title. Try to determine the sentiment. Is this positive, negative, or neutral? And this is a surprise. This is kind of what people kind of expect, or this is just a surprise to users, right? So I have the sentence transformer down here. I'm going to pop that in and basically run that over the RSS newsfeed. This is news RSS. Okay, so that is a data frame. If you go back here, you can see that indicated right there, right? So we're looking at the head. So you can see in all these videos, I try to explain this, and I have to figure this stuff out too. I don't know everything, guys. I certainly don't know everything. So I have to figure it out as I go along. But I try to make these videos like pretty much very similar, very standardized, so you can follow along pretty easily. And it's just easier for me too, right? There's probably many ways you can skin this cat. If you do everything always different all the time, it's probably gonna be a lot harder to learn. If you come up with little changes once in a while, that's totally fine. But if you do things fundamentally the same, and that's just your style, that's your sort of purpose, or what I say, just your signature or your style, I think that's totally fine. Just try to be consistent and persistent, right? So I'm referencing the sent date and the sent and then the date in the RSS news feed that comes from the data frame. You can see that. And I'm going to look at rolling period over time, because I don't know just exactly at this point in time, is there going to be an impact on the stock price based on this news article that came out? But we can look over a period of what are we looking at? Minimum period of 5 days to see if there's an impact, right? So maybe at this point in time, there is no impact. Maybe there's a slight lead or a slight lag. I mean, I don't think there would be a lead necessarily, because news hasn't even come out. But maybe there's a slight lag between the news article being punished and the movement of the stock price. And again, maybe there's no movement whatsoever, right? That's what we're trying to determine. So I have some basic metrics over here. I'll show you how this works in just a minute. I'm going to hit Control Enter to run this. Okay, this should be pretty quick right here. And again, I'm looking at the ticker, the date, topic shift, and then the mean. I just want to understand the average change in stock price over time, again, based on the news that is being published from these Google news articles, right? So we're using Google over here. If you look close, you can see that is the source, right? So Google RSS. I forgot what RSS stands for. Let me check this out real quick. www.rss feed. Oh, here we go. Meaning I used to know this. I forgot. Oh yeah, really simple syndication. Okay, so it's just basic news, right? And you see this all the time with comments online. Probably Twitter uses some form of this or something like that. Maybe YouTube uses it. Certainly the news uses it. I've seen this in Stack Overflow. They have RSS feeds as well. I haven't used Stack Overflow in quite a while. Some of those people over there are kind of mean. Like you ask questions, right? And they take it for granted that you know all this stuff. Well, if I'm asking a question, it's because I don't know. That's the purpose of me asking that question, right? And they expect you to know everything all the time, but nobody knows. Okay, so this is running. And again, we're looking at the topics, the topic shift over the span of 5 days, and looking at things like the average sentiment, right? And what kind of impact does this news story that is published having on the stock price, right? Is it driving it up? Is it driving it down? Is it just in between? There's no neutral sentiment. There's no real up or down movement of the stock price, or like what's going on over here. That's what we're trying to determine. So I think this is almost finishing up. Let me see here. And I think it does take a little while because it has to do the analysis for every single record. And I think we're getting like, what was it, 20 per? Let me look at the setup again. So, yeah, going back 30 days, I'm looking at, I think 20, where is it? I can't see it right now. 20 per, oh yeah, per ticket, per limit. So it's got like 600, I think, over here or something, or 300, right? Okay, 300. We have 30 tickers in a Dow, and maybe not all of these tickers even have news on it, right? So Honeywell does. There's one there. There's one there. This is Boeing. CRM, I believe that is Salesforce, and what is this? Intel, right? Yeah, Intel Newsroom. Okay, so that's it. So still waiting for this final data frame to be displayed, but this should come up in just a minute. I'm going to hit the pause button here, and I will circle back when this thing is done. Okay, so hang in there. Okay, we're back in business here. So I have the ticker, the date of the published news article, the sentiment mean. This is the feeling. Again, sentiment is positive, negative, or neutral. So this is the average sentiment. This is the feeling of the article, the number of counts for that article. Looks like there's one there, and then the cent Z and the topic shift. Okay, so we're looking at these metrics right here to, again, try to determine what is the overall sentiment of that news article, right? And how is that going to potentially drive the stock price, or does it have no impact whatsoever? Okay, so I'm using Finbert to go ahead and leverage this tool for my NLP stuff here. This is a natural language processing model, and it is pre-trained specifically on financial text. So I think this is very appropriate. It's built by training the BERT language model in the finance domain using large financial corpus. Corpus is a body of text, and thereby fine-tuning it for financial sentiment classification. Okay, so I just Googled this thing and I just copied and pasted it over there. Hopefully there's no kind of, what is it called, plagiarism or something like that. I don't think so. I'm just defining what's Finbert. That's it. So we have the cent mean. This is the average Finbert sentiment of the day's headline per ticker, right? We computed the Finbert class probabilities based on headlines, again, sentiment, and the sign score. P is positive and negative. It could be either or in between, right? If it's neutral, the article count is the count for the ticker, how many headlines went into it. Normally it's one, sometimes you'll see two, so there's two articles here for, what is this, Walmart, I guess. The sentiment Z-score is a standardized definition from the ticker's own 30-day rolling mean. So Z is always calculated as mean minus the data point divided by the standard deviation, and this just shows us like how skewed or how something is going to move over time, right? So you take the mean of everything, subtract out that data point, and divide by the range or the standard deviation of those scores, and it answers the question of, is today's sentiment for this ticker relative to its recent history? That's what we're looking for there, okay? And then topic shift is the day-over-day change. This is calculated using Jensen-Shannon distance between yesterday's and today's topic distribution of headlines for that specific ticker. Okay, so we do have a couple metrics here. We're trying to quantify things and then again understand the impact on the stock price. That's what the point of this whole thing is, right? So the price impact is relative to the abnormal returns. Okay, so we can get that over here. So I'm looking for something that is basically normal. If my notes here, I have if one next we get a label of 1 if the next day 3-day CAR is greater than 0. Otherwise, we get 0. Okay, so in most cases here, we don't have a whole lot of 1s, and that's just because the news tends to be kind of the same relative sort of thing over time. You do have extreme news stories, but you don't see too many of those, right? So a lot of times you'll get 0. There's really no significant label here. There's no meaning or importance between the news article that's published and the stock price that we're looking at relative to the news, right? But sometimes you do see an impact, right? But it's pretty low in most cases. So, so this thing is running. I think we're in good shape. I'm going to, I guess I'm going to pause the video. I thought this thing was a little bit faster, but that's fine. I don't want to subject you to having to wait for this thing to finish up. This could take a couple of minutes. I'll just hit the pause button and I'll be back when this thing is done, okay? All right, so the job is finished. And again, we're looking for either 1s or 0s if the cumulative abnormal return for the stock price is, how do I explain this? We get a 1 if the cumulative abnormal return over the next 3 trading days is positive, right? Otherwise, we get a 0. So you'll see there's quite a few 0s in here. I don't even see any 1s, but that's fine. We just want to know what the pattern of the stock price has been and what the trend is. Okay, so that's why we're doing this step. And this is basically a supervised target for an event-driven alpha model, right? So the event is the news story, and we want to see if we can generate positive alpha. This is capital gains and profit in the stock market. That's what alpha measures using the features that I just showed you, using the BERT model, using the sentiment analysis, and so on and so forth. So now we have to align the news features and the stock returns. So that's what this step does over here. Okay, so I can see the ticker down here. This is article count. Usually it's 1. Every once in a while you get more than 1. The sentiment mean, so this is the average sentiment score. So close to 1.0 is going to be high. This is going to be positive. Negative 1.0 is going to be highly negative. So I see one that's pretty positive over here for Honeywell, and I see one that's fairly negative over here for Boeing. The sentiment z-score, again, the z-score measures the overall mean for all the scores minus the data point divided by the standard deviation. That's what that is, okay? The topic shift is over here, and label CAR is the last metric that I'm using over here. So you can see, I'm going back in time a little bit. We have like some sentiment over here, right? That's pretty positive. That's somewhat neutral, mostly neutral. This is highly negative, pretty much negative, positive, kind of neutral right here. It's not really strong. This is highly positive and somewhat strong negative, but I think this would actually register as neutral. I think that's how that would be interpreted. So, okay, so now we can move on to the next part here. The article count is simply the counts. The cent meaning is yesterday's average Finbert sentiment analysis. Remember, Finbert is doing all of the, as a pre-trained model, is doing all of the analysis of the body of text, right, and the language specifically relevant to finance topics, right? So the sentiment Z is yesterday's sentiment surprise. Again, I'm calculating the z-score the standard way, like I showed you. The topic shift is yesterday's average day-over-day topic change, and the label CAR3 is your target, which is a 3-day cumulative abnormal return. This is the CAR starting on this date, right? Looking back over three time periods, basically 3 days, and with a daily top 20% selection and a tiny cross selection, you could be selecting one name or none per day. Okay, so sometimes there's just no news articles for whatever reason coming out about these stickers, and then sometimes you'll have one, sometimes there'll be more than one, but there's no guarantee there's even going to be news published about Microsoft and Honeywell and Boeing and Apple, right? So if there's no news, then there's nothing to do. There's no action, there's no event. So Moving on, can we actually profit from this? That's what I want to know, right? So the model is set up, it seems to be working, but how do we actually generate a profit? And can we generate a profit? And how do we do that? So that is what this cell is for right here. Control Enter to refresh the cell. I'm using a new model here. So I have the training and testing. TR is training and TE is testing. So I'm not going to get into all the machine learning. This video is not about that, but I have dozens of videos on my channel specifically about machine learning. You always have the training set and the testing set. Usually it's about 70-30 or 80-20. If I think by default it goes to 70-30, but you can choose whatever testing threshold you want. You can make it 75%, 80%, right? So just basic model, running the model over there to see if there's any significance and what the outcome here is, right? So we went ahead and generated all the signals. We can see we started the portfolio at about, this is 100% of the money invested. We lost a little money over time. This is about down about 2%, kind of dips down here, down about almost 4% at this point. And then the portfolio comes back a little bit and we end after, what is this? 6 months. I think it's 6 months. Today is October 3rd, 2025. So we go back about 6 months and we end down at about 98.81%. So we lost some money on this trading strategy, right? If we bought these Dow 30 components and have equal weighting for each of those, I think it's about 12.5% of the total amount of money. So if you had 100,000, you'd put 12,500 into each of these stocks and you would end up with a negative return of about just over 1%, right? So really, we're not making any money on this trading strategy whatsoever. And you can drag that across and scroll that out if that's your pleasure. You can go ahead and do that. That's why I like these plotly charts. Charts are very interactive and dynamic. So really, 90, 98 is about down 98. I ran this a couple times and it's pretty dynamic, right? So it's going to change a little bit. So this is last time I ran this was a couple days ago. So walk forward, as configured with this, RSS News is not profitable. Certainly before costs, right? Because I haven't even taken into consideration any trading costs or any taxes. You wouldn't owe taxes on this because you actually lost money. But basically, the whole strategy is just not generating a profit. So we could say that the headlines are short. They're a little bit duplication. We saw a couple times when the news article was 2. We had 2 counts of those. That was a little bit weird. You would think they would just put out 1, but sometimes there's more than 1. And they're kind of laggy, right? So it's always backwards looking. So the news will come out, the stock price could be impacted, but really it's not going to have a very major impact. This is called de minimis. There's really no impact whatsoever on these stock prices. You lose a little bit of money, in this case about 1.5 to 2% negative return, right? This is called capital destruction. You want to create capital, you don't want to destroy capital. So this strategy simply doesn't work. But again, we looked at the entire portfolio, right? We invested in all of these stocks. So now we can take a slightly different perspective and say, well, okay, this is all well and good. So I can't put an equal amount of money in all 30 Dow stocks and expect to make money. It's just not going to happen. We did the walk forward. We did the lag back in time. I think that was like 3 days. I think that's why I said that too. So it's not going to work. But maybe we can pick specific stocks and generate positive returns on some of these Dow 30 components. Maybe we don't have to have a very diverse portfolio. Maybe we can look at just a handful of stocks. And if you have a certain affinity for Amazon, you can buy that. This is Amgen, McDonald's, Johnson & Johnson. Maybe you can just pick a few that you follow that are your favorites and use these news generation RSS articles, right? And say, maybe I can just pick a few stocks. I don't have to pick all 30. Maybe I can concentrate the portfolio on just a handful of these and see what the returns are. So these are the news correlations, right? That's what I'm looking at right here. And I'm going to go back to the same methodology I had before with counting the articles, sentiment mean, sentiment z-score, and then topic shift to see if this is moving over time. So this RSS window is recent. It goes back 180 days. There are a few Apple headlines, few McDonald's, few about Boeing, and so on and so forth. Some features for Apple are or actually missing on some days, right? The news doesn't come out every single day about Apple, and that's totally fine. But we do want to capture these, right, whatever is available, and try to understand the potential direction or impact that's going to have on the stock price. Something is happening, or something big is coming up, right? That's what we want to try to understand. So this Finbert pre-trained model is helping us to understand that. What else do I have in my notes? Higher sentiment mean is more positive and lower is more negative. I think that's pretty straightforward. The sentiment Z, higher surprise versus baseline, right? So again, the Z-score is the average price minus the actual data point divided by the standard deviation. That's how we're calculating that. And we're looking at shifts over time too. Is there some kind of regime change? Like, is the CEO of one of these top companies like a newly appointed CEO? That is going to probably drive stock prices, right? Is there something novel that the company's coming out with, something innovative, something that's really big news and it's really going to drive the stock price up? Or maybe there's a recall or some kind of investigation, or the CEO resigns unexpectedly. That would be bad news, and that is going to push down the stock price most likely. Okay, so let's look for some evidence of that. I'm going to hit Control Enter to run this thing. Okay, so I have the positive, negative, neutral sentiment over here. The average mean return for 1 day. This is the 3-day mean, and then the count of the news article, right? And then I want to try to understand the impact that this has on the stock price. So the average 1-day mean for negative news articles actually has a positive impact based both on the AR mean number and the CAR 3-day mean number, right? For neutral, there's not too much really going on here, right? So neutral news is basically just neutral. There's no impact. Negative news is actually positively impacting the stock. That's kind of surprising, but it's not unheard of. And if the news is flagged as positive, the AR mean is actually going to be negative, right? So here's a case in several cases where positive news has a negative impact on the stock price for the 1-day mean return, but for the 3-day, it is positive. That's what I would expect over here. This is a little bit counterintuitive, but apparently negative news drives up the stock price pretty significantly, actually, but not like super huge, not as much as you would really expect it to. And this is a heat map over here. So the red bar is going to be higher negative. You can see higher negative over here. So this for TRV is negative 0.08, but it's pretty small. It's pretty tiny. And here, this is almost incalculable. This is close to 0. This darker blue is 0.06. So negative news has a average 3-day abnormal return positive for Triple M, positive for IBM, and positive for CVX. And these over here are, I'm sorry, negative news, right? We're looking at negative. So this actually can have a positive impact on Triple M. The others are tiny. I wouldn't even really register that. It barely moves the needle. Here, neutral news is associated with a negative stock price movement for TRV. These are slightly positive, and over here you have some positive news specifically for CVX and a positive move of the stock price. And over here you have slight negative move of the stock price with positive news, right? So you have to look at these 3 columns. You have negative news, neutral news, and positive news, and there is not a huge impact on the stock price. You have one that goes down 8%, so the stock tanked 8% for TRV, right? I only see one instance of that, and all these others are pretty much not even moving that much. I mean, just slightly, but I would say that the market is pretty random, and you cannot use like positive, neutral, or negative kind of news that comes out and expect that to have a real impact on the stock price. Maybe a small, tiny nudge, but nothing significant, nothing that you could use to actually trade on and to make or capital creation or to create some kind of profit from. It just doesn't exist, guys. It just doesn't exist. Okay, but at least we answered that question. Can we look at news that's coming out from a reliable source? It's all from Google, and create a positive profit-driven alpha pipeline for the Dow 30 components? No, we can't do it. It's not possible. So that's it, guys. So we answered this question, and I think it was pretty interesting. I think it was a pretty interesting journey to get here. So I would like to see some positive impact over here between news and the stock price movement, but it just doesn't exist. So that's it, guys. I'm going to wrap it up here. Thanks for your time. Thanks for watching through to the end. I appreciate that. I am going to take this thing, put this to bed right now, and I will save a copy of the video, and I'll post it later today for your amusement and enjoyment and all that fun stuff. Okay, so I'm going to wrap it up here, and I'll see you guys in the next one. Take care for now. Goodbye. Hey there, everyone. My name is Ryan Schul. Welcome to my predictive analytics channel. I talk all about data science, machine learning, deep learning, and things of this nature. I'm coming up to 200 videos really soon here. I think I'll hit that today, actually. So kind of proud of that. And I want to keep going, by the way. So let me preface, whatever the term is, this lesson just by saying that I would prefer not to go back to the corporate world and do the 9-to-5 thing and so on and so forth. But I have to be successful with the channel too, right? Like if I'm not super successful, I probably have to go back to the 9-to-5 grind. So I'm hoping that I can pick up some more subs. Sub is short for subscriber, and get people to increase their watch time. Some of the watch times on my videos are kind of short, so I can tell that people aren't watching it from the beginning to the end. But I would like to pursue this as a full-time career rather than just a hobby. So I'm trying to cross my fingers and just getting hopeful that that this channel can become successful. And I think we're leaning towards that, but it's got a ways to go. So let's see how everything shakes out. So today's lesson is pretty cool. It's about getting AI agents to analyze stock prices and make recommendations. We're going to use a Jupyter Notebook and Python code, of course, because I do this for all of my lessons that I demonstrate over here, all the demos I make and showcase over here. So why would we use an AI agent for investing and trading strategies, right? There's several reasons. We can use data-driven decision making, basically eliminating the empathy or the feeling or the emotions for making decisions. Sometimes people get really emotional about their stocks and they fall in love with a particular stock. You cannot fall in love with a stock for one reason and one reason only, because that stock will never fall in love with you. So why would you love that thing back, right? So you want to remove the emotion from the stock. Don't fall in love with any one stock or any company. Please don't do that, because it is not mutual, and the company will not like you as much as you like it. That will never happen, right? So you want to remove emotions, make your decisions more driven by data, use predictive analytics and pattern recognition. I'm going to show you how to do that. Use different machine learning models. Okay, we have a couple of models we're going to look at today. Pretty simplistic, and there's all kinds of different ML algorithms that you can apply in these data sets. So this is just one example, so keep an open mind. This is just one way to do it. Automation and speed, right? We can import data very quickly from the web and analyze it much faster than any human being can achieve the same results, right? So automation and speed is a huge advantage. And to reduce emotional biases, that's what I just mentioned. Don't fall in love with the stock, because it will not love you, I can guarantee it. Risk management, we try to manage our risk exposure and diversify the investments that we have in the portfolio. And I'll show you that in just a minute. We don't want to necessarily have a lot of money invested in 1 or 2 or even 3 different stocks. We want to pick a bunch of different stocks, and preferably different industries or different sectors, right? So we can diversify across different types of investments, right? And we would have more exposure to market risk or some type of diversified risk only, but not sector-specific risk or security-specific risk. That can be very dangerous. You could invest in a stock that happens to take off and you make double or triple your money, but realistically, that's probably not going to happen. So don't even try for that. That's more gambling. That's not investing, right? We want to focus on investing here and diversified, responsibly created and maintained portfolios, right? And portfolio portfolio optimization is another reason that we could do this. I have another video on my channel specifically about portfolio optimization. If you Google that, not if you Google that, I mean, if you search for that on my channel, you'll find that there's only one on that. So take a look when you have some free time. So here's a bunch of tickers I'm going to pop into a list, and I'm going to pull historical data from these 24. I'm sorry, I'm looking at 24. Sorry about that. We have about 30 stocks. This is the Dow 30 here. These are all the components of the Dow. And I'm pulling in the last 24 months of trading, right? So we're going back in time 2 years. So it goes pretty quick. Like I said, speed is a huge advantage with these processes, right? Where you eliminate the emotions for making a decision. I just mentioned over here, right? And try to automate the process and make it more data driven, right? And that's what we're trying to achieve here. So I pulled in the historical data. I'm going to create some buy and sell signals looking at the 50-day moving average and the 200-day moving average, right? And the 50-day is greater than the 200. I'm going to add a 1, right? So 1 is just going to be a flag that says go ahead, and this is going to be a positive buy signal. We're going to look at that more closely, or just recommend that as a buy signal. And if not, oops, accidentally made a tiny mistake there. Let me undo that. So we add a 1 to a buy signal or a -1 to a sell signal. So if it's not a buy, it's a sell. If it's not a sell, it's a buy, right? So we're looking at 50-day moving average across crossing over the 200-day moving average. So we're looking at a shorter moving average that fluctuates more over longer maturing, over longer moving average that moves just more slowly, right? Because you have a 200-day lag versus the 50-day lag. But we're assuming here if the 50-day lag is picking up and crossing over to 200-day moving average, then the stock is probably taken off and it's probably a good buy signal, right? It's a good buy signal for us to get into this thing. So let me go ahead and refresh the next cell here. So we have the month and the year. We are going to convert or roll these up into monthly and yearly frequencies, so we can look at the actual return based on the month and the year for each of these stocks. So if you look here, the first one is, what is this, Apple? Okay, so we have the daily returns, and you can see that here. If you want the daily returns, you can just comment that I'll actually have the daily returns and the monthly. I want to just focus on just the big picture here, so I'm going to leave the comment in. If you want to see those, by all means, you can just undo that comment just to leave it there, right? So here we have the Apple daily returns. It says daily. It's actually like yearly. You can see it. It's pretty clear. It's yearly. And then the cumulative return is 66.56%. And remember, going back 2 years in time, this was 24 months, right? And you can change this to be whatever you want. If you want this 3 years, 4 years, 5 years, to have a 200-day moving average, you have to have at least 200 days or 201 days of trading activity, right? And the market, I think there's 252. You subtract out all the Saturdays and Sundays, and I think there's 11 days for holidays. You have Christmas, New Year's, what else? 4th of July, Thanksgiving. What else? There's 11. There's a few others I'm missing. Whatever. There's 11 days plus all the Saturdays and Sundays. So you have about 252 trading days in a year. So you would have to pick, if you want at least a year of data, at least 252. And for the 200-day moving average, you need at least 200 days, right? You can't calculate this if you have just 2 or 3 months, right? It doesn't make any sense. So we want to go a little bit long term and get better historical volatility of all these stocks, right? And understand how the stock price is going to move over time. We don't really want to focus on the short term analysis in this scenario. Now, in other scenarios, you might want, let's just look at 3 months or 6 months or something like that. But in this is a little bit longer perspective, right? We want a longer term historical type of fetch when we go and get all these data points from the Yahoo API, right? So that's what this is doing. Hopefully that makes sense. So here's Microsoft. It's up 64% in that 24-month time window that we're looking at. Amazon's up 126%. JP Morgan is up almost exactly 100%. Walmart is up 102, so on and so forth. So we have the cumulative year only down here, sorted in descending order. So 126, Amazon outperformed the pack here compared to all the others. And then Nike came in as the worst, right? And this was the second worst. Dow, and then BA, I think, is Boeing. That is 13% down in the last 2 years. So if you invested your money in Amazon, 2 years ago from now, because I'm going back 2 years from today, then you'd have 126% return and so on and so forth. And if you put it on tonight, good luck. I think you can make better decisions than that if you start to invest in this tool or spend some time with this tool that I'm giving to you and understand that better. So let's move on now. Okay, we're creating buy and sell signals over here. That's the next step. So let me refresh that. Okay, and I'm trying to look at rolling signal 2 to say is the rolling last 3 days. So I'm going 3 days back in time greater than negative 5%. So I want, if I'm going to invest in stock, I want it to be rolling up and positive. If the trend is going down more than 5%, I don't want to look at these stocks, right? So I'm going to try to add a simple filter and some basic logic to help me go ahead and understand which stocks potentially on a rolling basis are the best ones to get into here. So now I'm going to create my buy and sell signals and look back 2 years in time for all of these stocks. Okay, and here's the chart. When I refresh it, we'll see the chart pop up here. So this is Apple. Doesn't go in any particular order, I think. Actually, let me look at that. Does it go in any order, or is it just go in alpha order? Up here. Oh, Apple's the first one that came in, right? And then Microsoft after that. So that's the order it's going in. So you can reset this to be in alphabetical order or the order of the top performer. I think we saw Amazon was the top performer, right, for the past 2 years. So you can set that. I'm just picking this in the order that the tickers are coming in. So that's it. And then again, like if you zoom in here, here's your chart. You have the confidence interval on the upside and on the downside, right? So this is what Apple. So Apple is a little bit volatile, but overall pretty much up. And if we go back and look at the historical performance here, this was up 66% in the last 2 years. So that was a good one. Microsoft is up. You can see that. So all these charts are printed out for you right here. Let me refresh that view. There's one thing I want to draw your attention to, and by far, a lot of these stocks are up, and this is a good investing strategy. If you look at all the buys and sells, it should work for you. But I can't swear by this, okay? And I can't guarantee that any of this stuff is going to work. So don't get mad at me. Don't try to sue me or whatever if it doesn't work. All I'm doing is showing you this strategy and the logic behind it, okay? I'm not saying like this is going to work and you're become a mega millionaire next week if you invest in this tomorrow, right? Like, it doesn't work like that, and there's no guarantees in the stock market, so just be aware of that. But you can see these signals here. So this is a small downturn. There's a sell signal. This is up, so it's a buy signal, up, up. This is down, this is down. So here's a buy signal here, 194. The next day it goes up to 207. So that is definitely a good signal. However, sometimes you'll see a buy signal here, and then it goes down the next day, right? So January 22, we had a buy signal 210. Then the next day it went down to 207. So you lost $3 per share. So there's no guarantee you're going to make money with these, right? It's looking at long-term up and down buy signals, sell signals. Is the stock moving up over time? And you're going to get buy signals, but you can have a reverse like we just saw here. And there's a big one I noticed down here, Nike. So this is something that you really can't protect yourself against. Where is it? Here's Nike. Okay. So, right, the strategy is not perfect, and you can make a mistake. You can lose money with this, right? But by and large, you should make money. But you have some scenarios like this. December 21st, the stock was trading at 120, and there's a buy signal generated because the day before it was down, but then it was up, right? So December 20th down, up on the 21st. That's a buy signal. However, the next day it goes from 120 down to 106. Oh, come on, we've just lost $14 per share, but there's no way that this model is going to predict that the stock is going to depreciate $14, right? And the market doesn't know that. There was some bad news that came out probably, or there's some automated selling activity that was triggered maybe by some bots, trading bots that control the market sometimes. And there's high frequency traders. They could see a signal or a trigger that causes them to sell a whole bunch of stock quickly, and that could trigger a sell-off, right? So we can go from 120 per share down to 106 the next day, even when there is a buy signal on this model, okay? So just be aware of that. These things aren't perfect. But again, that's why we have diversification, right? That's why you'll buy not only Nike, but you'll buy Walmart, you'll buy, what else? Microsoft, Amazon, you'll buy a bunch of different stocks in your portfolio. So if Nike tanks on you and it does go down, what do we see over here? 30% or whatever this thing was. If Nike is down 34%, through your diversification, you should have other stocks in your portfolio, like these right here, that are going to offset the losses, right? So if you bought all of these Dow 30 components, you can see most of these are up easily. Most of these up. We had 1, 2, 3, 4, 5. Only 5 of the 30 were down, so 25 are up. So if you had the equal weighting among all these 30 stocks in the last 2 years, you're guaranteed to make money, right? But again, that comes from diversification, and that is one of the best strategies that you can engage in. So this strategy that I'm showing you down here is showing you all the ups and downs, all the buys and sells, right? But really, diversification is the best strategy that you can engage in to help protect yourself from these downs and some of these stocks that inevitably will happen. You will have Nikes in your portfolio, you will have losses, right? But hopefully, if you diversify, you'll have way more winners than losers, and you should have a profit at the end of the year, this year, next year, and the year after that, and so on and so forth, right? That's the goal. And if you do dollar cost averaging, so you put the same amount into all these stocks in equal weights, so as the stock goes up more and more and more, you put in the same amount, $1,000 per paycheck, if you're investing through your payroll department or whatever, or $500 or $2,000, whatever. If every investment period, 2 weeks, you get paid, and that amount comes right off the top, 1,000 or 500 or 2,000 or whatever you can handle, goes into the stock. As the stock gets more and more expensive, you buy fewer and fewer shares. As it gets less and less expensive, you buy more and more shares, right? You always put in the same amount. If the stock gets more expensive, you buy less of it. Gets less expensive, you buy more of it. So that's dollar cost averaging. And through diversification, you should be able to make a decent profit year after year and generate nice returns. But again, like this strategy I'm showing you here is showing you all the buys and sells, but you will have a few instances where it's recommending a buy signal right here, and then you have a huge sell the very next day, right? And then the sell signal triggers, but by then it's too late, right? You lost some money. So that is inevitable. You can't buy every single time. I mean, you can't win every single time. Sorry, misspoke. You can't win every single time, but you should have more winners and losers if you dollar cost average and if you diversify, right? And here you can see, here's a sell signal, sell, 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 sell. Then the market's up, then we have a buy signal, all right? So if you follow this strategy, most of the time you should be fine. The only case that you're going to be in trouble is when you have this buy signal and then there's a sell, another sell after that, right? So just be aware of that. And again, there's a way to really prevent that, except through dollar cost averaging and diversification. That's all we have, right? So we have to leverage what we have, and we have those two strategies that typically pay off unless the market is down, and everything is down consistently, and you have a market meltdown like we saw in 2008, the dot-com boom and bubble burst in 2000. There was a mortgage crisis in 2008, right? And what else? There was COVID, right? But that was very short. That was just like February and January of 2020, right? And by March, the market was already up, right? So that's kind of the exception to the rule. But if you're heavily invested and all sectors of the market down and everything is down, yeah, you're gonna lose money because everybody's losing money. But if you diversify in dollar cost average, that should help you in most instances, right? So just a couple more things in my notes here: back testing the strategy, refinement. That's what this strategy is looking at here. Adaptive learning. So we're using these AI agents to adaptively learn over time, right? And they're learning more and more as new information becomes available. That's all these buy and sell signals, right? Sentiment analysis. So that could come from news that we see coming out from Google, from Microsoft, MSNBC, I think is one. What else? All the big news outlets are going to have news and they're going to be reporting on it, right? So there's sentiment analysis that you can actually bake into your investment strategies. That's another thing to do. We didn't do that here, but that might be material for another video I can come up with sometime soon. Diversification, so I mentioned that, right? Diversification and portfolio optimization, and dollar cost averaging, right? Those are the things that we can leverage for consistent and persistent returns. Most of the times, there will still be exceptions, like the 2008 financial crisis, the dot-com boom and bust, COVID, the first couple months of 2020. But again, like long-term, if you have a long-term horizon, you should be immune to these short-term vagaries and variances and random movements. These are random movements in the market, right? So that's it, guys. So hopefully this was useful and helpful to you. I am going to wrap up my my analysis right here, and I'm going to save this HTML file, and I will upload that when I load the video later today, and I will look for you guys in the next video. So see you soon. Goodbye. Hey there, everyone. My name is Ryan Schul. Welcome to my channel. The camera is not working today, so I can't turn it on. I don't know what's going on with that thing, but I'll look into it. Anyways, it doesn't prevent me from getting the message out. In today's project, I want to talk about how to build a self-improving AI agent to trade stocks. Okay, we're going to use Python as always, and this is actually called reinforcement learning, and you can set up rewards and then punishments for this trading agent. Any kind of AI agent, you can set up rewards and punishments and tell the agent, okay, I need you to trade better and create a trading pattern for me, or show me how I should do my trading, all right? And 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 I want to make money over time, and I want the trading to get more efficient. And basically, I want the tool to improve by learning from the reward system that's fed into it. And if it makes a mistake, it gets punished, and it knows, okay, this is not how we do this. I made a mistake. I'm not going to repeat my mistake. So this is exactly how computers were trained to learn that game Go. I think it's called Go. I've never honestly played that, but it's the same technique between the same technique for training a computer how to learn to play chess, right? So I play chess a lot, and I like it. And I had to learn over time, so the computer has to learn the same way, right? You get a reward if you're winning, if you're improving, and making better chess moves, and the punishment is you lose the chess match if you don't set up your chess pieces strategically enough, right? So why would we do this for a trading algorithm? Basically, markets change over time. Nothing is stationary, right? It's completely not stationary. And traditional markets rely on fixed assumptions that can be static and stationary. I mean, the model or the assumption, we want something that's very dynamic and very interactive and gets better over time. Okay, so that's why we're using a reinforcement learning agent in this exercise. Markets can evolve due to new regulations, shifting technologies, macro events, shocks in the system. Right, there can be emotion built into a trade, right, where people fall in love with the stock. I will tell you personally, do not fall in love with the stock, because the stock will not love you back. No matter how much you love it, the stock has no emotion for you whatsoever. So don't do that, right? But it's hard. It's hard to remove your emotions when you're making trades, because there's a lot of money involved here, right? So it is hard to get away from that. But these types of AI agents have no emotion, right? So you're not caught up in that mess. So it's going to be self-improving over time. It's going to get better and better. We can do back testing and live learning. I didn't really get into that because I think this project would drag on. Maybe I could do another project related to that. But that's a pretty interesting topic. I think this can be scalable, and we can include multiple assets as well. Maybe that will be another video. This video is just going to include one and the S&P 500 for comparison. You always want some type of baseline to see how well your trading is compared to some type of standard, some type of baseline. The S&P 500 is excellent for that, right? If you make 2% return on your investment and the S&P is at 12%, if it's up 12%, your investment kind of sucks, right? If you make 2% return and the S&P is down 30%, your investment is fantastic, right? So you really need some kind of benchmark to measure against, because 2% or 10% is meaningless, right? Unless you gauge it with some type of benchmark. So we're going to use the S&P 500 for that. And this is just going to help us understand how to make overall better, more intelligent, smarter investments. So I'm going to go ahead and import the data here. I'm going to look at INTC. I think this is Intel. I don't even know. Let me see. What is this thing? INTC. I know it's down quite a bit for the year. Finance. And we'll look at a few different stocks. You can very easily trade, change, not trade. You can easily change, yeah, Intel, that's what I thought. You can easily change the stock that you are looking at, and you can easily change the time frame that you're analyzing too, right? So in this case, we're going back in time 12 months. We're getting 12 months of historical time series data. That's my start date. So back in time 12 months from today. And you can change this to be whatever you want. This can be 1 or 2 months. This could be a couple of years. 6 months is fine. I think for our purposes today. And just to illustrate how this works, I think 12 is good. So I've got my returns here. Okay, I'm going to scroll down to my next cell. So this is pretty important right here. We have to define the agent and then the state for these trades. So the state can be a price trend up or down, holding status 0, or no stock. Okay, so 1 is holding, 0 is no stock. And here's the action over here. So 0 is hold. Sorry, I just misspeak. 0 is hold, 1 is buy, and 2 is sell. So this is how we're going to tell the agent, because it doesn't know what a hold or buy or sell is, right? You have to assign some type of numeric representation to the action, and then the agent can learn from that. If you tell it to buy or hold or sell, it has no idea what that is, right? So we're assigning actions over here. We're going to start with 0. So this agent actually learns very much like a human being. When you start trading, you basically don't know anything, okay? Let's be honest. When you do it for the first time, you don't know anything, and this AI agent doesn't know anything either. So we'll start at 0, but you should, if you're an effective trader and if you're successful, you should get better with time, and you will have some type of accumulated knowledge, what works, what doesn't work, or what probably works or probably doesn't work, right? But you always start basically at 0. So the agent will start at 0 too. Hopefully you make more and more intelligent decisions over time, and hopefully this agent does as well. Okay, so that is the setup here, and we're using this Q table um, to hold all our data here. Okay, so let me hit Control Enter to refresh this cell, and then we get down to the learning and the trading loop. So we have alpha, gamma, epsilon episodes, and the initial cash is going to be 10,000. These are Greek, so you don't have to worry about this too much. Just alpha is how much the stock is up relative to, I'm sorry, no, alpha. Yeah, alpha. I got confused for a sec. Alpha, you want this to be positive, right? You want positive alpha stock. That means that you're making more money, and you'll probably lose a little bit along the way. That's almost inevitable. Nobody just makes money all the time, but you want positive alpha, right? You want like a positive outcome with your portfolio. Again, starting with 10,000 initial investment. Let me go ahead and run this. Okay, and then we have some basic logic over here. We're looping through all the returns. Remember, the returns came from over here. These are the stock returns. So we're training the agent on the actual ups and downs and movements of this Intel stock price. So that's pretty straightforward. Probably the most interesting thing is down here. If action equals 1 and shares equals 0, then we're buying the stock, okay? And we're assigning or using cash to make the purchase for those shares, right? If action equals 2 and shares greater than 0, sell. So remember, these actions came from over here. So we have 0 is hold, 1 is buy, and 2 is sell. So that's what we assign those um, pieces of logic, and we're using that. So if we have a 1, we're buying. If the action is 2, sell, and then the other side is just hold, right? So if nothing warrants a buy or sell, the agent is just holding on to the shares that it has. It's not taking any action, because if it looks like the stock is going down, it's going to do a sell. If it looks like the stock is going up, then it's going to do a buy, right? But there's another option too, just hold. If you're not sure what the heck is going to happen, just hold your position and just do nothing. That's fine too, okay? So I'm going to go ahead and refresh this cell. Okay, now we start to generate the actual transactions. Oh, this is all hidden. I'll show you in just a moment how you can see all the trades, but this is all hidden away as the agent just does the transactions, and we actually converted 10,000 into $7,118. So we lost almost 3,000. And there's really nothing that we could do about that. If we go back in time, you'll see that the stock was just down from 1 year ago. So it's down 44%. We lost about 30% of the portfolio. So even though the stock is down, we basically lost $3,000. Because the agent was smart enough, it actually did better than just the buy and hold strategy. Because here we're down 44%. Let me pick a stock that is probably up, AAPL. Let's see if this guy was up for the past year. We can look at this. 1 year. Okay, so this was up about 17%. You can see when you put the mouse over it, the bubble is up 17%. So that's okay return, not huge. Okay, though. But let's come back to that in a minute. Let's look at all the trades. This is for Intel here. So control enter. So these are all the individual details of all the trades. It's buying and selling. And it bought 54 shares at 118.32, sold 54 at 177. The stock looks like it's going down. So it's getting rid of these shares. It's unloading that. 53, it bought shares at 179. It looks like it's going up. I think the agent is doing exactly what it's supposed to do. And it's selling 53 shares at 179.62. I guess the agent thought there would be a drop, but it's up just a couple of pennies. That's fine. That's fine. Go down here, and I have some more notes over here. I can let you guys read out. That take you through everything. Again, this is reinforcement learning, and they don't start out smart, right? So it's learning everything just like a human being does. That's why we have to start with 0, because we have basically, where's my 0 here? I don't see that. Where is it? I don't even see that, but like so it's somewhere in the logic, I did set the learning rate to 0 because initially that you don't know what's going on, right? The agent has to learn what's right and what's wrong, and then make decisions about whether to buy or sell, just like a human would do. So at the beginning, it can make some mistakes. It can trip up. Hopefully, towards the end, it's making very few mistakes and mostly intelligent trading decisions. But at the beginning, it's always going to be a learning process, and there's nothing we can do about that, right? So it is what it is, and this is pretty normal and pretty realistic, right? For the agent to lose if it hasn't had enough time to self-improve. So it does take a little time for the agent to get going and to understand what's going on in this environment, but over time, it should be more efficient, self-improving, and making better and better, more intelligent trades over time. Okay, so I have some things listed in my notes down there, and in the end, stock prices aren't totally random, but in the short term, they are very random, right? But in the long term, they're much more predictable. Now, how predictable? It really depends. It's not completely predictable, but in a longer time continuum, the price will be much more predictable than within a couple of days, right? It's just too short. It's just too short time span. So here's the historical S&P 500 plotted on this chart, and then I compare the two at the end. So we have Intel versus S&P 500. Remember, I always told you you need some type of baseline to compare this to. So if you just saw Intel all by itself, yeah, it looks pretty ugly. It doesn't look like a great play over here. That's pretty obvious. But let's look at Apple. So this is a totally different example. It looks like Apple was up about 17%, if I saw that right. So if we go to Apple AAPL, control enter. Okay, so we have our returns. I'm going to fire up the agent here. Okay, defining strategies. Okay, here's the training. And we evaluate all our policies right here. Now we started with 10,000, right? So 10K. Now in this case, we're at 4,000. So we made 4 grand, a little bit more, almost 4,600. Okay, so this stock obviously was better. And here's all the exact trades that the agent did. Okay, so we have that. Let's go down and get the S&P 500. I already plotted that. I don't have to redo that. But I want to look at these two side by side. All right, so I have my baseline, and I have my actual Apple. And, oh, because I didn't refresh this thing. I have Intel and Apple mixed together. Okay, that should be a little bit better. Let me see. And it's complaining data closed. None of the indexes are in the column. That sounds weird. Let me rerun the whole thing. Okay, run all above selected cell. Okay, get this thing to work. Close should definitely be in the column. They just did that. Control enter. Yeah, there it is. Okay. Wackadoodle, guys. Okay, so you can see here, S&P 500 and Apple. There's a big dip. This is when the trade tariffs were announced. This was about 2 weeks ago, right? So it impacted the S&P, it impacted Apple. They have both since bounced back a little bit. But I like this comparison because you can see Apple was up pretty strong over most of the last year. They kind of like coincided a little bit during the trade tariff announcements, right? But Apple is still a better investment than the broader index. And you can see the total return here was about 4 grand, 4.5 thousand. Okay, so that was good. Let's look at one more. Maybe Amazon. Let's see what Amazon is doing. AMZN, AMZN. And let me go down here to the bottom and refresh everything. And we'll compare Amazon with our AI self-learning, self-improving agent to the S&P, run all above. Okay. So let's see what this thing spits out here. Okay. And we have our final results. And okay, so Amazon and the S&P were kind of neck and neck for a little while. The Amazon stock basically got beat by the S&P, I would say. How much money did we make on this thing? The agent made $500. Okay, so not a whole lot. A couple of dollars. You have a little walking around money for the weekend, but not a huge return. But that's it. That's it, guys. How to build a self-improving AI agent to trade stocks. And you have all the details of all the trades revealed to you right here. Okay, so I think that's pretty cool. That's pretty cool stuff. Okay, and the last thing I'll say is this is not investment advice. So if you want to use this to make money, that's totally fine. Don't get angry at me. Don't try to sue me. If you lose, I don't even have a job right now. I lost my job about 18 months ago. That's why I moved over to YouTube. I'm doing YouTube videos, so I have no money. And this is not trading advice in the market. It's a volatile place, okay? You can make money, you can lose money. All I'm doing here is demonstrating the math and the statistics behind AI agents and how to use them to do trades. That's all it is, okay? It's not investment advice. So there you have it. Hopefully this was informative and a good use of everybody's time. I learned a couple new things when I was putting together the script, so I'm grateful for that. Okay, I'm going to wrap it up and I'll see you guys in the next video. Goodbye. Hey there, everyone. Ryan Schul here. Welcome to my data science channel. In the project today, I want to talk about the economics of trading stocks and all the implications of doing trades. Okay, so the economics of stock trading is somewhat convoluted. It's not too bad. I'll take you through it. But it's very interesting too. And you can think to yourself, okay, I can figure this out. I can get a handle on this, and you can do some pretty efficient trades and make some good money. But there's always things that are trying to erode the capital that you generate from your trades, right? There's commissions, there's different buy-sell prices. They're called bids and asks, right? There's slippage with the bid and ask. There's capital gains tax when you make money, right? You can offset that with capital losses too. So that's nice that the government gives you that kind of opportunity. There's fixed trading size or percent of capital that you're trading, right? That could impact your overall profits. Taxes impact real profitability. Okay, if you make more money, you pay more taxes, right? So it's not just let's go do these trades and be profitable. There's a lot more to it than that. Okay, there's risk-adjusted performance. That's very important to consider. Avoid over trading with emotional decisions. You definitely don't want to fall in love with a stock, because I can guarantee the stock will never love you back. That is a mathematical certainty. It also helps set realistic expectations and prevents strategy decay, at least to some extent. Okay, the strategy could start to decay over a period of time. You could have a strategy that works pretty well for you now. Maybe in a few months it's not working anymore. Okay, so you have to be aware of that, and that can drag down your overall profits and returns. Okay, so I'm going to go ahead and import some data from Yahoo Finance. I'm going back in time about 36 months here. So 36 months relative to today. So we have the current date. The start is going to be current date time, that's today, and end is daytime now. That's what I'm getting, the daytime now, right? And subtracting out the time delta right here, okay? So we have the start and the end, and we're going to plug that in right here. So here's start and here's end, okay? So that is the data frame. So when I hit Control Enter, I get a total of 753 rows. That equates to 36 months of historical stock prices and one price. This is the S&P 500. Okay, so this is what we're going to look at to do the trades. No specific stock per se. We're just looking at the index. All right. So I want to go ahead and get the rolling window for 5 days and for 10 days. So I'm getting a moving average of 5 days, moving average of 10 days, just so we can see, is the trend up, is it down, is it sideways, what is this thing doing? Okay, so let me hit Control Enter. Okay, we have our MAs set up. Now we can move on to back testing the strategy, right? So I'm going to loop through all the records here from 1 into the length of the data frame. So the data frame you just saw over here was 753 rows, right? So we're going to loop 753 times. And we're going to go through all the moving average 5 days, moving average 10 days, okay? And we're going to say, this is a pretty simple trading strategy. I have a bunch of strategies on my YouTube channel, so if you want to check those out, just search for that. This one is pretty simple, right? If the moving average 5 day is greater than the 10 day, and the moving average is less than or equal to the 10-day average, then we're going to go long, okay? So the moving average looks like it's increasing, right? The short-term moving average looks like it's increasing. The long-term is decreasing. Otherwise, if positions equal long and moving average is less than the 10-day, then we don't enter into this trade, right? So if the moving average looks like it's going up, the 5 days greater than the 10, the stock is taking off, right? And it's starting to pop. So we're going to get into the position. Otherwise, we do nothing. We look for the percentage return here, which is current price minus the entry price, divided by the entry price, right? So it's always like end minus begin, divide by end, or current minus start, divided by start, right? So that is going to give us our capital over time. We are appending this into this list right here, okay? And then we will convert the list into a data frame. So let me go ahead and run this. So very simple trading strategy, looking at moving averages for 5 days and for 10 days. And then when that's done, I'm going to go ahead and plot the chart. Okay, and if you look careful, I'm using DF as the data frame. So DF goes into this plotly chart. X is the DF index. So the index is going to be the date. Y is the capital. This is on the y-axis is the vertical axis. That is the total profits. You can see we started with 100,000, kind of dip down here. We had that down to 90. Then the strategy starts to pick up some steam. It's coming back. We're getting up to 100, a little over 100 here. Okay, now it's starting to pay off for us. Okay, and we're getting better and better performance over time, ending at 129,000. So on 100,000 investment, we made about 29, almost 30. So 30% return. Okay, but if you look close, there's no accounting for taxes or for for bid-ask pricing, for commissions, charges, things like this. But these are real-world items that we are accountable for. We have to pay the taxes. We have to pay the commissions. Now, you could have a commission-free trade. Sometimes brokers offer that, and they'll basically take the cash that's sitting in your account if it's not fully invested and lend that out to their customers in forms of margin, maybe even to other financial borrowers, maybe other institutions. I don't know what kind of agreements or contracts they have, but at least for margin, they could lend out that money, right? So if you give them more money, they'll gladly take that, but they're going to lend that at a higher rate than you could earn at a bank, right? That's how they make that's how they make their profits. So let's see, I ran that. So we had a $30,000 profit on $100,000 investment. So not too bad. But again, there's no slippage costs, there's no transactions costs, there's no fees for trading fees, commissions fees. There's no taxes baked into this. Okay, so let's make it a little bit more realistic and add in some commission fees, right? Flat fee per trade, slippage percentage, okay, capital gains tax, 0.15. Now that's long-term. If you do a lot of short-term trading, it's going to be higher. I forgot what it is exactly right now, maybe 25% for short-terms capital gain tax and 15 for long-term. But you can just change these numbers to be whatever you want right here, okay? And then annual drag rate is 0.01. So this is the basically the inflation drag. So we start with 100,000, no positions initially, entry price is 0, capital over time is the name of the list that I'm creating and I'm appending to. So if you see down here, capital over time append, float capital. Okay, so it does a couple things in between here. Looking at daily drag for IN range Length data frame, that's what we saw before. So it's like 735 or something. What did I say? Yeah, 753. Okay, so we do 753 loops. Okay, and then we set the moving average 5-day, moving average 10-day. And again, similar strategy to before. If the moving average is increasing greater than the 10-day moving average, we're expecting the stock to take off. It's starting to pop. Otherwise, if the moving average 5-day is less than the 10-day moving average, then we're going to sell this, right? We get our exit price, which is current price, times 1 minus the slippage, right? We have to count for the slippage before, when we're looking at these examples over here. Oh, there's no slippage over here. Oh, okay. So just to make this a little bit more realistic, I'm adding in these extra like little gotchas, right? Like the commissions, the slippage, things like this. Oh, so we have the tax rate, the capital and position equals none. So we're appending everything to a list and then converting that list into a data frame. Let me go ahead and run it. Control Enter to run. And let me plot the results. Okay, so accounting for most of these main items now here that are going to drag down the overall return on the portfolio. We've accounted for a lot of these, not every single one, okay, but most of them. So now we start with 100,000. Again, dips down a little bit, but then starts to come back. So we're doing good. We're doing good. We're back to break even. Now we have a profit, 115K, and we end at just about 112, right? So all those commissions, transactions, costs, taxes actually took a big chunk out of our profits. Before we had the 30% return. Now, in this much more realistic scenario, this is more real world, we only have a 12% return, right? We really got 30, but what goes into our pocket, it's only 12%. So actually a little bit more. So 15 would be half of 30. So we're actually paying more than half of our capital gains back to cover all the costs from the commission and the slippage, bid-ask spreads and things like that, really. So that's kind of a big hit to the portfolio, right? You're getting actually less than half, but you do have to account for these things, right? And this is much more realistic. So let me just take you through a couple more things. These are some basic financial metrics that we look at whenever we're doing trades. The Sharpe ratio is the actual return minus the risk-free rate divided by the standard deviation. You can see that right here. Okay, and we're calculating all of these returns right here. Here's the mean, here's the standard deviation. So pretty simple. I love how Python is so efficient and so elegant. All you need is one line of code to get the mean return for the whole portfolio. All you need is one line of code to get the standard deviation for the portfolio, right? And the risk-free rate, I think I'm setting that to 0 right here. It's pretty low. I don't think there's like really risk-free rate of 0, but for our purposes here, I think it's okay. So I could change that to point. What would it be? 1.02. Maybe that's a little bit more accurate. Okay. Wait, it didn't like that at all because that went negative. 0.002. Is that it? Oh, and then I have to annualize it. Okay, probably like this. Okay. That's negative again. Let me leave this at 0 right now because something looks a little bit off, but it is going to be pretty low rate, right? Probably close to 1%, 1/2 of 1%, even 0%. I think is okay in this case. So we have our Sharpe ratio analyzed. Here, the maximum drawdown is the percent drop from the peak to the current value of the portfolio. Okay, this is always good to be negative unless you never had any drawdowns whatsoever. That's pretty rare. Standard deviation is the volatility of the standard deviation of the portfolio, right? So there's a standard deviation. You divide by, or you multiply by 252 because it's 252 trading days in the year. Remember, the year obviously has 365 days. I think we can all agree on that. But the market is closed every Saturday, every Sunday, and then I believe there's 11 holidays. So you'll have January 1st, the market's closed. December 25th, the market's closed. Labor Day, Memorial Day, Thanksgiving, you get the picture, right? So there's about 11 trading days. So if you take 365, subtract out 52 times 2 for every Saturday and every Sunday and add 11 to that, you should get to 252. So let's go ahead and print this result right here. We see that the Sharpe ratio is 0.44. Maximum drawdown is 11.2%. So we lost 11.2% at the max. That's not too bad for a portfolio. Some lose way more than that. the mathematics get very interesting too. So the more you lose, the more difficult it is to recover. So if you have a stock you bought it for $100 and it goes down by half to 50, just to break even, to get from 50 back to 100, you have to go up 100%. Okay. So how many among us are making 100% in the stock market on a regular basis? I don't know too many, right? So the key is not to lose a whole lot of money in the stock market, because everything you lose has to go back double just to break even, right? So that's going to be hard to do. And um, not everything goes 100%, but the more you go down, the more you have to come up, right? If you go down 10% to get back to break even, I think it's like 11% or 12%, whatever. But if you lose 50%, it's another 100% to get back just to where you were before the loss. Okay, so it really takes a toll. The goal is to not incur too many losses, but almost inevitably you will have some loss, right? So this is a good start. There's other things we could do to take this a little bit further. Bid-ask spreads, inflation. We didn't account for inflation. Leverage, right? We can lever up and trade more money. And if we borrow money from the broker, right, they're going to charge us an interest rate on those loans that they're lending us the money for. But if you just invest half of your money and the other half is the broker's money, and you make that your return, you're really just paying off the broker a small percent for interest rate for that loan, but your initial investment was just half, right? So your return is almost going to be double. But then if the market moves against you, or somehow you get whipsawed, it goes down, you sell, and then the market comes back and you get left behind, that's going to be difficult to deal with too, and to absorb those losses. So leverage can be a very good friend, or it can be a horrible enemy. So you have to be careful with these things. And margin call too. If the stock goes down to a certain amount, the margin will be called back and the broker will automatically sell your trades and claw back all that money, okay? Because they don't want to suffer major losses, right? Like maybe you will say, okay, I'm just going to gamble it away and wait for everything to come back magically. Well, the broker's not going to let that happen, right? If it goes down a certain threshold, there's going to be a margin call and they liquidate and they dump everything, and then you have to eat that loss. And that's very painful. I've had that happen to me. Okay, that's it, guys. So I just wanted to take you through the economics of trading stocks. We're using Python for everything. I am going to save this Jupyter notebook. I will export the code and I will share everything with you guys when I drop this video a little bit later today. Thank you so much for your time. I appreciate it. Thanks for sticking with me to the end. I'm going to wrap it up here and I'll see you soon in the next video. Bye. All right, everyone. And the topic today, I want to talk about bond valuation and determine if a bond is fairly valued, or is it overvalued, or is it undervalued. If it's undervalued, we can go into the market, buy the bond today, hold it until it appreciates at its maturity date, and make a decent return on our investment. If it's overvalued, we wouldn't touch it, right? It's too expensive. It makes no sense to invest in this type of security, right? So that's what we're going to take a look at today. Pretty straightforward, pretty simple type of analysis. So stick with me to the end. I think this video is going to be kind of short. And if you know just a little bit about bonds, or know nothing about bonds, I think you're going to get a lot out of this. If you're a bond expert, you've been doing this stuff for the past 2 decades, I don't think you're going to learn a whole ton here. But anyway, let's proceed, and hopefully we can drop some knowledge and help to educate a couple of people out there. Okay, so bond valuation is basically done to help us understand the present value of future cash flows. These are coupon payments that the bond pays. These are guaranteed coupon payments, unless the bond, well, if it matures, you're not going to get any more payments, right, at maturity date, or if it's called away. Some bonds are callable, especially mortgage or corporates that have call features, they could be called away. But typically, you would get all those cash flows until the bond matures, right? And then you would get your principal back at the maturity date. So this is how it works. Basically, if you spend $1,000 on a bond that pays 5% interest, you would get $50 per year, or maybe 2 coupon payments every 6 months of $25 each until the maturity date. And that could be 10 years, 15, 20, whatever the maturity date is. And at the maturity date, you would get your $1,000 principal back. So it's a pretty good deal, actually. So you'd pay $1,000 today, get $1,000 when the bond matures, whatever date that is in the future. 10, 15, 20 years, could be 30 years, could be more. And then you would get the coupon payments every year, every 6 months. Semi-annual is pretty common. Maybe quarterly. I've seen that before. That's somewhat less common. But it's a pretty good deal. You invest the money today, you get all your money back in the future. Now, in the future, your money's probably going to be worth less due to a few factors. Inflation, right? A dollar today is worth more than a dollar a year from now because you can invest that money and make a capital return on that investment, right? And risk too. Like if you um, invest your money, you should be rewarded with some type of return, but there's always a risk to everything. You could lose some money too, right? So there's a few reasons why the time value of money is important and why money today in your hand today is worth more than money in the future. Okay, so TVM, time value of money, is abbreviated TVM, and it helps us understand this concept. And then again, the coupons are the periodic interest payments that the bond issuer makes to the bond holder. So yourself and myself as individuals or corporations could be bond holders, and the issuer could be a bunch of different entities. It could be a corporation, Microsoft, Apple, any kind of publicly traded security. I don't think Microsoft has any debt right now. Some companies don't if they're cash rich. I think Amazon has no debt. I could be wrong. Microsoft, I think, has none. Apple does. We're going to look at an example of Apple in a couple of minutes. And face value, the principal, is typically $1,000. That's very common. If you see something other than $1,000, that's pretty unusual. And obviously, like that would be explained to you as the bond investor before you invest in that, right? But typically, it's going to be $1,000. There's only a handful of exceptions. So this was my data source. I've never used this thing before. Yesterday, I just discovered it yesterday. So let me show you how it works. So if we go over here and go to issuer name, I have some notes over here too. So issuer name equals Apple, up with that, and show results. Okay, you can just type it in here, show results. And we have our results. Now I am looking at a maturity date. This is our matured 2023, 2029. That was 6 years ago. I want a maturity date that hasn't matured yet, right? Okay, so these bonds are basically gone. I'm looking a couple years out. It's 2025 now. I want something about 5 years out. And let me get something that rounds off nicely. I'll get 820, 2030. See that right there where my mouse is? 820, 2030. So it's about 5.5 years away from today. I think that's just a good place to start. This is totally random, guys. I'm just trying to introduce you to the topic. So we have the features of the bond here. Coupon rate, 1.25%. Maturity date, last trade price, last trade yield, last trade date. That was yesterday. Okay, so this bond is traded yesterday. Is it callable? Yes. So Apple issued this bond. They can call it back if a certain specific condition is met. I don't think they can call it at any time. I worked with these bonds years ago, but I forgot not all the nuances, but some of these nuances. I think a certain condition has to be met for the bond to be callable. They can't just call it at any given time willy-nilly. And then the next call date, oh, there it is. Okay, so in 5 years, it can be called, but between then and now, they cannot call back the bond. If it's called, it's basically redeemed by the issuer. So go back to Apple, and they would pay you whatever coupon payments are remaining at that point in time, and then you get the principal. You just get the principal back earlier, and you would miss out on some coupon payments along the way. That's all that means. Okay, so I selected that bond just to get some basic information to feed into the model and to run it. So the face value is $1,000 almost without exception. We got this from the website, 1.25. The coupon payment is face times coupon, pretty simple. The yield, 4.633. Look at here, 4.637. You know, I actually got this yesterday. I think it changed just a little bit overnight. That's fine. So 4.637. I'll update that thing. Okay. I did this yesterday. And that's 0.04, 0.04, let's just call it 4.6, okay? Because this is going to change every single day. So yield to maturity is 5.5. We know that. That's maturity date in mid 2030, and the last trade price was 83.43. 83.42. Okay, I got this data yesterday. I was tired at the end of the day, so I didn't make the video until today, the next morning. So it changed just a bit, 43.42. And by the way, if you see my other videos, I always try to make these very dynamic. So You just click the cell and run it, and it actually imports all the data from the website. That's called screen scraping. But when I tried to do this yesterday, I was getting some weird results from this FINRA website, and I couldn't quite figure it out. Normally, I'm good at these things. I tried about 9 or 10 different approaches to getting this data imported dynamically, but I couldn't really do it. But I think it's fine. This is not a demo on screen scraping. I have several demos on how to do screen scraping on my channel. I put out a bunch of videos about that, so you can check that out. In this case, I don't think it's pertinent. All we're doing is understanding the value of the bond, and is it fairly valued, is it overvalued or undervalued? That's the point here. So if we can make it dynamically screen scrape, yeah, that's a bonus. That's the cherry on top. But I looked at it yesterday, spent a little effort, put in some labor, couldn't get it going, but that's fine. The point of this video is to analyze the inherent or intrinsic value of the bond. That's all we're doing here. So let me hit Control Enter, run it. You got my water. Okay, so the intrinsic value is $833.99. Okay, and the last trade price was $83.42. So what's going on here? There seems to be a big discrepancy between what the bond is trading at and the actual intrinsic value of the bond, right? So when it's redeemed, it's going to be worth $1,000. Okay, and we're about 5.5 years away. So this bond is trading at a deep discount, $83. It's actually like almost ripe for a 1,000% gain and value there, which sounds like a phenomenal deal, right? But remember, the bond is only paying 1.25%. So if you invest the money, you're only going to get $12.50 per year. That's not a whole lot of money, right? But again, that's a pretty good return, all things considered. You buy this bond for 83 bucks, you get 1.25% interest every year for the next 5.5 years. It probably pays semi-annual. I don't think the bond actually specified. We would need more data because I don't see it in here. Okay, and here's the rating. So it's a AAA. It's issued by Apple, right? They're not going out of business. They can pretty much guarantee that. So it's actually a very good deal. You're buying this bond at a deep, deep, deep discount. It's not paying a whole lot of interest, but it's going to appreciate from $83 to $833. But actually, at the maturity date, it should be $1,000. So if you invest $83 today and you get back $1,000 in 5 years, that's a hell of a deal. It's probably a better deal than you're going to get in the stock market. You do have to wait 5.5 years. Okay, so there's a cost of doing business here. You have to sit tight and wait 5.5 years. But if you could do that, the payoff is pretty huge. Okay, so the code calculates the intrinsic value of the bond, taking into account all the discounting and all that jazz, right? All the data comes from the link that I showed you. Okay, we tried to import it dynamically. It didn't really work. And after a while, I gave up because the point of the video is not to import bond data, but to calculate the intrinsic value of the bond and compare it to the market price of the bond. Now, if you buy it today, the price will appreciate. Like I told you, the total gain is about 916.57. And if you take this 1,000 minus 83, that is your total gain, right? So again, I don't want to belabor the issue here, but if you invest $83, you make $916. So that's pretty good bang for your buck. There's no question about it. I mean, like after I did the analysis yesterday, I'm seriously considering buying some of these Apple bonds and sitting tight for 5 years. And then you can calculate the total return would be about 1,092%. Again, this is slightly different because I did the analysis yesterday. Now it's 83.42. It only changed 1 penny. It's not a big deal, right? So again, the coupon rate, but let's calculate the yield to maturity because this actually is the total gain that you would get, 1,092% in the stock market. That's a phenomenal return if you're getting that. That's great. But again, we have to annualize this. Like I said before, this is not 1 day, 1 week, or 1 month. This is 1 year. So we want to understand the yield to maturity, and this calculation will help us with that. So the yield to maturity is actually 64% per year. So again, still a heck of a deal. This is a heck of a good deal. I think when I finish the video, I'm going to go out and buy some of these Apple bonds because the payoff is pretty huge. Okay, so let us go ahead and plot this. I always like to say a picture is worth 1,000 words, right? If you illustrate the point here of what the code is doing, we can see clearly the intrinsic value is $833.99. Last trade price is $83.42. So this bond is seriously, seriously undervalued. This is a fantastic investment right here, okay? So just to wrap it up, why do we do all this? We want to understand market price versus intrinsic value. We accomplished that, okay? Risk return characteristics, okay? Investment strategy, investment decision making, okay? Mission accomplished there. Bond price sensitivity relative to interest rates. As interest rates increase, bond prices will decrease simply because a bond that's outstanding now will be paying the market rate of interest, whatever that is. If interest rates go up, bond prices have to go down because now new bonds are being issued are being issued at a higher interest rate because the market rate is higher. Like you've seen this after COVID, the Fed raised interest rates significantly from, I don't even know, mortgage rates. I think were about 2.8 before COVID. Now it's like 7.5 to 8% for a mortgage, depending where you live in the United States. And in other countries, it's going to be vastly different, right? I'm just thinking about the US. So it went from about 2.8 or so to 7.5 to 8. So interest rates went up a lot. All bonds that were issued around COVID or before COVID have depreciated in price significantly. That's a given. And if interest rates go down, bond prices will go up because now, if interest rates are going down, new bonds that are being issued at the current interest rate are paying a lower coupon payment. This is less desirable for investors. So the price will have to depreciate to make that investment more appealing. Otherwise, nobody's going to touch it, right? Because if interest rates are going down, I'm sorry, I misspeak. If interest rates go down, bond prices go up. There's always an inverse relationship. Interest rates up, bond prices down. Interest rates down, bond prices up. So we saw that happen during immediately after COVID in the last couple of years. Interest rates went up, bond prices went down. Now, if Fed starts cutting rates because of the high inflation and trying to stimulate the economy, somewhat they could lower interest rates. Bonds that are existing today will appreciate in value because new bonds will be issued paying a lower interest rate. This is less desirable. So people are going to be more incentivized to buy the bonds that are paying higher interest rates that are issued previous to today, okay? And then to help us understand fixed income strategies. So that's pretty much it, guys. Hopefully you picked up a few nuggets of information there, trying to drop some knowledge on you guys. Hopefully that was beneficial, okay? I think I'll wrap it up here and I will post the video later today. Thank you so much for your time. Have a wonderful day. Bye. Hello, guys and girls. In the topic today, I will be discussing how to determine if a stock is fairly valued. So earlier today, I did a tutorial on how to determine if a bond is fairly valued. Is it valued fairly according to the current market price? Is it overvalued or is it undervalued? If it's undervalued, you probably want to buy it because you're going to make some money. If it's overvalued, you're not going to touch it because it's too expensive. If it's fairly valued, it's up to you. You might invest in it, you might not, but you want to buy something at a discount, right? You want to get a good deal on your investment. You don't want to pay too much. If you pay a premium, it's going to take a lot longer to get that investment recouped, and you may never get your money back, right? If you pay a huge premium for some type of security. So we want to research whether a stock is fairly valued based on its intrinsic value and its current market price. So we're going to compare these two things together side by side, and that's going to help us determine should we buy the stock or should we not buy the stock, okay? And there's several things we're going to look at, or several reasons why we want to do this type of exercise to identify undervalued stocks. Those are something that we were potentially interested in investing in. If the stock is overvalued, we're not going to touch it, okay? We want to maximize our investment returns, understand risk management. Let me add something here. It's one word, kind of a stickler here, but I think you get the point, whether that was there or not. Avoid market sentiment and speculation, right? You don't want to speculate on stocks. You're going to get burned, probably. Long-term investment strategies, valuation fundamentals, market investment, decision-based actions. Sorry, I'm in a room where you have to move around every few minutes, or the motion sensor thinks you're gone and it shuts off the light. It's just an energy savings technique. Market efficiency and arbitrage opportunities. and any kind of mergers and acquisitions, right? If you're in the M&A business or investment banking, you probably want to look at this stuff to help you understand, is the stock under or overvalued, and then assess industry and market trends. Okay, so we're going to fetch financial data from the web. And my other example with the bond data, I just copied and pasted it. It's very simple, very straightforward. In this case, it's quite a bit more sophisticated to analyze an equity, and you're going to see why in a minute. So I'm going to go ahead and make this very dynamic and fetch the data from the web. So we have updated data, and this is pretty cool because as the data changes over time, you can just rerun these cells. You don't have to manually make updates and copy and paste anything. You would just hit Control and Enter once you're in the cell. This is a cell in the Jupyter Notebook, and that will refresh the data pull from Yahoo Finance. Okay, so we're going to look at free cash flows, the growth rate of the institution or the enterprise. This is going to be a publicly traded company. The discount rate, this is how we're going to help us calculate the WACC, the weighted average cost of capital. So we want to understand the cost of capital. How much does it cost to do business? There's going to be a risk-free rate. There's going to be a risk premium. It's going to cost money to engage in this business, right? Nothing's for free. There's no free lunch here. So we have to understand the WACC and how much it's going to cost us to make these types of investments, right? And we are going to start with historical cash flows, okay? That really makes the most sense to get historical cash flows. So I put together this function yesterday. This gets Yahoo data from Yahoo API endpoint, and we're calling that stock data. We're going to try to do the fetch, the cash flows, the free cash flow data. We're looking for this when we pull in this data. Okay, if I do this, let me see if I can just show you an example here. If I put in an extra cell, is this going to work or not? I think so. Let me see. Just trying this now. I'm not sure. Import, yes, import, print. And there, print. I think that's what you need for this. Let me see if this works or not. No. FC cash flows. Oh, I think I see. Oh, I know. Ticker equals. You have to put the ticker in too, right? Starbucks. Is that using Starbucks down here? Oh yeah, Starbucks was the last one. Okay. You know, it doesn't even matter. We're going to get what we get here. So I was trying to do a one-off thing. It's not going to work because it's kind of interconnected with a few other things here. So we're going to go ahead and fetch the Yahoo data. From that, we're going to extract free cash flows and convert all of those to numerics just to make sure they're numerics. Now it's not necessarily numeric. I've seen dates come in as strings. I've seen numbers come in as strings. These are objects. You can't do any type of numerical analysis on an object. You can't calculate difference between dates. If they're objects, you have to convert those into actual dates and actual numerics. That's why we're doing that. And then we're going to get the shares outstanding. Okay, and the growth rate is going to be 1 plus the growth rate to make that a whole number rather than a fraction. And we have the free cash flows down here. The discount rate is going to be applied, and then we have the terminal value, and the terminal value present value. So remember, the present value is what happens today, and we're looking into the future. When you discount everything back in time, like if we have an investment that's going to pay us 5% per year, and we invest $1,000 in that investment, we're going to get $50 per year, but every year that $50 is going to be worth less and less. Okay, so $1 today is worth $1. If you have $1 a year from now, that's going to be worth less than $1 today for a few reasons, because of inflation, because of the riskiness of investments, and because of the time value of money. You can just take that dollar today and invest it and make money. You don't want to wait 1 year to get $1. If you can get it today, you're going to be better off. So this is a user-defined function. I'm going to hit Control-Enter to refresh the function and pass in this variable Starbucks. Control-Enter, and we're looking for the intrinsic value and current price, free cash flow, forecasted terminal value, present value. Okay, so terminal value is into the future, probably 5 years into the future. That's what we're looking at here. Free cash flow forecast over the next 5 years. We can see 5.3, 6.4, and this is all in billions, 7.6, 9.9, and then 10. Sounds a little bit optimistic, but let's take a look. So if we go over here to Starbucks free cash flow, we can see trailing 12 months, TTM is trailing 12 months, is 3.3. The free cash flow here it was 3.3. That was back in September 24. 1 year prior, 3.3. The year before that, 2.5. And the year before that, 4.5. And this is in billions, okay? So all numbers are in thousands. If you have $1 million right here, multiply it by 1,000, you get a billion. So the free cash flows are actually decreasing over time, but we're a little bit optimistic with this model. We're going to say Starbucks is going to open new stores, they're going to enter new markets, and it's going to increase its cash flow. Now, this is just a forecast. This could be off, it could be slightly biased, but hopefully it's going to be pretty accurate. The terminal value is going to be 183 based on the discounting of all these forecasted cash flows. The present value, we have to take this 183, discount that using the WACC, the weighted average cost of capital. So today it's 124 billion. The terminal value would be 183, but 183 5 years now is actually 124 today, and the total equity value is 155. So the intrinsic value of Starbucks is 137.16, and the current price is 92.64, 92.53. So this comes from the web, but you can see this is dynamic. This changes every couple of seconds. So when I ran this about a minute ago, we got 92.64. So this is actually undervalued. So Starbucks is a pretty decent investment. So why are we looking at this? We need the free cash flow over the next 5 years to understand what this company is capable of generating in terms of cash flows, right? If you're not making money, you're going to be out of business real quick. So you have to have positive cash flow to stay in business, or you become, what's it called, dysfunctional, or what's that term? A liquid? No. I forgot. A liquid, immobilized. Anyways, you can't, insolvent. I'm sorry, insolvent. You become insolvent and you can't pay your bills, okay? So we want to make sure that cash flows are positive, strong, consistent, persistent. We're looking at the terminal value to see what this series of cash flows is worth 5 years out. We want to take the present value of that terminal value to understand what it's worth today, right? That's the 124 today. 5 years now, 183 billion. So you're talking about some big numbers. Total enterprise or total equity value is the value of all the equity shares. You have to divide by the number of shares outstanding. I think you can get that from here, statistics. Let me see if they have that. They may or they may not. No, they used to. It's changed a little bit. So you could Google it though. Let me see. Starbucks. Okay. Oh, shares outstanding 1,132,000,000 shares. So that's a lot of shares, guys. That's a lot of shares. So to get the intrinsic value, take the total value, divide by the number of shares to get the value per share. This is the intrinsic value per share. The market price is 92, so this is seriously, not seriously undervalued, but you get a discount, probably 30% discount, 137 divided by 92.64. Let me see what this is. 137 divided by 92.64. Six four. Subtract 1. Okay, what's wrong with that? Okay, so you get a decent discount, almost 50% discount. Okay, not bad, not bad. So let's plot this now. We're going to plot this and see what this looks like visually. Okay, a picture is worth 1,000 words. And you can see here the intrinsic value is 137. The current value is 92. Okay, so pretty straightforward here. And let's create one more plot here. I like these Plotly charts because they're interactive and dynamic and you can play around with it. So here is the 137 intrinsic value and here's the actual market price. So if this blue line is below the red, this is a good buy. Starbucks right now is a strong buy. Okay. So highly recommended for this type of investment. Let's look at a couple more real quick. Let's look at Amazon, AMZN, Control Enter. Okay, we have intrinsic value negative 1.4, but the current market price is 224. Let me look at that. Finance, AMZN. What you got for me? AMZN. Got it. 224, is that what I said? Yep, right there. Okay, and it's tanking too. Okay, so let's look at the cash flows and see why. Okay, so it was negative just 2 years ago. Negative cash flow, not good. Negative 14 billion. Remember, then it was 25 billion. So it's actually bouncing around a lot. They must have a lot of capital investments in 2021, 2022. It writes itself by 2023, 32 billion and 70 billion. So wow, they really hit it out of the park in the last trailing 12 months. But that is impacting our analysis here. We have a big negative number there, negative number there, negative almost zero, but still negative. That's why we're getting negative intrinsic value of 1.42. So 224 seems to be seriously overvalued. Let's look at the chart. Control Enter. It just barely shows up. It's just a blip on a radar screen. So the stock is trading at 224. It's worth about negative. It's actually negative. Okay. And let's look at this one. Refresh. And you can see, yep. So almost at zero is the actual like intrinsic value of the stock, and it's trading at 224. So I think Amazon is going to reverse and go back to the intrinsic value, or something's going to happen. But I mean, like, look, we are picking up some negative cash flows for the past couple of years. So if that continues to improve, like you saw, this is bad, this is bad, this is much better, this more than doubled. So in the next couple of years, if they continue to double, then this intrinsic value number will rise up to meet the stock price. If not, the stock price is going to dip down and go towards the intrinsic value. So it can go either way. Let me look at Microsoft, MSFT, and I know you guys can do this by yourself. I don't have to hold your hand and do this for you, but I think it's kind of cool. It's kind of fun for me to do this. Okay, so Microsoft intrinsic value is 81. The current price is 428. And I bet that's right. AMSFT 428 right there. So we got it right there, guys. And the intrinsic value is just a slice of that 81. And we'll see the same thing. So the red line will be below the blue line in this chart. Exactly what we see. So intrinsic value 81, market price 420, almost 430. That's okay. I think people are very bullish on Microsoft. Maybe there's a lot in the pipeline. I'm not sure, but it seems like the stock is seriously overvalued. Let's look at one more. This is the classic TSLA. Control Enter to run it. Okay, get all our refresh information. So 2.6 billion cash flow over the next 5 years. It's pretty consistent. It doesn't change. 2.6, 2.6, 2.5, 2.5. So the intrinsic value is about $12. It's trading at 399. Gotta love it. My God. Tesla TSLA 399. Okay, so this is dynamic. Pulls all the information from the web. Let's go ahead and refresh our chart. And that's exactly what is reflected here. Tesla should be worth about 12, unless like they've got some secret to printing money, or they can turn lead into gold. There's no way the stock is worth 399, but that's what it's trading at. So the market can remain irrational for quite some time. There's no saying the market can be irrational longer than you can be solvent. I know some hedge fund managers tried to short this because this is seriously overvalued. Intrinsic value is close to $12. This is trading at 399 right now, 411. I think yesterday was the closing. But again, if you try to short this and the rest of the market is bullish on this, you're going to get slaughtered, right? So even though it's seriously overvalued, the rest of the market has to understand what you and I understand, or we're going to get killed if you invest in Tesla. I never bought Tesla in my entire life. I never really understood this thing. I think I read somewhere that Tesla's market value is equal to the next top 10 auto manufacturers combined. And I think Tesla has about 5% market share, and the next 10 auto manufacturers have 95%. So the mathematics make no sense whatsoever why Tesla is trading at that price, unless maybe people are looking at that investment or that enterprise as a battery manufacturer and not really a car manufacturer. If you think they can um, they can revolutionize the way that batteries are manufactured so that you can charge them super fast and they can deliver a ton of power, and we get away from all kinds of internal combustion engine propulsion systems for jets, any kind of plane, any kind of boat, cars, trucks, trains. If you can do that, if Tesla can do that, then yeah, it's worth $399.69 per share. But as a car manufacturer, it's really worth about $12 per share. If you're manufacturing batteries and you have the best batteries in the world, your stock could be worth this. Maybe that's what investors are looking at. But if you're looking at just the auto manufacturing piece of the business, it's probably closer to $12. So again, just to wrap it up here, free cash flows are very important for understanding um, the value of a stock. All right, very different from analyzing the value of a bond. You'll check out my other video. I'll post both of these later today. Bonds, you're looking at discounted coupon payments. Cash flows are more relevant for stocks, right? And we use this metric to understand the overall value of the business. What's the intrinsic value of this enterprise right now at this point in time, right? And if you need more information, you can get that from the company's 10K, from the quarterly 10Q reports, SEC mandates that any publicly traded company publish 10Ks once a year and 10Qs every quarter, so you can go ahead and get that. I got all my data dynamically through this user-defined function over here. I think this is easier than reading 10Ks and 10Qs, but it should validate exactly what you see in the 10K and the 10Q, because ultimately all that data goes to Yahoo Finance, so we're getting the same data that everybody else gets, okay? We're just not reading 10Ks and 10Qs, we're just importing it from Yahoo Finance. That's the only difference here, trying to streamline things and make it more efficient and just simpler and easier to use. I like to make things simple. I like to create order out of chaos. So that's why I do it this way. Okay. So that's it, guys. Hopefully you enjoyed this. Hopefully you learned a couple new tricks today. I learned a couple of things when I was putting the code together yesterday. That's pretty much it. I'll wrap it up. Thanks for your time. Enjoy your day. Bye. All right, everyone. It is late Friday afternoon. I'm going to do one more teaching session today, and then I think I will log off for the rest of the day and relax just a little bit. So let me leave you with this before we head into the weekend. I want to talk to you today about Black-Scholes option pricing model. We're going to use Python to do all the coding and all the logic and all the plotting and charting and analysis and so on and so forth. Okay, so what is option pricing? It's actually a critical tool in the financial markets for both theoretical and practical reasons, some of which include valuation of options. That's what we're going to look at today. Hedging strategies, that's important. Is an option overpriced or underpriced? We're going to look at that. Options are very popular risk management tools. It's used for market efficiency, decision making for investors, regulation and reporting purposes, and scenario analysis. Okay, so I'm going to put a link to this URL that I found online. This is actually the Black-Scholes option pricing model. This is it right here. So this is a beast, right? This is kind of a behemoth when you look at it, but don't be too intimidated. We're going to get into the nuts and bolts and explain how a lot of this works. So it does look a little bit intimidating, but just sit tight and stick with me to the end, and I think you're going to learn a ton. So let's go over here. Let's look at Walmart. I just picked Walmart's for no particular reason, just picked it, right? So here you have a list of all the calls in the left-hand column and the contract name, right? So each one has a slightly different ID number, last trade date, strike price. That's where the option comes into the money or goes out of the money. If you're in the money, you're actually making profit. If you're out of the money, then you're not making a profit, okay? And last price traded, bid ask. The spread is the difference between these two. The market maker keeps that spread. That's how they make their money, right? And then you have the volume and the open interest. So this is number of contracts traded. So you can see right here, implied volatility is almost 400%. So the reason it's so high is because right now the market, if you look close, it's at 92.83. It's almost 93. So anything at the money is going to be a lot cheaper and have a lot less volatility. So right now the market is about right here. This 0.33 right here is the last price traded, right? And it's the difference. That's the historical volatility, also not also known as, but there's two ways to calculate the volatility: the historical volatility or the implied volatility. We'll look at both in just a minute. But you can see how the implied volatility is much lower here. It's about 17%, and over here it's 400%. So if if Walmart stock drops from 93 to 65, if it drops almost 30 points there, like what is it, 28 points or whatever, then the implied volatility is 400%. You're going to make a lot of money, right? If you have this strike price, you're going to be in the money. So this guy would be deep in the money right here if the price drops. And this guy is at the money right here, right? So at the money, you don't see a lot of volatility. Deep in the money or deep out of the money, you see a lot. So down here, puts, if you buy a put, you want the stock to go down instead of up, right? So a put is sort of like a short, and a long is kind of like a call. And you can see the implied volatility right here because you're pretty far out of the money. It's 93 right now, and the strike price is 70. So that guy's way out of the money, okay? And this guy is way, wait, that's way out of the money too, okay? At the money is right here. This is the 93. Oops, I'm sorry. That's 93. That's the current stock price. So you can see the volatility is the least right here. It's like 0%, literally no volatility, right? Because you're at the money. And over here you see at the money 93, but this is on the call side. And the volatility is pretty low, 11%. Not quite zero, but that is the lowest one, right? So that's kind of an overview of options right here. And there's two ways, like I said, to calculate the volatility. So we know 4 of the 5 inputs to the Black-Scholes model. We know this with certainty, okay? So there are 4 are current stock price. We know that's 93. The strike price, you know that is right here. It's whatever you pick for the option. You know the strike price is 93. That's the one you pick, but you can pick any of these, right? You can pick 65 through 93. 65 is going to be a lot more expensive, right? That's deep in the money right now. That guy is definitely making money, so it's a lot more expensive because he's guaranteed to make money. This is pretty cheap because it's at the money, but it's probably not going to really go into the money. The stock is 92.86. It's just in the money a little bit and expires today. If you look close, it's actually today at 3. This is the price at 3:22 p.m. The market will close at 4 p.m. So it's 3:54 right now. It's 6 minutes. The market's going to close. So nothing's really going to happen. See, at the end of the day, either you're in the money or out of the money. That's it. The money has been made. These stock options probably came up probably about 3 or 4 weeks ago. I'm guessing close to 4 weeks ago. So that's it. It's going to expire today in about 6 minutes, and nothing is really going to change that stock price too much at this point. So the current stock price is given, strike price is given. We just saw that time to maturity is given. We know that is today. It's basically 0 days or a fraction of 1 day, right? 6 minutes out of the market's open for about 7.5 hours each day, and then the risk-free rate. So that is given too. We can go to the market, or we can create sort of our own risk-free rate. It would be about 3%, maybe 4% in this interest rate environment. The only unknown here is volatility, right? So what's the standard deviation? The standard deviation represents the expected annualized standard deviation of stock revenues. This is directly observable in the market. Okay, so these 4 are given: stock price, strike price, right? Time of maturity, and risk-free rate. This is the only unknown. So if we can calculate that with a high degree of accuracy, we can price these options very precisely, and then we can make some decent money with that. Okay, so let me go ahead and refresh this. Okay, and all we're doing is going to Yahoo Finance, importing data relative to that stock ticker, and we have the options change data that comes here, and we have all our puts and all our calls data right here. So this all comes to us free from Yahoo Finance. And we refresh that. You see the available expiration dates, the contract symbol, and then the strikes. So we have 65, 70, 75, 25, 84, 20, 85, 15, 29. Okay, so if you go back here, 25, 84, 20, 85, 25, no, 15, 29, sorry, 15, 29, that's exactly what you see here. So you're just pulling in the data. You're not doing any analysis. You're just pulling this data from Yahoo Finance. So I think everything there looks fine. We have the 4 givens right here. This is the unknown. Once we can try to derive this volatility pretty accurately. We can make a very precise calculation for what that option should be worth, and then we decide is it overvalued or undervalued. Okay, so it's very interesting to think. I did a video about bond prices, which bond prices are overvalued, which are undervalued, stock prices, which are overvalued and undervalued, and now we're looking at derivative contracts, well, specifically options pricing, not really derivatives like grain or cocoa or oil. This is more like options trading. I think I misspoke here. It is one type of derivative, I think, but derivatives are much broader than this. So there's two ways to deal with volatility or to derive the implied volatility, right? So we have historical volatility and implied volatility. Okay, historical is a measure of how much the stock has fluctuated over a specific period in the past. So we're just looking at the standard deviation of prices and up and down, where's it going, back and forth, right? That is historical volatility. Implied volatility is more like the market price of an option using the Black-Scholes formula to solve for volatility. Okay, so we back into it or we derive that volatility. Okay, so here is historical volatility right here. This is the first part of the equation. I put a little print symbol so we can separate historical from implied, and this is all the logic for the implied volatility. When we come down here, we'll see both are calculated. Historical is a little bit lower, 0.18. I'm sorry. In this case, it's higher. I looked at one before; it was actually lower. So for Walmart, the historical volatility is a little bit higher. The implied volatility is a little bit lower, and that's fine. We have everything derived from this calculation right here, which originally came from this. Okay, so this was in fact invented by Black and Scholes, Burton Black Scholes model. I think around 1956 or so they came up with this, and it's withstood the test of time for quite a while now. It's still probably the most popular way to price options, puts and calls in the market today. So we have the historical and implied volatility. So now we have 5 of the 5 that we need to solve this equation, right? So we have this was given. Remember, current stock price, strike price, that's a given. Time to expiration or time to maturity, say basically the same thing. Thank you. Officially, it's expiration, risk rate, and then volatility. And we have the historical and the applied, right? So now we have all 5. We can go ahead and solve our problem. So I am going to pull in a little bit more information from the Yahoo stock prices, Yahoo API endpoint. I want the current price, I want historical volatility, and a few other things, strike price and market price. Okay, so I'm going to hit refresh, and it's just Control Enter on the keyboard, and I'm going to give all this code to you guys when I post a video later today, so you'll have everything. You don't have to take notes. You don't have to try to write this down as I'm going. To sit back, relax, figure out what's going on. This file, run it for yourself. Okay, so because the option is expiring like literally in 1 minute, I have 3:59 on my clock here. So the dates to expiration is 0 and the time to expiration is 0, right? Strike price, we know it's 93. Historical volatility is 0.18. We got that from over here. Okay, and we know the risk-free rate is 0.03 and the current stock price is 0.9296, right? If we go there, so it's coming in right from there. So pretty nice. Everything is dynamic, updated in real time. Okay. Okay, so the next step here is to use the Black-Scholes model to calculate the theoretical fair value of an option, given the parameters that we discussed above, right? So the stock price, strike price, time to expiration, risk-free rate, and volatility. And we have all 5 now. Remember, originally we had 4. Those are given to us, and we just derived the volatility. So we are going to plug that back into the Black-Scholes formula. And if you look carefully right here, you will see the same thing over here, represented probably just slightly different because of mathematical notations, but that's fine. So let's go ahead and calculate the price of the option. Control Enter to run it. Okay, we print the price of the option is 0.03, and the reason for that is because it just expired and it's basically useless. Like you can't even do the trade. It's 4 p.m. right now at the NYSE, and that's it. The market's closed. So it's basically almost 0 value because there's no time value left, right? If you bought an option 2 weeks ago or 3 or 4 weeks ago, there'd be a lot of time until the expiration date, and anything could happen. The stock price could jump up, it could crash down. In either event, there's going to be a lot of volatility if there's a big movement, and that's going to make any kind of put and call more valuable and more volatile, right? So like we saw before, if this is the strike price 0.93 and you have a strike price of 65, you made a ton of money. Look at the gain on this is 400%, right? Whatever money you put in, if you put in $100, you made 400. So what is that? You made like $400, right? That's all it is. If you put in 1,000, you made 1,000. If you put in 10,000, you made 40,000. So it's a good trade if that was your strike price. If this is your strike price, you made like a couple of bucks, right? It's 11%. If I refresh this now, I think it's probably going to be zero, right? Because it's at the money and the market is closed. Yeah, okay, so almost. So I think it's just a timing thing, but basically the market's shut down and you can't trade anymore. So it's almost 0% gain. And what was this again? 0.07 was the last price of the option, right? So it costs almost nothing, but you make nothing. This option costs $25, but you make 400% right there, right? So that's how that works. And this one is deep in the money for put, so kind of the same thing. Here, this one costs $14.65. Wait a second. Put. So yeah, and then all these are far outside of the money. So I'm trying to remember. I did this pricing before, but this was a few years ago. I just tried to refresh all the stuff in my model like 1 or 2 days ago. So anything that's further from the strike price, you're going to have a higher volatility, right, and higher movement. Anything right at the stock price, it's not going to move that much, right? It's just a small fraction of a percent there, right? So we got the calculated option price 0.035, and what did they say in here for this call? We go back to the calls, and at the put at the strike is 0.07, so 7 cents to buy one contract. This says 0.35, so it's actually off about 3.5 cents. Not a big deal. It's off a small amount there, but it's only off three pennies basically, right? Okay, so pretty accurate. But some of these calculated volatilities or historical volatility and applied volatility might not match exactly what the market has, and the market might have more perfect information than the model does. There's a lot of traders that look at this all day long, and there's all kinds of economic scenarios, conditions related to geopolitics, supply of oil, um, anything from inflation to housing prices have an impact on all these things, right? Maybe housing prices to a lesser extent, but there's a lot of information that comes to the market. So this price right here is going to be pretty accurate. Overall, this is highly accurate too, but the other market price is probably slightly better approximation of the true price of that option. Okay, so continuing on, we choose the strike price closest to the current stock price that's at the money. That's what I said before, okay? And there will probably be a small difference between the theoretical option price, that's what we derived above in this example, in this code right here, and the calculated price using the Black-Scholes model, okay? We saw that. And there's actually a small deviation in this over here too. But the point is not, okay, you're off by 3 pennies. That's no big deal. The point is really to understand these other options here. This is in the money, this is in the money, this is the money. Anything lower has come into the money. Anything higher is out of the money because these are calls, right? It has to go up to 125 for this guy to pay off. It's not going to happen. Actually, that option expired 2 days ago, right? Today's 110. 2 days ago, this option expired. So that is basically worthless. It's trading for 2 pennies. I think something didn't refresh. But the point is to try to triangulate what you're getting from the Black-Scholes model, the implied volatility, the historical volatility, and then this price that you see in the market right here. Okay, so that is what we're trying to triangulate, like between 0.07 and 0.01. It's right at 0.093, so probably that is probably the most accurate price. Okay, some factors that explain these discrepancies, like we saw a 3 cent discrepancy, it could be market prices, real world supply and demand. That's what I just said. So anything economics, implied volatility, explains basically what the market expects in terms of future volatility. So the implied volatility and historical volatility can't explain future volatility, but the market can capture this, right? So the model is pretty sophisticated, but I mean, it has its limitations too, right? So the strike price and the expiration date at the time of the money or at the money ATM generally are closer to market prices. We saw that there's a time decay right? The longer you have until the expiration date, the more chance the money, the more chance the option will move into the money, whether it's a put or a call. And Yahoo Finance prices reflect both intrinsic values and time value right here. Okay, so I think at this point, all these options have expired. This is last year. These have all expired over here. This one expired today. This one expired today too. Okay, so so these are gone. This is all useless. The smart money was made, and we can take a look at this Monday morning when the market reopens, and we'll have fresh prices here. Okay, so why would an option be over or undervalued? There's higher implied volatility. Okay, we saw that the market will actually capture that volatility. The Black-Scholes model won't. It's trying to make that guess, but there's certain limitations and constraints too. Supply and demand imbalances. So the market is aware of that. The market prices are updating constantly. Okay, and you'll see this price updating all day long. That's just stopped because the market has just closed like 7 minutes ago. So as new information becomes available, it gets incorporated into the stock price, right? But the Black-Scholes model will not capture that. So you have market sentiment. That's how eager or excited or how stressed out traders are, or the overall market is, right? So you have human emotions and feelings that play into that stock price, and real world constraints. So Black-Scholes doesn't count for factors like liquidity, transactions costs, or dividends, and it really only prices European options, which have to be held to maturity. American options can be not called away, can be sold at any time, right? So European options have to be held to maturity. American options can be sold at any time. So Black-Scholes won't really capture these nuances. It was never really designed for those types of special conditions for the option. So let us go ahead again and get the options data, and then display the head of the calls and puts. So we started calls and puts 65, 70, 75, and down 80 is 11.16. We should see that exactly the same thing over here, 80, 11.16. Okay, so these are all the calls. And then on the put side, we'll see again 80.02 cents, and that is on the put side, 80 down here, 0.02 cents. So exactly the same. So we're not doing any math here, we're just pulling in the data. Okay, and then the next step, let me refresh this. This is going to show me the names of all the columns. The next step, I believe we are calculating the over and undervalued, not conditions, over undervalued valuations for each of these call options. So what happened here? Column, get low key, implied volatility. Okay, so why would that be call implied volatility? Oh, that's interesting. So I think this changed because that was all one word before. That's why I printed the columns before. That's weird because I saw that the other day and that looked like it changed then, and then maybe it changed back. It's very bizarre. Okay, well, let's fix it. I can't explain why or how that happened, but well, that's fine. Let's fix it. Okay, so now we have, whoops, now we have another error. Strike. Okay, so this is bizarre because I saw this change the other day. They are saying strike has a capital S, and over here, let me look for it. Strike. Very bizarre because I know I saw this. I changed it just before I started the video here because I saw an error before. I was testing these things before I turned on the recorder. Okay, so that fixed it. No, it didn't. Oh, last price. Okay. It's always one more. Okay, let me look for the last price. LASTPRISD. Okay, so these spelling conventions or the naming conventions changed. A little bit concerning. But whatever. Let's just deal with it. That is price implied volatility. Also, this one's gonna change too. Okay, so let me fix this. Sorry guys. So I don't know why they would change the column names midstream like that, but it's fine. We'll fix it up. But it makes me wonder, like the next time I run this, is the column naming convention going to be the same, or is it going to change again? It shouldn't, but I mean, I guess you could write some logic and say that should be strike right there, implied. I think that'll work. Oh, okay. So we got the nope, nope, nope. There's another one. Last price. There's always one more, huh? It's a little bit annoying. I don't know what's happening here because I literally changed it right before I turn on the video recorder here. Okay, it seems like it's working. But why would it change like that? I have no idea. I can't explain that. Okay. Let me just go down here and test this because now I'm a little bit afraid that something else is going to change. You can test it and say, is this, if it's not this name, then use a different name. So it did it again, right? So implied volatility. Okay, we'll fix it. We'll fix it. Playing some games here. That's fine. And then that is implied capital, right? Oh, wait, see, implied volatility. And last price is another one. Strike. Oh yeah, strike. Okay, okay, we'll get it. Oh yeah, yeah. And then I think that's it. Let's see. Run it. We'll see for sure. There we got it. Okay, and then here's the plot. And okay, everything converged at the end there. So the plot looks a little bit weird. Typically, it would be horizontal to the left as you go into the money. These stocks over here are, it says overvalued, undervalued. Probably not the best time to do this demo because we're late in the day and the market just closed and all of these options just expired over here. So the last one that we had was 110, 2025. But you know what? I'm not going to redo this video. I think 95% of this is fine. Normally, if you look at this Monday morning or anytime just before the stocks expire, the options expire, then you'll see a more realistic move from the left up to the right for calls, right? This is going into the money as it's going higher and higher. The market price is higher and higher. It's $25. And these down here are almost useless because they're out of the money or they're at the money, okay? So let me see if I can see one more thing over here. Let's see, option price plots. Let me try this. Just to show you basically what these things look like visually. Oh, here's one. Okay, this is fine. So anything that goes into the money is going up in value, or puts are going to go down in value. So can I get that? Is it going to let me do this? Okay, so call option payoff. So anything that is positive, this is a call buy payoff, and this is a call put payoff. So it's going down, but it's still positive because you want the stock to go down. This is going up in money, in value, right? Call option buy payoff, put option sell payoff. Okay, so as the stock goes lower and lower, as the stock price goes lower and lower, you lose money because you sold it. If you sell a call, you want the call to go down, but you're making money. If you buy a put, you want the money to go up. So anytime you buy, you want to go up. Okay, so up to the left and the lower southeast quadrant, up to the right in the northwest quadrant here. Okay, if you buy something, you want to go up. If you sell something, you want to go down. That's what you see. The put sell, it's going down in value. You can buy it. You don't buy a lower value. I'm sorry, that's like a short. You would actually just make money as the stock price goes lower and lower. As the stock price goes higher and higher, if you sell a put, it gets a little confusing. You might have to like read the definition and study some terminology. But if you buy a call, you want to go up. Buy a put, you want to go up. If you sell, you want to go down. So this on the northeast quadrant is going down. You're making money, and selling a call is going down. It's making money. So that's what those look like. I will go ahead and put that into the notes over here. So that's pretty important too. And I'll just add that right there. Okay, I'll share the notes with everybody later today. Let me close this. I don't need to find anything. So where are we? Almost at the end here. Okay, so we got the chart and we have the profits and losses over here, and there's the last chart. So the last thing I want to show you here is all the implied market price, the theoretical price, and market price and strike price, and then we're going to go do a quick calculation to determine is the stock option overpriced or underpriced, overvalued or undervalued. Sorry, I misspoke again. So we have the strike price, market price, theoretical price, overvalued. The market price is 1. This is less, so these are overvalued. We wouldn't buy any of these. This is actually undervalued right here. The market price is 95. It's worth $1.02. The market here is asking $2. This is worth $2.02. So these two you could buy and make a profit on. And over here on the put side, these are the calls at the top. On the put side, you can tell right here if you look at this. Oh, I'm sorry, these are all puts. I'm sorry, these are all puts. So the calls are above this. The calls are over here. Okay, data frame calls. This is what it looks like. And over here we can see the same thing. So market price 0, theoretical price is 0 because it just basically expired. So all of these look a little funky, but they're all overvalued right here because that those options just expired today. And then down here, you would see the opposite on the put side. These are all the put head and tail results, and you can see these two you could buy and make money on. The theoretical value is 95 cents. The actual value is 1.02, or calculated value. This is selling for $2. The value is actually $2.02. So anything that says false over here, this is selling for 95 cents. It's worth $1.02. This is selling for 2. It's worth 2.02. And same thing here. You can buy this for $2.96. It's worth 3.02. Okay. All the others that say true, these are overvalued. You wouldn't touch it. Okay. Doesn't make any sense to buy those. You're probably going to lose money. But then again, this is how these things work, right? This is mechanics, but it's a little bit theoretical. You could buy something that's overvalued and still make money, but it probably won't happen, right? So we have to be careful of that. So in conclusion here, the Black-Scholes model provides a lot of important benefits for options pricing, closed form solution, widely accepted benchmarks, risk management tool, simplicity and speed, optimal for European options, not for American options, only for European options, market consistency, and theoretical framework for options pricing. So it's tried and true and tested. I think invented in 1956, and it's been around ever since then. It's withstood the test of time. So that's it, guys. Take a look. Hopefully you can learn a couple new things today. Go ahead and experiment with this theory if you want. I've made some money in the stock market trading options. I lost some money too, so you have to be careful with it. Just start small, build your confidence, get mature with this stuff, and I think you can have a lot of fun and make some decent returns too. Okay, there you go. I'm going to wind it up now. Friday evening, heading into the weekend. Enjoy your weekend. Enjoy your time off, everybody. Bye. Hey there, everyone. Ryan Schul at Straight Data Science. This is my data science and machine learning channel. So I have an interesting topic today. I'm going to show you how to value an asset that has no active market value. Okay, so market value would be like the price of Microsoft or Amazon or Tesla stock. There's an active market for it. For these assets, and you know exactly what the fair market price is, right? It's whatever it's trading at on whatever exchange it's at, and it can be traded on different exchanges around the world, some are international, at that point in time, right? So everybody knows what the price is. But what if you have an illiquid market or a security that doesn't trade very often, or there's not too many people that are interested in a specific asset, but it still has a value? How can you determine the value for that? So let me show you a few different techniques to do that. We can use something called discounted cash flow. This basically estimates the value of an asset based on expected future cash flows discounted back to the present value. So in the finance world, we always look at the time value of money. A dollar today is worth more than a dollar 1 year from now for a couple primary reasons. Number one, you can take that dollar and invest it. It's not big money by any means. A dollar is not a lot, but you can invest a dollar. And if you have capital gains, you can grow your money, right? And you'll have more than you will have in 1 year. And the dollar today is also worth more than the dollar that you receive 1 year from now because of inflation, okay? So a dollar 1 year from now is going to be worth less just because of the eroding purchase price of inflation as things get more and more expensive over time. So we can also look at internal rate of return. This is the internal return that an investment can generate. Again, we look at this on a relative basis, so discount everything back to the present value, or look at the time-adjusted value of all these things, so we can compare apples to apples, right? We always want to look at something at the present time. We can look at net present value. So again, present value, discounted cash flow, takes everything discounted back to today. Net present value is basically showing how much value the investment adds beyond its cost. And we can look at comparing multiples, or using different financial averages, like the PE ratio. I'll show you a few techniques for valuation. If you like this type of stuff, I have a whole bunch, not a whole bunch, but a few videos on my channel about different types of financial metrics and financial ratios and what they all mean. Okay, so that is another technique we can use. And basically, just valuing an asset that's very illiquid, which means it doesn't trade very often or maybe not at all. But it can be traded, and there is some intrinsic value or some inherent value for this asset. We can try to determine what that is, okay? And these are some different techniques that we can use to achieve that goal. So let's say we have cash flows. In this scenario, I have these separate cash flows going for year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I have 10 years, and the discount rate is 12%. So basically, this is the financing rate, or this is the bank. This is the rate that we would have to pay the bank interest on this loan to get everything discounted, again, back to the present value. So we have EBITDA, which is earnings before interest, tax, depreciation, and amortization. And we have a multiple, EBITDA multiple of 8. Net income, and this assumption is $40,000, okay? And the PE ratio, for these bigger numbers too, you can use an underscore, and it's like the same thing, because you can't have commas. And here, if you try to put in a comma, it makes it easier to read. Whoops, that's apostrophe. But the machine is not going to know what a comma is. Whoops, that's a back arrow. All right, it's going to throw an error. But instead of a comma, we can use an underscore to make these things a little bit easier to read for people, and a computer will just ignore that. So we have DCF valuation is $162,021. So where does that come from? It's these 10 cash flows for the next 10 years. You're basically making an investment in some type of asset. It could be anything. It could be a piece of hardware. It could be a small business that is rented out by a professional service firm, a doctor, a group of small doctors, a group of small lawyers rent your office space, right? That could be generating cash flows for you. And the cost to buy the space, to go out into the market and buy the space, is going to take whatever amount you invest in it, discounted at 12%. That's what you're paying for the loan, right? Book value, again, is 180. We can make that a little bit easier to read for these bigger numbers. Price to book ratio is 1.2. Then we get the calculations are done here. So valuing the DCF is the net present value of the discount rate, the initial investment, and the list of cash flows. You can tell this is a list because it has square brackets around it. Value the PE and the price to book, and the EBITDA. So we get these values down here, and then the blended value would be the mean of all of these over here. Okay, so we have the DCF valuation. So all these cash flows from 50,000 to 850,000, different frequencies or different amounts over the next 10 years. This asset to you is worth 162,000. So that's a good example, actually. If you want to go out and buy like a small retail store or something and rent it out to a professional service team, again, a small group of doctors or small group of lawyers, and you can estimate that you can generate these cash flows and you pay the bank 12% for the financing for that asset to you is worth 162,000. So you can actually make a profit if you know you can get this asset for 150,000. Then you're going to have a positive DCF, a positive IRR, the internal rate of return is going to be positive, and it's actually worth more than the market price, right? Now, if you overpay for that, then some of these numbers are going to go inverted, and it's probably not a good investment, right? And then you'd have to have a lease and a contract. But if the tenants that you rent the space to leave after 5 years, then you're gonna have to scramble and find new tenants. There's probably be a clause in the contract where they have to pay a penalty or something. But anyways, the asset today with these cash flows for the next 10 years at 12%, cost of borrowing, that's the cost of doing business, is worth 162,000. The EBITDA is 560,000. The price to earnings is the price that you pay to earn this amount of money. It's 400,000. Price to book is 216, and the blended, which is average of all these right here, price to book, PE, earnings value, and DCF is all $334,000. So basically, the rule of thumb is if DCF is positive, I mean, in theory, even if it's positive $1, you could do the deal. Now, I wouldn't get a loan for 10 years at 12% and get these cash flows just to make a buck. But in theory, if the DCF is positive, at least $1, then it makes sense to do the deal. You want the DCF to be higher. Higher is better. That's more money for you. Anything is positive, you can move forward with it. Anything is negative, you don't touch that. Okay, that's not a good investment. So now we just assign a value to a piece of property when there was none before, right? So I think that's pretty phenomenal that we can do that. We can go ahead and determine the intrinsic inherent value of something that's generating wealth for us. This is generating wealth for the next 10 years. So it's pretty consistent, very persistent, and it's a good investment because we're making $162,000 by not really doing a whole lot, just collecting rents. And the asset can be anything, right? It can be any kind of tangible property that has some kind of wealth generating mechanism for yourself. It could even be rare art, a piece of art that you hang on your wall. There's no market for that probably, but potentially, you could buy the piece of art for, I don't know what, $500,000, maybe sell it for $1 million. So that's generating revenue for you. It's not discounted cash flow revenue, but it's still an investment, right? If you pay a couple million for a piece of art and you sell it for $5 million, you have a capital gain on the art, right? You still made the $3 million profit and you can enjoy the art hanging on your wall for as long as you have it. So that's a good investment, right? So just the whole concept here and the whole theory is we're trying to determine what something potentially could be worth. That's an asset that we can't just go out into the market and say, okay, I know what this is worth. I can assume, or I can calculate what this is worth. It takes a little more effort and a little bit more legwork to determine these valuations, but it's not that hard, guys. It's not that hard. So let's look at another example down here. Now we have more of a scenario analysis. The scenario is the interest rate that we are charged on the loan is going to change slightly over time. Okay, so the IRR is going to go from 8% to 10% to 12%, and we just want to look at different potential NPVs as we pay different interest rates for the loan. Now I'm looking at this. I don't have to print out the IRR each time. That was unnecessary because that's not going to change. But that's fine. I'll just leave it in there. But you can see as the interest rate on the loan is lower, the value to you of that piece of property, because you're paying a smaller mortgage, is more, right? The value of that property is more as you're paying less for the loan. So at 8%, that same asset is worth $236K. If you have to pay a higher interest rate, this is the discount rate, it's worth $196K. If you have to pay 12%, it's worth $162,021. That's how we got this number over here, remember? Because we said the discount rate is 12%. So we're doing the same type of analysis. The only difference is we're looping through 3 scenarios so quickly and easily we can see how much this asset potentially is worth at different interest rates. That is what we'll have to pay the bank for the loan for this money, okay? So that's a scenario analysis. A Monte Carlo simulation is when we run a whole bunch of different scenarios. In this case, we do 1,000 different scenarios. Here we did 3, okay? So this is 8, 10, and 12. Here we do 1,000 different scenarios. So the computer runs the analysis pretty quick and pretty fast, so we hardly even notice it. Then we can plot the results below. So now instead of looking at just 3 scenarios, we see 1,000 different potential scenarios with a whole bunch of different interest rates. The frequency of those counts of the outcome, and then the associated NPV. So if the interest rate is very low, remember, NPV is going to be high. If the interest rate is high, the NPV is going to be low. We saw that over here, right? So low interest rate, high NPV, high interest rate, low NPV, right? So we see the different scenarios. And the lowest NPV we get in this case with 1,000 scenarios is 130K, and the highest we get, so this would be the best case scenario, we just get 1. More likely it would probably be like around here, but this would actually be the most likely, right? It's kind of a normal distribution, bell-shaped curve. We know after 1,000 scenarios, the property is probably worth about 160K to 170K. And we've assumed a whole bunch of different potential NPV, discount rates, right, for this scenario. So the property, if we can buy this between 160K to 170K, that would be the NPV to us. So we're making 170K in the next 10 years. That's the total amount of the value of this asset. So we should go ahead and invest in the asset. That's a green light. That's go for that. Okay. So again, anything over positive NPV, we do the transaction and hires better. Okay. So what else? I'll just summarize the last thing. The last thing I have in my notes. When asset has no observable market value, such as private equity, distressed assets, early stage startups, IP portfolios, or infrastructure projects, even building out infrastructure, even if you have to build a dam, if you have to build a bridge or a highway, this is a great way to determine the value of that asset, whatever it is that you're financing, right? This is a different financing techniques, and how do we manage it efficiently and responsible? That's what NPV analysis is for, and IRR. And like I said, maybe rare artwork. Again, there's no cash flows for the art, so that's kind of like a little bit different scenario. But again, there's ways to value the artwork too. So basically, the real world implications here are real options value, cost-based valuation, right? We're using judgment, we're using mathematics, we're using information to make an intelligent, informed decision, expert judgment, income capitalization, machine learning, model valuation, what else? Bayesian valuation and belief updating. We really didn't get too much into that topic today, but I have several videos on my channel about Bayesian analysis, so you can check that out. Scenario analysis, we certainly did that. Monte Carlo simulation, we did that. Shadow pricing and infrastructure valuation models, right? Again, if you have to build a dam or a some type of energy generating asset, whether it's dirty energy or renewable energy or a bridge or a highway, these are techniques that you can use to value the project and make sure it has positive NPV, or you don't engage in a project, right? Or you have to renegotiate the cost or something. It has to be positive NPV, or you don't back it, because that's a bad investment and you're guaranteed to lose money. So hopefully that's it, guys. Hopefully I covered the topic and gave this its full attention here. I think these things are pretty interesting, and I like to just drop knowledge and help people to learn different concepts and different techniques. I'm going to keep this one relatively short. I'm going to wrap it up in just a bit, and I will put all this code online so you can download it and run it in your own Jupyter Notebook environment and do the analysis for yourself and see how everything turns out. And then by all means, mess around with the numbers over here. Add a couple more cash flows. Make it 12 years, make it 20 years. Check out different interest rates, right? And change the interest rates down here. That's what the scenario analysis is for. And add more simulations here. I can add one more. I can go from 10,000 to 100,000, rerun this, and see what the outcome is going to be. Okay, somewhat similar as before. We just have more outcomes now. Now we have, instead of 1,000 different scenarios, we have 10,000. So again, the most frequent count is about 160 to 170. A little bit lower NPV would be 155, and the probability of this happening is a little bit lower, right? But we can also assign total probabilities. What's the most likely 90%? I didn't add that into here. Maybe I could. Maybe I'll just modify the code a little bit before I actually post it. But that's pretty much it. I think we covered the topic sufficiently. So I'll make a small modification to the code. I'll post everything later today. You'll have everything you need. Go ahead and copy it, paste it, modify it, and by all means, learn as much as you can from these scenarios. Okay? Thank you so much for your time. I'm going to wrap it up, and I will see you in the next video. Bye. Hey there, everyone. Welcome to my data science channel. My name is Ryan Schul, and I talk about all kinds of topics related to machine learning, deep learning, artificial intelligence. A lot of the topics are pertaining to finance and financial services. That's my background. I got my MBA in finance about 22 years ago, so kind of a long time. And I've been on Wall Street ever since for the past 22 years. So I like to take these type of topics I find either doing some independent research or things I know about, and doing some fact finding and due diligence, and come up with different data science techniques I can demonstrate here and showcase to you guys. I like this stuff and I think it's pretty fast and pretty cool too. So today I want to talk about portfolio optimization and how we can actually combine portfolio optimization with a very basic strategy called buy and hold, where you just buy a bunch of stocks and sit on them. Don't do any trading whatsoever. You just hold the stocks for a period of time, and it could be whatever you choose, 12 months, 24 months, 36 months, which is 3 years, or longer or shorter. And we compare the performance to the optimized portfolio, right? This is a strategy that we're going to use today. There's a whole bunch of investment strategies. On my channel, I discussed quite a few. I don't even know how many now, over a dozen easily, maybe almost 2 dozen investment strategies that I've discussed in other and other topics and other videos on my channel. So you can look out for that if you're interested. Hopefully you like that stuff. I'll keep doing it if I get some good feedback from you guys. But today, yeah, we're looking at portfolio optimization, and portfolio optimization, according to Wikipedia, I just looked this up, is the process of selecting an optimal portfolio. This is asset allocation, where you're investing in a bunch of different assets, right, to create a diversified portfolio. And we're trying to pick the best assets for the portfolio. So we don't just randomly say, okay, we're going to pick Apple and Walmart and Costco. I don't even know if Costco is publicly traded. Coca-Cola, Verizon, and Amazon, right, or whatever you pick. We don't just pick random stocks to put in the portfolio, but we pick stocks based on the overall historical price movement of the stock, how volatile is it up and down, and then is it mostly up or is it mostly down, right? So we want to pick stocks that are relatively increasing over time, that have low volatility, but not a lot of choppiness, not a lot of up and down. It's relatively just stable, persistent and consistent increases. And we want stocks with not too much volatility, right? So not a lot of choppiness, kind of small movements over time, right? If we can decrease the volatility and increase the profit or increase the return, that's really the optimal combination of assets to include in our portfolio. Okay, so we basically have two objectives here. We try to maximize the returns or minimize the risk. You can't really do both at the same time. You can do either one or the other, or you can kind of take a combination of both. But if you maximize returns, you're going to take on more risk. And if you minimize the risk, you will give up some returns, right? So you can pick in between, but you're always going to make a compromise, right? So it's either maximize returns or minimize risk, or maybe you can take a combination of those two. So that's what I want to look at today. So I have these stocks. This is basically the Dow 30. I'm going to put all these stocks into a list of tickers. I'm going to go back in time 120 months. Now you can pick whatever you want. You can go back 3 months. You can go back 6. You can go back 12. That's 1 year. All right, I'm going to do 120. That's 10 years. 12 times 10 is 120, obviously, right? Basic math. And the point is you can choose this to be whatever you want. This is dynamic input. This is not another dynamic input. And based on those two things, it's really the only thing you're going to have to change here. You can pick whatever tickers you want, pick whatever time frame you want, and do your own analysis. So this is a very dynamic kind of example here of how this works. So I'm pulling in the data from Yahoo Finance. Everything comes from right here. Yahoo Finance is the endpoint, and Yahoo covers about, I think, 50,000 different stocks. It might actually be, might be more. Let me look this up. Now I'm curious. Whenever I start talking about these things, I have to look it up. How many at Yahoo Finance? And it might not even say. Oh, wait. Does it say? Okay. So they have the S&P 500, Russell 2000, Wilshire 5000. I'm sure they have that. I'm not even seeing it here, but they have ETFs. They have some stock screeners and so on and so forth. I'm not seeing it. You know, I'm going to go out on a limb here and say 5,000. I don't know for sure. This is not going to tell me. You know what? Has plenty of stocks. So probably whatever you're looking for, you can find it here in terms of ETFs or stocks. Very good coverage. I think there's about 3,500 ETFs or 3,300. And as far as I know, Yahoo Finance covers all those. And I'm just going to say here, maybe 50,000 stocks, maybe a little bit more, maybe a little bit less, but it's pretty sufficient coverage. So whatever you're looking for, you should be able to find it. Okay. So you go ahead and fetch those stocks for whatever time period you pick. Again, in this example, I'm looking at 120. Okay. And I have some analytics over here, it is a little bit scary, but don't get too intimidated. I created some functions to maximize the Sharpe ratio and minimize the variance of the portfolio. Remember what I said initially, either you can achieve a maximum return, potentially. There's no guarantee when you work with things in the investment world, right? There's always surprises and gotchas and little pitfalls and things like that. But we can try to maximize the returns or to minimize the risk, or a combination of those two. But you can't have the maximum returns and the minimum risk, right? You always give up some risk when you achieve higher returns, or you take on higher risk. I mean, or you can minimize the risk exposure, but your returns are going to be chopped a little bit too, right? It's going to be cut. So the main thing to know here is the maximum Sharpe ratio, right? So that comes from the user-defined function above. You don't have to get into all the mathematics and all the theory behind this. This was created by, I forgot who. Sharpe ratio came out in the mid-50s. Who invented that? Now I have to Google this. Who came up? Who came up? Oh, Harry Markowitz. I think it was Harry Markowitz. Portfolio. I think it was Harry Markowitz. I think that was the guy's name. Yeah, that was it. Harry Markowitz, 1952. Okay, so early 1950s, he came up with this concept where we can maximize the Sharpe ratio or minimize the volatility of the portfolio, thereby minimizing risk. And you can do one or the other. You can't do both, right? Or you can take a combination of these two. So most of the math is a little bit convoluted. Don't worry about that. The only thing you really have to change here is the inputs of tickers, right? And the date that you choose. And this is kind of the brains of everything right here, right? Just to point that out. I'm not going to get into all the math, but it totally works. Okay, you can dissect this thing yourself, and you can see how it works. It'll take a little research if you're not familiar with this topic, but that's fine. You're going to learn a lot in the process. Okay, so when you run that, you'll get this result down here. We're pulling in the historical daily returns from Yahoo Finance for all these stocks, right? Then you'll get the allocation right here. So annualized return of the portfolio, 21.9%. Annualized volatility, 17.8%. And Sharpe ratio, this is the risk-adjusted return. So you have the return minus the risk-free rate divided by the standard deviation. This is 1.07 Sharpe ratio. So the higher the Sharpe, the better, right? You have more return for lower risk. The number is going to be higher if the numerator is higher and the denominator is lower. That's what that means. And then you can see the allocation of each stock. So this is important because this is how much of the money you allocate to each investment, right? So let's say we start with 100,000. We're going to start with a hypothetical 100K and allocate 6.9% to Apple, 18.35% to Microsoft, 15.57% to Amazon. JP Morgan gets that. Walmart gets 20.99, basically 21%. United Health gets that. This is Visa, nothing. Johnson Johnson, nothing. Caterpillar gets 10%. Okay, so on and so forth. This total will add up to 100%, and you'll put this percent of the total investment into each of these stocks, right, to optimize the portfolio. Now, the other end of the coin here, obviously the coin is to minimize volatility. The annualized return will be a little bit less. See, the return here is 11.8%, and here it's 21.9. So here you have a higher return, higher volatility, 17.8, and here the volatility is less, 13.6, and the Sharpe ratio is going to be less, right, because you have lower return, although you have lower volatility, so the denominator is lower, right? Numerator divided by denominator, you get a lower Sharpe ratio, but again, less risky portfolio. And now you can see the allocation is different. So 0% for Apple. Over here we had 6.9. Microsoft, we have 18.3, and now we have 0. Right? Amazon, 4.7% of the portfolio. There it was 15%. So these stocks basically are lower risk and lower volatility. You can see Johnson Johnson, 16%, McDonald's, 11%. Where does most of it go? Most of it goes to Coca-Cola, and Walmart gets 14%. Coke gets 11.9% for the minimized volatility. Here, for the maximized return, you put 0 into Coke. So you can see how this works, right? If you want higher potential return, and there's no guarantees, again, in the stock market, if you want a higher potential return, you would put your money into these stocks. If you want a lower volatile portfolio, right, minimize the volatility of the portfolio, you would allocate your money into these stocks. Now, this is just one slice of time, right? Just 1 month, how you should do the allocation. What I did was take this portfolio optimization and add it into a tool that is going to do month-end rebalancing. So every month end, we go ahead and flip out the underperforming stocks and buy the stocks that are recommended according to modern portfolio theory, right? Or in portfolio optimization, which is the same thing basically. And we're going to do a monthly rebalance for the portfolio. So every month we go out, look what's happened in the prior month, and look at the stocks that the portfolio optimization logic here picked for us, and we'll buy those stocks and rebalance the portfolio, right? For 120 months, we're going to do this exercise, rebalance the portfolio every month. And we're going to have the optimized portfolio allocation, right? Now, the only problem with this is it's backward looking because you can't see what's going to happen into the market tomorrow and the next day and the next day after that. Nobody has a crystal ball, right? So it has to be backwards looking. So therein lies the risk because although this was a recommendation for the past month, right? 6% to Apple, 18% to Microsoft, 15% to Amazon. Is that going to guarantee to be the allocation for next month into the future? No, you don't know what that's going to be, right? So it's always one step backwards looking, right? So you always have some risk exposure, but we're trying to optimize the portfolio. Well, we will optimize the portfolio, that's guaranteed. But the returns are not guaranteed, right? So that's the whole concept of how this works. So let me kick it off here. Everything is set up, ready to run. I have 120 months, that's 10 years. I have these 30 Dow component tickers. If you go over here, you can look for these Dow 30 components. Okay, and you'll get that right here. It's the first link that pops up. So you have all the Dows. That's Amazon, Amgen, Apple, JP Morgan, down to Walmart and Disney. That's why I got those right there. Okay, and you just put quotes around those and put that into the list. So let me go ahead and kick it off. We have 10 years of data, 120 months with these stocks. Okay, so I'm going to run it. And it goes pretty fast. Again, you don't have to change anything down here. I would encourage you to learn the math and learn what's going on under the hood here. But if you don't totally understand it, it's okay. The code will still work just as I described. And you'll have all of the stocks coming in. So we get 10 years worth of data right here, okay, in the allocations. This is step 2. I'm going to use, again, $100,000 in this example and take this 100K and allocate it to those 30 stocks depending on what the portfolio optimization methodology is going to recommend. So we're processing the first month going back 10 years, right back to 2015. It is March 2025, March 8th, 2025. So we're going back in time, 10 years, and processing this step by step. It runs pretty quick. It'll take a minute or so to finish off here. Okay, so basically at this point, we already pulled in the 10 years of historical price data. We're doing the portfolio optimization 120 times here. In each month, we're taking the best stocks, applying that to the portfolio, trading those stocks. Any stocks that are losing are getting dropped off the portfolio, right? And we take the proceeds from the stocks that we sold to buy the new stocks that are recommended for the current holding period. But again, it's still 1 month back. We're looking back 1 month because we can't look forward. It's impossible. So I think we're about halfway done. We have to get to 2025. March probably ends in February, right? Because this is the beginning of March 2025 now. Okay, we're about halfway done. And then when we get that, we can compare this optimized portfolio month by month by month. We're doing monthly rebalancing. That's what we're doing right now with the buy and hold portfolio where we bought equal number of shares, or we took the 100,000 divided by all of those stocks in the portfolio, those 30 stocks that we recommended, and bought probably maybe like 12,000 invested into each stock. If the stock price was a little bit lower, for some stocks they're going to be higher, the price is going to be lower for others. You buy more share of the cheaper stock and fewer shares of the more expensive stock, right? But we equally allocate the 100,000 among those 30 stocks. Not buying the same number of shares because the price per share will be different, but the same amount goes into each bucket. So probably about 12,000 or so into each bucket, whatever 100,000 is divided by 30 stocks. What is that calculator? Because so say I'll see. Let's see, 100,000. 3,300. Oh, 3,300. That was way off. I said 12,000. You put about 3,300 into each portfolio. Okay, so I have this done. That's step 2 of 4. And these are all the buy-sell transactions over time too, right? So you see February 2025, it's actually getting, we're in March 2025 right now, right? So it's getting these, this would be the last one, and this is the cutoff here. You can see the total portfolio value is 281,000. We started with 100,000, so you made 81,000 over, 181,000 over 10 years. This is step 3 of 4. So this is the benchmark. This is the, this is the S&P 500, right? So we're just buying the S&P 500. This is 500 stocks, and we buy that benchmark and hold it, and then compare that to what we would have gotten from the portfolio optimization, right? And S&P returns is that portfolio. S&P return is 286,000. Portfolio return is 282,000. I'm going to plot the results, and we get this line right here, which is pretty close. So the portfolio optimization actually came in just about the same, just a fraction under the S&P 500 buy and hold. But remember, we did that for 10 years, right? Now, if we go back and do that for less, let's do it for 5 years. We'll do 60 months here, okay, and rerun the whole process. So this is step 1 of 4, pulling in historical prices for 5 years now. Okay, this goes pretty fast. And the next part will go faster because it's half the time. It's only 5 years, it's not 10. So that's step 1. This is step 2. Okay, step 2 of 4. So this is the portfolio optimization. Again, doing month-end rebalancing. Anything that's a winner or performing, generating positive returns is kept in the portfolio. Anything that is actually bought but then generates a negative return gets sold out. And we use the proceeds from the sales to buy more of the stocks that were recommended by the portfolio optimization calculations, right? So that's what we're doing now. We go back to 2020 because this is only 5 years, right? So up to 2022, 2023 now. Then we will get the S&P 500 as a benchmark. You always want to compare this to some type of benchmark to see relatively how well the portfolio return performed according to some general market index. It could be the S&P 500. That's a good proxy. So that's what we're using in this case. Otherwise, you don't know. So if you get a 200% return on your portfolio optimization strategy, that's what we're doing here. Is 200% good or is it not good? I have no idea. I can't compare that unless I have some kind of proxy to compare it to, and that's going to be the S&P 500. So almost done here. Okay, and you can see 282 for portfolio optimization, 286. Oh wait, that was the old one. I have to refresh this. So that was 2 of 4. This is 3 of 4. Okay, 3 of 4 goes pretty fast at this point. 186K to 216. So actually, S&P outperformed the portfolio optimization tool, and you can see that in the chart here. So the S&P returns are a little bit better. 216. This is about 186. That's exactly what you see over here. 186. 216. And what if we did it even for a shorter period of time? I will go to 36 months. That's 3 years. So this is 1 of 4. This will run even faster than before, right? Because we're just going back 3 years in time. Okay, getting our historical prices. That is done. Let's do step 2 of 4. This is the portfolio optimization, right? And the auto month-end rebalancing process. Okay. So we can see the months ticking off there, chugging along. It goes pretty quick at this point because we're only going back 3 years, right? Then we'll move on to step 3 of 4. Again, that gets the proxy. So this is the S&P 500 compared to the portfolio optimization technique. We need some kind of basis or baseline for comparison. The proxy will be the S&P 500. And we get that. And we're done, right? Okay. 2024, closing that up, and 2025. Okay, 3 months into it, and that is done. And we have 3 or 4. So here's the S&P 500 proxy. Okay, and here's how they compare. So there's the portfolio optimization. This is the S&P buy and hold. And you can see again, the S&P 500 buy and hold strategy outperforms the month-end rebalancing and automatic trading and automatic rebalancing that the portfolio optimization tool did for us. So why is this? That's my question. When I ran this, I was kind of surprised because I thought the portfolio optimization tool would outperform the buy and hold strategy. But I ran this a bunch of different times, um, doing exactly what I just showed to you guys, using different time durations, and almost without exception, I didn't even see one time where the S&P 500 underperformed the investment strategy, which is pretty sophisticated, right? Because we're optimizing the portfolio with the best stocks that we can get, but the buy and hold outperform the sophisticated investment strategy every single time. And there's a handful of reasons. The underperformance of the optimized portfolio compared to a buy and hold is attributed to about three or four different factors. First, portfolio optimization, such as maximizing sharp return or minimizing volatility, aims to balance the risk and return rather than just maximizing returns, right? So, like I said before, you can get one or the other, but you don't really maximize the return. It's very rare. And you don't really minimize the risk. It's usually kind of a combination of those two, right? So, the buy and hold is going to have 500 different stocks, and over time, it tends to just outperform the optimization strategy time and time again, right? Also, frequent rebalancing in the optimization strategy can incur transactions costs, right, and tax consequences too. Every time you have a gain and sell it, you have to pay taxes on that. If you have a tax loss, you can use that to offset the gain, so it kind of helps you a little bit, but not significantly, right? And the S&P 500 over time basically outperforms this sophisticated investment strategy with no unnecessary turnover whatsoever, right? You buy the proxy, buy the S&P 500, and sit and hold on it, and that's it. You don't have to do anything. Very simple, very straightforward. If number three, if the backtesting period is coinciding with a strong bull market, a diversified portfolio with a focus on risk-adjusted returns would naturally underperform an index that includes many of the market's biggest winners, right? Because in this strategy with the blue line, we're only picking 30 with the 30 stocks. With the S&P 500, you have 500 stocks, right? And there's going to be some big time winners in that 500. Here, you're picking the best 30, but you're missing 470 stocks. And of those 470, some are going to be big time winners. All you need is a couple of big winners in your portfolio to really make a big difference, right? And fourth and last, factor exposure plays a role. Optimized portfolios may have higher allocation and lower volatility or defensive stocks, which can lag in high growth environments, right? So if we're looking at these top 30 stocks, maybe you don't have the top performers, and overall the portfolio is going to be optimized compared to the S&P, which is not optimized, but you're going to have so many more stocks that typically outperform these 30 that we're picking right here. You just can't compete. You just can't compete with the index, right? So ultimately, the takeaway here is S&P almost without exception is going to outperform even a sophisticated investment strategy like portfolio optimization. So there you go, guys. Pretty straightforward, pretty simple analysis. A long time ago, I worked in a firm where people paid my company a lot of money to do this type of stuff. And I'm not even kidding you. We charge customers like $500,000 to $1 million per year for tools just like this and a couple other things too. We did back testing, strategy simulation, of course, portfolio optimization, and a few other things. But in this case, really, you can do all this stuff all by yourself for free. You don't have to pay $500,000 or, God forbid, $1 million for a professional money manager to do this for you. You could basically just do it yourself. I'm kind of a DIY kind of guy, and I like DIY, do it yourself kind of stuff. So that's why I did this one. So there you go. Hopefully that was some useful knowledge I dropped today. Hopefully that was enlightening and educational and inspirational too. I am going to wrap up the video now, and I will see you guys in the next one. Bye. Hey there, everyone. Ryan Schul, Straight Data Science Channel. So today I want to talk to you about network analysis and clustering stock prices. Okay, so based on the historical performance of different stocks, we can create clusters and visualize and see how these different stocks um, perform or like cohesively interact together, right? And if it's homogeneous, it gets grouped together. That's what clustering is. If it's heterogeneous, then it goes into its own separate cluster. But there could be relationships or connections between the different clusters. So I think this concept is pretty interesting. I worked on this a few years ago, right before the pandemic hit, and just took everything offline. But I think, yeah, I think the concept is very interesting. So basically, the network is going to generate interactive network graphs, and we're going to look at how things change over a period of time, right? Because the stock market is very dynamic, it's always changing every day, every hour of the day, even every minute of the day. Stock prices are going up and down, right? We're just going to look at closing prices at the end of the day, so we're not going to see intraday prices. I don't have the access to that kind of data. But I don't think it matters anyways. I think like if you just get the end of the day in that snapshot picture, I think that's good enough. And we're going to look at the changes over time based on a month-to-month time frame duration. Okay, so what is a node? A node is basically a stock. We're going to look at nodes and edges. So a node is a stock. So it's one stock ticker. We're going to look at Apple, Microsoft, Amazon, JP Morgan, Walmart, Universal Healthcare, Verizon, or no, not Verizon, Visa, Procter & Gamble, and Johnson & Johnson. Okay, so we're going to look at these different stocks. The node itself is the stock, and the edge is the volatility or the change in price over time, right? So stock prices move up and down, they bounce around a lot, right? So the edge is going to be the volatility or the standard deviation or the movement of the price. And the no color is going to be based on volatility, and we're going to assign each stock to a cluster, right, using the k-means clustering algorithm. And we're going to use a network graph. So I've talked about this in a few of my other videos. Network graphing is a very interesting concept. It's almost like literally looking at yourself on Facebook and all your friends, that would be your network, and your friends of friends, that would be their network, and your friends of friends of friends, that would be like another network on a whole nother level, right? But how do all these different features or interactions, how are they combined together? So it's very fascinating, somewhat complex, right? But a network graph can help us understand these interactions over different levels, right? And different periods of time and different paradigms too, right? Like it can be a paradigm shift. And the edge colors are going to be reflected by the closeness of the volatility. So again, how similar or how dissimilar things are, how homogeneous or how heterogeneous things are, right? So I put together this code, I tested it, tried and tested it, debugged it, and you will see this in many of my videos. I'm importing data from Yahoo Finance, and network X is the network algorithm that I'm using. So I'm going to go ahead and pull in historical data. We're going back 36 months. So this is a variable. You can change this. I think 36 months is a good time frame. You can make this 12 months. Obviously, that's 1 year. You can make it a couple of years, 3 years. I'm looking at 3 years. You can go back 10 years in time. It's really up to you. This is a variable. You choose this. You choose this. This is arbitrary. So we're looking at the going back in time from today. Okay, getting the current day and time, going back in time for 3 years. That's what we're doing. And we're going to import all of this data. I just hit Control Enter to refresh. I'll do it again just to make sure, just for peace of mind. Okay, so you can see everything that has the same color is relatively the same. We have JP Morgan, Walmart, and Apple. So these three stocks basically perform the same going back in time for 3 years, okay? And we're not looking at too many different data points or different levels of interactions. There's all kinds of different things we could potentially look at. I'm just keeping it simple here. Just looking at the prices over time and the variability, and JP Morgan and Walmart and Apple perform pretty much the same. Visa and Microsoft are both yellow. They perform somewhat the same. Johnson & Johnson, Amazon, Procter & Gamble, and United Healthcare perform essentially the same, okay? Again, we're just looking at one variable, just the stock price, and there's all kinds of different things you can introduce in different analysis. I just want to keep it simple for this discussion today. So we can see these clusters. Everything that's blue is similar. Everything that's yellow is similar. Everything that is red is similar. I like these types of graphs. You can zoom in, you can zoom out. Very dynamic, very interactive, right? You move it around, and you can see that they all have a relationship to one another over this course of 3 years, right? So the course that we're looking at is a 3-year horizon. If you pick larger, smaller, then the graph is going to be different depending on what you select, right? So they're all kind of similar because they're all interactive. I'll show you in a couple of minutes here that it's not always the case, and these will change over time. But given a 3-year horizon, this is the clustering, and these are the relationships, right? So the blue groups, these basically
represents stocks that likely have moderate volatility and cluster closely together, meaning that they share similar standard deviations or daily returns or variance. So variance and the standard deviation are basically the same metric. One is the square of the other. I actually forgot which one is which. Let me look this up. Now I'm curious. Sorry about this. Going off on a tangent. Okay, give me a sec. Deviation and variance. Standard deviation is the square root of the variance. Okay, so that's the relationship. So you have the variance, you take the square root of that, that's the standard deviation. I forgot the definition, studied that one time ago. I'll do this every single day of my life. So that's it. So they're tightly coupled together, but they're slightly different metrics, but essentially the same. It's almost like taking inches and square feet, or square feet and or inches and centimeters, right? It's kind of the same type of metric. So the yellow group is slightly different because of the risk profile. It's probably lower or more stable volatility, right? So less bounciness, less choppiness. It's kind of a little bit more stable. So Microsoft and Visa a little bit more stable. The blue group have moderate volatility, right? Amazon, Procter & Gamble, United Healthcare, and J&J are grouped together, and these are basically higher, more volatile types of stocks. And again, it's just different patterns and different returns over time. That's all it is. And I'm going to give you guys all this code. What happened here? Something is not refreshing. Let me save this. Okay, last checkpoint. Let me refresh this. I'm going to give you guys all this code so you can copy and paste it and use this in your own Jupyter environment. Okay, so the refresh is coming up. Okay, so we have the graph analysis, and we had a couple notes. So I'm going to create monthly groups now because I want to see, this is over the 3-year period, right? So we know how these stocks interact with each other, but I want to see month to month to month to month to month, what are the different interactions, right? And plot each of these interactions per month. So I'm going to slice this up into a monthly frequency. This used to be frequency equals M. Now they change it to ME, right? So this is the update, and these things happen all the time. They always like make updates, things become obsolete, or they get abstracted away for whatever reason. I guess it gets more efficient and there's more improvements made. Used to be month, now it's month end. So when we get that, we can go ahead and create a small script over here that we can actually put into a Python file. So .py is Python. It's basically a text file, but has a .py extension, and we can create a volatility viewer. So again, I'm going to give you all the code. You don't have to, write down all your notes and try to memorize this or try to learn it. But the goal is to try to understand like basically what's going on here and basically what's happening, right? So you can make your own informed, intelligent, meaningful, practical, purposeful decisions, but you don't have to like understand every line, right? I'm going to give you this code and you can run it for yourself. So I will go ahead and copy and paste this into my own py file, and then I'm going to run it. So let me shrink this down just a little bit and get this guy out of the way. So I have viewer app.py, volatility viewer.py. Okay, so I actually have this file already. I tested it earlier. I would just copy and paste this code into here, okay, into a text file, and save it. Okay, save it on my desktop, and then I'm going to run it. So I did this earlier. I know where the file exists. All you need is a Streamlit run and your Anaconda prompt. You have to put this into Anaconda, Control Enter to run it, okay, and you will see Streamlit come up. It's going to pop up in just a second. It's very dynamic, very interactive. It's very interesting the way that this stuff is put together. So let me get Streamlit over here. Went into my other monitor, so I'll pull that over here so you can see it. Okay, and there we go. So now we have the slices of time month by month. So going back 2022, right? Because I went back 3 years in time. So this was a chart 3 years ago. Apple and Microsoft are together, and now you can see a different representation, right? So Amazon and JP Morgan kind of are grouped together here, right? And Johnson Johnson, Procter Gamble, Visa, Walmart, and United Healthcare are grouped together in the original, right? If you look at everything comprehensively, it's kind of a different view, right? Like remember this view? We just saw that before. So now things have changed because we're going into more of a micro kind of
scenario here, microclimate, where we're looking at everything month to month. So this is going back 3 years. So that was May 3 years ago. Down this is June 3 years ago. Okay, now Microsoft is kind of by itself. Okay, this is kind of off by itself, and then these are grouped together. So that's very interesting. Then we go into, that was June, then we go into July. We can see a different view. Now Microsoft is totally by itself, okay? And these guys are kind of coupled together. At least all the blues are in the same category. Procter & Gamble and Amazon are in a different bucket. Then we go into, what is this, August? Okay, now everything, now Microsoft is back with the group, right? And where's Microsoft here? MST. Oh yeah, that's the yellow guy. So it's still kind of like a problem child. It's still kind of off by its own, but it is linked to the greater group. And then we have September. This is the view. Now everything is kind of coming together. It's coalescing. So basically, the volatility is shrinking. Everything is getting more and more homogenized, more and more similar, but you still have these different buckets. So this is an interesting view here. So you have Apple, JP Morgan together, Walmart, Microsoft, and then PG, UNH, V, Johnson Johnson, and these guys are in red. They are together. Let's go into, which one was this? That was 10. Okay, let's go into 11. So now we're in November. Again, different view, different perspective on things. This is very dynamic. It changes constantly, right? The only thing that stays the same is change. And now we have a different view, and then we can go back to more recent times. So this is March. This was a couple months ago. Right now it's kind of like the end of May, May 23rd. So now we have a different view. And if we go to April, that was last month. Now this is interesting, right? So we have Apple and Verizon kind of off by itself. Microsoft is in between, but they're still co-joined. They're still together, still connected. And let's see the most recent view as of market close yesterday. So that would be 522. As of 522, now Visa is off by itself, and all these others are co-joined, right? And you have a red bucket and a blue bucket. So that's pretty much it, guys. That's how you create a dynamic interactive graph, charting and plotting, clustering of stock prices as they change over time, right? So I will go ahead and download this code and save it for you guys, and deliver that when I upload the video a little bit later today. Thank you so much for your time. I appreciate the time that you spend here. I try to make these videos informative and instructive and try to showcase things I learn as I go throughout my day and do different projects and interact with different concepts and different protocols, and just try to put together some code that I think is interesting and meaningful, and I share my findings with you guys. So that's it. Thanks again for your time. I'm going to wrap it up here, and I'll share the code in the video very soon, and I will see you guys in the next one. Take care, and talk to you soon. Goodbye.
Hey there, everyone. In today's teaching lesson, I want to take a look at network analysis of stocks and graph analysis of stocks. And we're going to use Python as always. I always use Jupyter Notebooks for all of these teaching sessions I do, and I will share the code with everybody. So you don't have to worry about taking notes or trying to memorize all of this stuff. I will post all the source code when I post a video, so you can download that as an HTML file, and you can open that and copy and paste it into your own Jupyter notebook, and you can see exactly what I'm seeing. You can do the same analysis I'm doing, and of course you can change the inputs and the features and the type of analysis, right, to suit your needs. So I try to make all these things pretty generic, but try to illustrate the point that I'm trying to focus on here, and trying to make this generic enough so you can plug in your own specific requirements, right, and solve your own specific problems. Because your problem might not be exactly the same as my problem. It probably won't be, but it'll probably be somewhat similar, right? So I try to make this pretty flexible so you can copy paste, run this as needed, and then input your own specific parameters or requirements or constraints, right, and solve your own specific problems. So network analysis of stocks emphasizes the relationship and a connection between stocks using graph theory to analyze how they're linked together, right, based on shared characteristics like return and volatility. These are two things that we're going to focus on today, returns and volatilities of stocks. But it could be anything. It could be any kind of fundamental feature. It could be return equity, return on assets, price to earnings by growth peg ratios, right? Price to cash flow, like any kind of fundamental feature. I have another video that explains everything about stock fundamentals and how to do analysis of different stocks using fundamental analysis. I have a video on technical analysis. So there's a bunch of ways to look at this. But today we're going to focus on just returns and volatilities. But of course, you can do this any number of different ways, right? So we're going to look at the relationships between different stocks, and again, focus on returns and volatility. We're going to look at how stocks are interconnected, and how they react either similarly or dissimilarly, right? And the application for this is network analysis. Usually involves investing systemic risk. So systemic risk is market risk that will affect the entire stock market, right? Like specific risks are specific to one stock. Apple, Microsoft, Cisco, Walmart, Ford, right? Whatever specific stock that is specific to the individual company. Systemic risk is for the entire market, right? Like you saw a big crash in 2008, 2009, the global financial crisis. There's a systemic risk when the dot-com sector blew up in early 2000. We saw systemic risk during COVID. So these are things that affect the entire market, and that is easily detectable using network analysis. And we can visualize the results. We're going to see this in just a minute, how this works, and the nature of connections between these different stocks. Graph analysis is a little bit more theoretical. It's very focused on mathematical frameworks, and the applications are broad to graph theory, structures, properties, and mathematical algorithms associated with these graphs. And the data representation involves nodes, edges, and analysis is highly focused on mathematics and the connectivity between different coefficients. Remember, we're focusing just on returns and volatility. Well, again, it could be anything you want. So I'm going to import some data from the web right here. This comes from, where is it? Pandas data reader. Okay, so this is the main library that imports all the data. I'm going to import data from this list of stocks. We can tell it's a list because we have the square brackets here. This could be a dictionary. This could be a data frame. Doesn't really matter. I think a list is very easy to work with. It's very flexible. It's comma delimited here. So we're going to feed that into this Pandas data reader and import the data from the web. Okay, and we are going to go back 6 months in time. Okay, so I'm getting daytime now. This function gets daytime now, and I'm subtracting 6 months back. So we're going back in time for 6 months, and we're going to pull in a ticker, the date, and the adjusted close price, right? So it's not real time. This is closing market price for the last 6 months. We can see I just ran the script in the cell, and this is 10/3/2024. So that is actually looking 1 day ahead. I probably have to subtract 1 day. Doesn't really matter for our purposes here. I'm going back in time 6 months. So it goes back to April 2nd, 2024, and we import all the data, and this is what it looks like. Okay, so we see the adjusted close price. We did a pivot, data frame pivot, to get it into this shape, right? So we see Apple, Amazon, AXP, BA, I believe that's Boeing, Caterpillar, CRM, Cisco, Disney, and so on and so forth, right? So this is pivoted, and if we go ahead and run this cell, we will see all of the returns, right? This is very easy to calculate. Returns is table.%change.mean times 252. There's 252 trading days in 1 year. And to get the volatility, we're doing table change dot standard deviation, right? So standard deviation and volatility are the same thing here. And we're looking at the square root of 252, again, the number of trading days in a year. And we see this in alphabetical order. So Apple, Amazon, down through Verizon and Walmart, right? And we can do the same thing. If I hit Control Enter, this will refresh this data frame. And we are looking now at the sorted data frame in descending order by returns. So here we have Triple M, Walmart, and this is annualized, so 85% return. We're just looking at 6 months, but we're annualizing over the year. That's why we did times 252. This is 64% return. So decent return, right, in 1 year. But again, annualized. So this isn't the guaranteed return, but we're trying to sorry, I've got a bit of a cold. We're trying to standardize this in a format that traders and investment managers and people that work in capital markets can understand. So everything is always annualized, right? We get into this format, so it's standardized. So INTC is negative 1.1%. Disney is dismal. In this case, CIS could be dismal, but don't really know. And Boeing, I think BFA, I always think that's Bank of America. I think it's Boeing, 0.33 negative, right? Let's look at a correlation plot here. This is pretty standard in the investment analysis world, right, to look at correlation so we can see how well correlated or how non-correlated these stocks are. So on the diagonal, you always see one, right, because Apple is 100% correlated to Apple. Amgen and Apple have a 0.31 correlation. So the darker the color, the higher the correlation. The lighter, the higher the correlation, the darker is negative correlation, right? So some of these are highly negatively correlated and others are positively correlated, right? Based on the shading or the colors here, right? So 0.88 AXP, I think it's 8 AXP. If I go down here to GS, it's Goldman Sachs. Pretty high correlation for this guy over here, right? So I'm looking at 0.88. So AXP and GS have 0.88 correlation. So that's very interesting. These two stocks should move together over any given point in time. I have other videos put out about pairs trading and how to make predictions on future stock prices. So this is very relevant to that type of analysis, right? And very useful to see these types of correlations. So I'm going to go ahead and refresh this, Control Enter, and I'll share all the code with everybody, all right, as soon as I post a video. So what are we looking here? What are we looking at here? Network analysis, and we're looking at graph analysis at the same time, right? So I think network analysis is a little bit more relevant. This is more practical. It's more hands-on. It's more feature enriched, and this is how you solve real problems in the real world. Graph analysis is a little bit more mathematical. It's a bit more theoretical. They're similar, but I think in most cases, in the investment analysis world, where we're trying to make real money in market in real time, we really want to focus on network analysis, right? So that's why we're using this approach right here. When I refresh this, I can see how these items are clustered together, right? So if I move this around, this whole cluster moves together, right? You can move it back and forth. All right, and this cluster is going to move together. If I move this, the others get out of the way. Okay, you have to move because I'm coming through. Look at that. So we can see here the different clusters, right? Amgen is by itself. Walmart is by itself. If I move this, the cluster has to move a little bit. So we're cooperating because that's a small guy. This is a big guy, right? So it has to get out of the way. All the other small guys have to get out of the way. So what does this mean when I run this? We can go ahead and visualize the results there, right? And let me do one more so we can see what the actual returns are based on these clusters over here, right? So we have Johnson & Johnson, McDonald's, Coke, Procter & Gamble, and Merck, right? And Merck has negative return, 0.222 and 0.23 volatility. If I go up here, I want to see negative 0.22 and 0.23. So where is that? If I look to the alpha MRK, negative 22, it's rounding, and 0.22. And let's look at one more. Triple M is 0.85 return, so decent return, 85%. If you put in $100, you'll make $85 at the end of the year, and 37% volatility. So this is 0.85, 0.37. Let's go down here. Where's MK? 0.85, 0.37. Oh, is that right? Yep. So it's rounding. So 0.86, it's rounding up to 0.37. So this is the triple M, right? This is the cluster for this. So why is this important? If we go down here, we see the different clusters. You can see cluster number 4 has McDonald's, PGKO, J&J, and MRK, right? So this is cluster 4. All right, so that's cluster 4. This is the largest cluster. This has Honeywell, Caterpillar, Home Depot, IBM, Cisco. If we go down here, we'll see that here's Caterpillar, Cisco, Honeywell. Great, and this is cluster 1. So this is the largest cluster. Walmart is all by itself. That's cluster 11. Walmart is right here. All right, we got 0.64 return, 64% return. If you put in $100, you make $64, and volatility is 0.19. So 64 and 19. Go up here, we'll see the same thing. 64 and 19. Right, so everything matches up perfect. It's doing exactly what we told it to do. And then look at the returns, right? So cluster 1 has return of 6%, a little bit positive, not great. Cluster 2 has an average return of 35%, so much better. Cluster 3 is negative 49. I don't want to invest in that. Cluster 3 is what? Disney. If we go here, Disney, yep, we saw this before. Disney looks dismal. DIS could be short for dismal or for Disney. 0.8. 0.48. You put in $100, you'll lose $48 by the end of the year. Who wants that? Nobody wants that, right? So this is pretty cool. We are getting the best return from Walmart cluster 11. So if you put your money into cluster 11, pick up Walmart, and just to diversify a little bit, cluster 8 is United Healthcare. So that is good. If I go up here to look at UNH, what's it doing? UNH is 55%. So you put in $100, you make $55 at the end of the year, right? So that is pretty cool. So I'd probably spread my money between Walmart, cluster 8, which is United Healthcare, and let's just pick one more just to be a little bit diversified. Cluster 2, the average return is 35%, and cluster 2 is Amgen. So there you go. You have 3 stocks. You can be diversified and get decent returns if you take the weighted average of this cluster 2.35, 0.86 is cluster 5. That's triple M. Actually, that triple M is a little better. I'm looking at this now. Probably triple M. Cluster 8 is United Healthcare, and cluster 11 is Walmart. So if you pick Walmart and United Healthcare and triple M, you'll have diversification. You're probably going to get about 50% return on your money. Put in $100, you get 50 after 1 year. This is all annualized, right? We standardize it into an annual rate just to make the comparisons easier, right? So in this case, we're looking at network analysis of stocks and graph analysis. The overall emphasis here is on network analysis. It's a little more practical, so a little bit more rigorous, a little bit more robust. Graph analysis is a little bit more theoretical. It still works, but I think the best approach here is to use network analysis. So again, this code is designed to be very flexible, scalable. Now, you put in your own tickers here, whatever you want. It can be anything that is covered by Panda's data reader, and they have, I think, around 50,000 different tickers, 50, 60. Pretty comprehensive. It's not going to be everything. It's not going to be some weird penny stocks or some weird international stocks, but they do have good coverage, right? So you pop in any tickers that you want, do the analysis. The only thing you'd have to change is the input tickers and the months back. I'm looking at 6 months here. This is somewhat arbitrary. It could be 3, 6, 9, 12. You can go back many years. You can go back 5 years, go back 10 years if you want. Some of these tickers maybe weren't around 10 years ago. But I like 6 months, honestly. Like, that's my personal preference, to go back 6 months. What was happening 10 years ago is not as relevant as what's happening right now today. And I tend to focus more on recent events, not primal events or primacy. I tend to focus more on recency. So what's happened in the last 6 months is more interesting to me than what was happening 10 years ago. But of course, you can change this number of months to be whatever you want. So I think that's pretty much it. I think we beat this horse to death. We proved what we want to prove, and the analysis was pretty thorough, pretty rigorous, and this did yeah, exactly what we wanted to do, right? So hopefully that helps you. This is not investment advice, okay? Just explaining how to do network analysis of stocks and how to understand the overall returns and diversification in your portfolio, right? This is not investment advice, so don't get angry if you pick stocks and you lose some money. That's not my fault. It has nothing to do with me. I'm just explaining the theory and the concept here. That's it. So don't come after me and try to sue me or get angry at me or whatever. Okay, it's nothing like that. But this does illustrate the point of investment management, investment analysis, how capital markets work, and how to pick a return, pick a portfolio based on the returns, and make sure that your portfolio is diversified, right? So you're not concentrated for one or two stocks. You have at least three or more stocks in your portfolio to be diversified, right? Okay, so that's pretty much it. Thank you for your time today. Enjoy the rest of the day ahead. Bye.
Hey there, everyone. Ryan Schul here. Welcome to my channel. So, in the topic today, I want to talk about sentiment-based portfolio rebalancing and show you how you can develop a strategy that's pretty straightforward, pretty easy, pretty comprehensive, very transparent, and actually beat the benchmark, which I'm using as the S&P 500. So, if you've watched several of my other videos, you've seen that I've made several, quite a few actually, about investment management, different portfolios, different investment strategies, and so on and so forth. There's a bunch of them on the channel at this point, dozens actually. So most of those videos, I'll compare the final outcome of the strategy to the S&P 500, and in many cases, almost all actually, we cannot beat the S&P 500. It's just easier if you just invest in the S&P 500, just let it go, don't worry about it, and you will outperform most of the strategies that professional money managers come up with, right? So that's just the way it is, and there's various reasons for that, right? S&P 500 has broad exposure. You're getting access to everything. If you pick a portfolio with a few stocks, you have those stocks exposure. That's it. Like if you have 20, 15, 30 stocks, whatever it is, I don't care what it is, you have exposure to those. You don't have the broad index, right? With the S&P 500, you have everything. So it doesn't go up as fast, doesn't go down as fast. It's kind of even keeled, but on some good days, and you have some very good days in the market, you have a handful every year, maybe 4 or 5 very good days where you'll get most of your gains, right? If you're in the market for those 4 or 5 days, whatever that is, nobody can predict it, you will make a lot of money. You will have a few days where you lose a lot, but in between, you kind of bounce around. It's kind of choppy. You make some money, you lose some money, but overall, like for the most part, S&P 500 beats most investment strategies out there. But with this strategy, I found actually you can outperform the S&P 500. So let's jump in. Let's go all in on this and see what's going on here, okay? So why would we even want to create a sentiment-based portfolio rebalancing tool? There's several reasons, like I just alluded to. Capture real-time market sentiment, complement traditional factors like price to earnings, fundamental factors, price to sales, price to cash flow, earnings to, what is it? PEG, price earnings divided by growth, things like that, right? You have all your fundamental factors baked in automatically, right? You get that with this kind of with this kind of tool because you're looking at the news, right? The news captures everything. So captures all the fundamental, all the technical information, right? What are insiders doing? What are corporate insiders doing? What are C-suite executives doing, right? This is all picked up and aggregated by the news and relayed or transferred to us, right? So we can read it. And we're using some ML techniques and some data science methodologies to take that, understand what's going on a large scale, and then translate that to investment ideas, right? That's what we're doing here. So this should help boost the performance of the portfolio based on news-driven market events, convert qualitative into quantitative actions, right? We're avoiding negative exposures like defense behaviors or investor psychology, where people are very reactive to what's the market doing. You're always going to be a little bit behind, right? If the market is up and you try to jump in, you've already missed some of the moves, right? If the market's down and you're trying to sell furiously, get out of those positions, you've already lost some money, right? You've left some money on the table. So you're reacting, right? You don't want to react. You want to be proactive and get ahead of it, right? So this should help us make better risk management decisions. And we can go ahead and do scenario testing and live updating. We'll see that in just a few minutes how this works, right? So I'm going to go ahead and capture some information from Yahoo Finance, Control Enter to run the cell, and they have 50 articles. So Yahoo basically caps it at 10 articles per request. So I have a list of tickers here. I have 5 tickers. I'm looping through all the elements in this list, and it's giving me 10 results for each request. Now I'm asking for 100. I'm saying, give me the first 100. Yahoo Finance says, no, 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 no. I'm not going to do that. I'm going to give you 10. That's it. I'm capping it. I bumped my head on the ceiling at 10 just because it's capped off, right? But I think there's a better way to go ahead and capture news events, right? So this is all coming from Yahoo Finance. I did a little research. I found another source for information. This is called News API. This is the URL to get access. You have to go ahead and request access. It's totally free, so go for it. You can get the API key right here for free. Once you get access to that, you can pop in your API key and run this. Now, I can't show you mine. I can't disclose it. I can't give you my key. This is personal and confidential. But go ahead and apply for your own key. It's totally free. Takes less than a minute to set up, probably 30 seconds to be honest. Then you can go ahead and loop through all the elements in this list. I have the same list of tickers, and you can go ahead and request a bunch more news articles. So we're getting all the news articles down here. You can see that. I'm going to compress this just a bit, just to shrink this down a little bit. So we can go ahead, once the information is imported, and we're going to switch back to Yahoo Finance. Remember, the first request came from Yahoo Finance. That's what this is doing right here. The second request came from this News API. I'm going to go back to Yahoo Finance and just grab sentiments based on the contents of that news. So a sentiment is defined as greater than 10% polarity. This is going to be 10% polarity. I'm going to assign a positive label to that. Less than negative 1%, I'm sorry, less than negative 10%, I'm going to say that is a negative news article, and anything in between the positive 10% and negative 10% is going to be neutral. So everything in between is neutral. So we have 3 outcomes: positive, negative, and neutral. So switching back to Yahoo Finance, I have the original 50 articles, and I can go ahead and do the sentiment analysis on those 50. Now again, 50 is kind of small. I want to get more than that, but just to show how this works, we have positive here, neutral, 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 neutral. This one's actually negative. Berkshire takes Kraft Heinz write down, operating profit fall. So yeah, guys, that totally makes sense to me. That's a negative, right? This is positive. Profits drop at Warren Buffett's Berkshire Hathaway's writes off its Kraft Heinz. But that kind of sounds negative, to tell you the truth. But it did get greater than 10% positive sentiment rating. So let's see why. This one sounds a little bit counterintuitive, but these machine learning algorithms don't really make mistakes. So why would that be positive? Maybe it's picking up on this. Earns 12 billion. That's pretty positive right there. Although it did take a write down, 3.7 billion. So they basically sold it, right? They sold off their positions and exited that. Berkshire's earnings can swing wildly from quarter to quarter because it's to record the current value of its massive portfolio. Operating earnings were down slightly. That one sounds a little bit weird. That one does sound kind of negative, but it is getting a positive review. But that's okay. I'm going to go with what the algo says, right? It is saying that the polarity is positive 10% or greater. That's why it's getting the positive right there. This sounds neutral. Third quarter earnings. It's just reporting earnings. This is neutral. Neutral. This one's positive. Stock market. That's like tank as market confidence cracks under Trump's tariffs. Weak job. Yahoo Finance. Again, that one sounds kind of negative, but it's getting a positive rating. So let me take a quick peek at this one, and then we'll move on. I'm just trying to understand here the logic behind these sentiment ratings. Oh, okay. So Yeah, the market was down like 600 points yesterday. That today is August 2nd. Yesterday was the 1st. Dow fell 600 points, more than 500. Yeah, 600. S&P down. Okay. Week job report. Okay, okay. Um, so it's doing what it's supposed to do, I guess. I'm not sure why that is getting a positive rating, but it's finding something in there that is resonating as positive tone or positive sentiment. So that's why it's triggering that. I'm not sure what offhand, but that one does look a little bit funky. I think the rest of these make sense. And again, like it's just doing what it's told to do, right? It's just like it's just a machine here. So I'm telling you, if the sentiment is greater than 10%, it's positive, less than negative, 10% negative. So it's finding something in there that's positive. That's all. Big tech has spent 155 billion on A. That's positive. Okay, that's positive. Jim Cramer, the AI business of fire. Yeah, yeah. I could listen to that guy. Saw something on YouTube. If you invest in all the stocks he says to sell, you would make a lot more money than if you invest all the stocks that he says to buy. So I have no credibility. This guy has no credibility based on what I'm seeing. Jim Cramer is just a quack fool. Anyway, so a lot of it is neutral. We have some positives and we have some negatives. Okay, so I'm just gonna call it out. I think this makes sense. I think it's doing what it's supposed to do. It seems to be right. There was a couple that looked a little bit funky, but I'm going to go with it. All this thing is doing is just following the logic. If the polarity is greater than 10% positive, if less than negative 10% negative, otherwise neutral. Okay, so very straightforward logic. I'm just going to go with it. So same thing over here. Slightly different methodology. So the way that Yahoo News comes in the way that this API news client pulls the news is slightly different. Again, pretty similar, just a little bit different. Here we have more articles. So instead of just, what was the other one? 10 per ticker. Now we can get 100 per ticker. So I see Apple has 100 right here. The next ticker is Microsoft. So Microsoft, a lot of these are neutral over here. Some positives. Microsoft is right here. We have 100 articles. So that's good. So the difference between these two is Yahoo is totally free. API, News API is totally free. But you get 10 times more news articles for the News API. That's why I switched over to this one. So Yahoo is free, easy to use. This one is also free and just as easy to use, but you get 10 times more information. So you have Microsoft, 100 articles, which is better than 10. Then you have Google down here, and we have 100 articles. So before with Yahoo, we got 10. Now we have 100, so that's good. Over here, we get Amazon. Amazon is next, and that gives me 100, so I'm happy with that. Before I had 10, now I have 100, and the last one is Meta. So Meta is giving me, I think I saw it, 99 articles. Okay, so I asked for 100, they gave me 99, pretty close. I think basically it's only 99 articles out there, and these things are very dynamic and changeable all the time. New news is coming out, old news is dropping off. So when I fetched this data set and I made this request, they had 99 articles related to Meta at this time. If I rerun it, maybe I'll get 100, maybe 98, whatever. So you get what you get. It's going to be close to 100. It's capped at 100. Could be a little bit less, but it's pretty close, right? So we have like 499 news articles here, and I'm happy with that outcome. So again, you have to get the API key. I can't give you mine. This is personal and confidential, but when you get your API key, plug it in there. I'm not going to rerun the code just because the key is not there and it's going to crash, right? But when you get this, you'll have the raw sentiment scores, okay? So this is the sentiment scores for the news API key that I just showed you, right? These are the sentiment scores here. Based on that, we're allocating this amount to the portfolio. So if I put in 17% to Apple, 17.3% to Microsoft. Google gets 31.95. Amazon gets about half that, 14.29, and Meta gets about 19.73. Now that is the amount allocated to these portfolios. The total right here is 100%. You can see sum is 100% equals sum. That's 100%. And that's the allocation or the breakdown for those stocks in those portfolios. Now, if I switch back to Yahoo Finance, I like both. The only problem with Yahoo is it's kind of truncated here. It just gives you 10 articles. It's not a lot to play with, but you can go ahead and run the code and get these 10 articles, then do the sentiment analysis on these 10, and then allocate the stocks in your portfolio based on the positive, neutral, or negative sentiments for these stocks. Okay, so again, the cap is 10 here, so you're only going to get 50. Here's the sentiment score. So score, adjusted score is basically the same thing, right? The weight of the portfolio based on the score. So more money is allocated to this stock because the weight is higher and there's more positive news articles, right? So if you look here, this is 7 through a negative, 0 neutral, right? So most of the money in this portfolio, 333,000, 33,333 is allocated to Meta. Now, this is the worst performing stock based on news sentiments, right? Based on news articles and what the public is saying. Now, you only have 4 positive, 4 neutral, and 2 negative, okay? So you have 2 negative here, over here, 0 negative, 7 positive, 3 neutral. So less to allocate to this portfolio. It gets 9.5 and $9,524 is put in. So we started with 100,000. You can see that right here. If you rerun this to 1 million, if you do 1_0, then you'll just reallocate everything based on that 1 million that you put in there, right? So now you have 333,000 invested, 238K, 190K, 142K, 95K, right? So it should hopefully make sense. More positive news, higher weighting in this stock right here, more negative news or less positive news and less weighting. So hopefully that's straightforward. Again, you can go ahead and plug in your API key. I showed you how to do that. You have to apply for that and get that key. Obviously, I can't share my key with you, but again, you'll get kind of similar breakdown here, slightly different methodology. Again, this is the API, the news API, I think it's called, news API client, right? And over here, we use Yahoo Finance. So different sources, slightly different methodologies. You can see here, Meta comes in number 1. Apple had the least favorable news. So I can't run this because I don't have the key plugged in. Go ahead and get your key and you can do this. Now you have Google coming back as number 1. Total score is 100. The weight is 35%. Here's 1916. This is sorted in descending order. That's what this line does right here. You get everything calculated, all the sentiments applied, all the weights plugged in there, and then you print everything in the data frame in descending order. So here, Google is the number 1 pick, and Amazon only gets 13,000. But again, if you copy and paste that into Excel, you'll see the total adds up to 100,000. Because that's what we start with over here. So I put in 100,000 here. I just changed it to 1 million, but you can put in whatever you want, right? Anything in between. I put that over here. This is the key, right? Or the index rather. That's the index. So if I sum this up, I get 99,999, right? So it's rounding, basically 100,000 equals. And obviously, if you have like 250,000 to invest or 500,000, you just put that number over here, update that, or over here. Where is it here? 100,000 for this one, right? That's the Yahoo portfolio. So here's the takeaway, right? In pipeline number 1, we have the news API. These articles come from the different media outlets. I think it's called Associated Press, the AP. And I think what they do is sell these news articles to different stations. And I think if you go around the United States, I think like 60 or 70% of the news is exactly the same because they buy it from the Associated Press and they run it in the local markets. That's what they do, right? So a lot of the stuff is recycled or just replayed on local markets, and they feed in like a little bit local news in between there. So these things are basically the same. You have the score, average, polarity, fine-grained granularity. I used to work with somebody that couldn't pronounce that word very well. They always call it granola. They say, we need more granola. We need more granola. They're talking about granularity. So it was pretty funny. That was a running joke in the office. We need more granola. We need better granularity. That's what the person meant. Effect of one, negative minor. Google looks best in this case. In the first case, Meta looks best, right? So Meta's coming out number one over here. That's Yahoo Finance. This is actually pipeline one, and this is two. I think I got this wrong. Okay, so whatever. And then just slightly different methodology. This is score positive, negative, divided by total, and this is course 1 to 5, and this is 0.1 to 0.4, right? So similar but different, but it does have an impact on how you do the allocation for the portfolio, right? So now I want to show you how to implement this strategy and actually use this to back test these ideas that we just experimented with and see what the outcome is. So I'm going to go ahead and just set a date range. I'm going to get 1 year of historical data, 2024 beginning to 2024 ending. So the entire duration of 2024, just a random year I picked. You can look at different years, 2023, 2020, it doesn't matter. That's kind of a bizarre one with all that COVID stuff. Remember that? That was so much fun. The fun is going on every single day is a COVID day for me, even though I got my vaccines and a lot of people got it. Some people got fake vaccines, believe that or not. I don't know why you would even do that, but some people did the fake vaccine, and the thing was just complete nonsense anyways, and our elected officials completely failed us. So I don't want to talk about COVID anymore. Kind of sick of it, but it's still here for me. It's still every single day is a COVID day. Maybe it'll end one day. I don't know. Got the vaccine, nothing changed. So I want to take this investment strategy, back test it, and see like what could the actual return actually be if I invested in these stocks based on what I saw above, right? So we have Google, Microsoft, Apple, Amazon, right? So I want to take the sentiment weights. So that comes from here. Control F comes from here, right? If I go back here, my actual weights. Oh, okay. So it comes from this data frame. That's why. So data frame to dictionary. I'm creating a dictionary of weight. This is going to be a key value pair. So the key is going to be the ticker and the value is going to be the weight. So basically I'm taking Google 35%, Apple 19%, Microsoft 16%, Meta 15%, and Amazon 13%. Okay. So I'm going to put that into the portfolio weights. You can see that down here, 35% from Google down to 13% from Amazon. Okay, there's the 13%, there's the 35. If you look close, there's the 35, there's the 13. So hopefully that makes sense. So we ran the analysis, right? We got all the sentiments, we got all the weights, all the portfolio allocations. We have $100,000. This is how we're going to spread it around 35, 19K, 16K, 50K, 13K. Those are the weights based on this down here. The cumulative return for 2024, right? We started January 1st, 2024. Market's actually closed, so the trades will go in on the 2nd, and you go into December 31st, 2024. That's the end of the year. If you did that based on these strategies, you would make 40% return. The annualized return is 1 year, so like the same thing, right? If you did this portfolio investment for like 1 month, we would annualize it. The reason we annualize is to get everything on one common standard or normalized or standardized, so everyone is looking at the same thing. If some guy says, hey, made 8% return, well, what does that mean? Is that 8% in a day, 8% in a week, in a month, or in a year? Those are all different things, right? If you get 8% a day, that's great. I'd sign me up for that. I want some of that. If you get 8% a year, that's okay. It's just average. It's just normal, right? But you have to annualize your returns. If you get 8% per month, every month, that's going to be a huge return. It's 8%. Forgot the exact calculation. You have to raise it to the power, divide by the number of months, right? But 8% per month for 12 months is way more than 8%, right? 8% per year is 8% annualized. So that's why we annualize it, just to get everything in one unified form that everybody can understand. Maximum drawdown is maximum loss, 14.64%. So that is the back-tested strategy. So we know that this works. I want to compare that with the S&P 500. Same time period. So start date is going to be portfolio value index start time. If I go back here and look for that, here's the portfolio value, right? So everything is dynamically linked together and tied together. So it's very easy to make these updates. I could change this date, the start date, and the end date, and everything is going to flow. You want to make these things automated. I spent 10 years on Wall Street working in the automation business, and basically my whole job is just to make everything as seamless as possible. You click a button and all your work is done. Now it's called artificial intelligence. Before it used to be called automation. So we have the start date, the end date, and this is the S&P returns. So you can just print out the returns. You see what this is. And we normalize and standardize everything to get on the same scale. Because if you look at the S&P 500 data, it's going to be very different from your portfolio data. So if I just take a quick peek over here. Okay, and let's just look at one Google and add an S&P 500. Get that one. That's a ticker. I can never remember that. GSPX. Okay, I'm just gonna go back and look. I never remember this thing. It doesn't make sense to me. GSPC, whatever the heck that is. So why wouldn't that even come up? I mean, I typed in the whole thing right there. Okay. Now it gives me just that one. Okay, that's fine. That's fine. Okay, this should work. That's good. It's fine. So Google, you see, it's $189. That's the dollar per share. Apple is pretty close, 202, but S&P 500 is way different scale, 6,238 to buy one share of this. And I think you can invest directly in the S&P 500, or you can invest in a portfolio that simulates that. That would be an index fund, a low-cost index fund. I think you can invest in the S&P though, if you want. The VIX you cannot. I know that the VIX is a volatility index. So anyways, these are very different scales. You have 206,000, right? So like 30 times more or whatever that thing is. So we really want to take that and just basically normalize everything. That's what these two lines are doing, just so you can compare apples to apples. Because if you have a little move in $6,000 stock versus a $200 stock, things get kind of funky and kind of weird. You want to just normalize it just so you're working with the same kind of relative base. I guess you could call it base. You just want to compare apples to apples and not apples to pumpkins or watermelons or whatever it is, right? So we get everything normalized. Then we can go ahead and look at the results. Here's the final outcome here. So you can see the portfolio got about 100. You start with 100K, you finish with 139.89, so almost 100, almost 40%. And these are Plotly charts, so you can zoom in and see the details, right? Here's 140, so it's like 40%. This is about 25% return. Double click to zoom out. So with this strategy right here, we actually outperform the S&P 500. So that is very interesting to me because I have several other strategies I discussed on my channel where we could not outperform the S&P 500. It's very hard to beat this thing, right? Very, very hard to beat the S&P, and I've proven it. And you can go check out those other videos. It's all on my channel. You can download the code. I shared all the code. You can download it, run it for yourself, and you can see exactly what the outcome is. So this is pretty rare that we actually beat the S&P, but based on the sentiment of the news and rebalancing the portfolio based on the sentiments of these different stocks that's coming to us in the news, right? Here's the weightings, here's the balancing right here, or the rebalancing, whatever you want to call it, the allocation, right? There's two different strategies here. This came from the News API client, and this came from Yahoo Finance. This strategy actually beats the S&P 500. So I was kind of shocked. I wanted to do the analysis just to see how things shake out. And I thought the S&P would outperform, but in this case, it comes up short. And the news sentiment driven strategy outperforms the S&P 500. So that was very interesting. Very worthwhile exercise. I kind of like this one. So yeah, I'm going to download the code. I will do this right now. I'll share the HTML file with you guys. I'm going to download that and post a video a little bit later today. I have some things to do in the afternoon, so I'll do the upload for this video. I'll drop the code so you can run it for yourself and you'll have everything you need. And I'll just close out here by saying this is not investment advice. Don't come after me and try to sue me if this strategy doesn't work. I proved that it did work. In this case, in this these stocks that we picked in this time frame that we selected. But the market is very dynamic, guys, and it changes all the time. So the strategy works, but I'm not telling you to invest in these stocks, right? I'm telling you the math. I'm telling you the statistics. I'm telling you the financial meaning and the purpose here. I'm telling you the data science, the machine learning. It's very basic machine learning, or data science kind of focus here. So I'm not saying that you have to do this. I'm not saying that you should do this. I'm just telling you the math and the statistics of how this works, okay? So don't come after me if you invest in strategy and it doesn't work out for you. I'm not doing this personally, but I think it's very interesting. I think it's fascinating to do the research and to do the experimentation and see what the outcome is. Although I will, with that caveat, having said that caveat, I will say this is one of the best strategies I've seen based on news. And most of the others that I've experimented with were basically failures compared to the S&P. The S&P outperformed most of the other strategies that I have discussed on my channel here. So you can check those out. I think it's all interesting, very educational, very inspirational as well. So I'm going to close up here. I'll drop the video shortly. I'll share all the code with you guys so you have everything you need to copy and paste it and run it in your own environment. And yeah, give me some comments in the section below. Give me some feedback. Let me know what you think. Okay, wrapping up here, and I will see you guys soon when I post the next video. Goodbye for now. All right, guys and girls, I got a good one for you today. This is the principles of financial planning, and we are going to use Python. Of course, all my demos consist of Python code, and I write out all the code and then run it for you. So you can see in real time how everything works. And then I have a bunch of notes. This is the standard format they came up with. I think this is useful. I haven't had any complaints. I haven't had any real positive feedback either. Maybe just a little smidge, but not a lot of positive feedback. But I think this makes sense, so I'll stick with this at least for the time being. So financial planning basically helps us to understand where we are at this point in time with our personal finances and then where we want to be in the future. So there's basically 5 pillars of financial planning. You'll have tax planning, insurance planning, investment planning, retirement planning, and estate planning. That's the 5th one. Okay, so I think all of these are pretty straightforward. I struggled a little bit with the estate planning exam when I took these tests, but I still passed on the first try. So yay for that. And this is not comprehensive by any means, but this is a good intro course, I think, to financial planning. What is it? How does it work? And it will touch on these 5 major topics and a few other subtopics as well. And of course, everything is in Python, so you can play around with it. You can modify the code to suit your needs and just roll up your sleeves and get into the code, dig around a little bit, and see how this stuff really works. So I think it's pretty interesting. Let's get to it. So why are we interested in financial planning at all, right? Why would we even touch on this type of subject matter material? There's a bunch of reasons. Basically, to improve financial control of our personal situation, to achieve our financial goals, to save for an emergency or to prepare for the future, right? Better risk management, tax efficiency. You should pay as much taxes as you are legally required to do, but not a penny more, right? So if we can minimize our tax liability legally, we should go ahead and do that. Increase savings and investment, debt management, peace of mind. That's important, right? Retirement security, legacy and estate planning, better financial habits, adapting to life's changes and crises that come up at a moment's notice, and maximizing financial growth. Okay, and there's probably a couple other things, but I think that touches on the major ones. So personal financial planning for budgeting, this is the first topic we're going to look at, involves creating a detailed financial plan around income and expenses, and this ensures stability of your financial needs. Okay, it allows individuals to allocate resources effectively and prioritize spending and track your progress to make sure that you are on course with your investment strategies, your investment targets, right? That's very important. I think Einstein said something like um, compound interest is the eighth wonder of the world. That's it, more or less. I think it's probably exactly it. So if you start saving earlier, you can save a lot less and you can still potentially have a lot more retirement. If you wait much longer in life, like 20 or 30 years, if you kick the can down the road and the latest, you're going to have to save a lot more money in the end to meet your target, right? If you do more at the beginning, overall, it's going to be a lot less contribution on your part. If you don't do anything until it's too late, then it's basically too late and you totally missed the boat, right? So let us take a look at this. I put together some Python code yesterday, refined it just a little bit this morning. So we have some inputs we're going to request from the user: income, rent, groceries, utilities, transportation, entertainment, and savings. Okay, and based on these, what is it, 4 or 5? What are they saying? It's maybe 8. I want to see how well we are equipped to prepare our financial plan and where everything sits when we input the numbers here. And it made this very dynamic, right? So I could hard code all these numbers. I could say income is whatever, 10,000, 2,000, can be $20,000. Like everybody's gonna be different for your personal situation, right? So I made this very dynamic so this can appeal to anybody. So enter your monthly income. Again, it's not hard coded. We're looking for input from user. I'm gonna say 10,000. Some people could gasp. They're like, "What? That doesn't make any sense." But I live in New York City. 10,000 is fairly common. You can see people making more than that. You could see 50,000, 100,000 in 1 month. Okay, I'm just using this as an example. I think in New York that's somewhat realistic. Monthly rent, I'm going to put 4,000. Okay, this is just my scenario. Give or take, I mean, it's a little bit different, right? But again, I tried to make this dynamic and flexible to accommodate everybody's needs. Grocery budget, maybe 250 per month. Might be a little under. Let me put 300. Even that might be a little bit low in New York. Monthly utilities, that's not too bad. 200, I'm going to say. Transportation, I'm going to say 150. And then monthly entertainment budget, oh, that could be anything. That could be pretty low, 50, $100 up to thousands. I'm going to say 300. I'll just say 300, whatever. And how enter how much you will put into your 401k per year. Okay, so again, this is going to be different for everybody. That's why it's an input. This is going to be very dynamic to capture all the possible scenarios. I'm going to say per year. So these other, if you're paying attention, these are monthly. This is per year. I think the maximum is 20K or 22K now. Over a certain age, it's more. I'm going to say 18,000. I know I don't put 18,000 in, but should. Okay. So we put in the money and we see the monthly budget scenario. Okay. So here's the income. I put in 10K. Now I'm saying in some scenarios it might be a little bit lower, in some it might be a little bit higher. So I'm multiplying my income. The blue is the original scenario. The red is the blue times 0.9, and the green is the blue times 1.1. So I want to take a haircut here or chop off 10%, and I want to add 10%. So here's my income. Here's my rent, groceries, pretty inconsequential, transportation, entertainment, and then here's my savings at the end of 1 year. 18,000 is most likely. Oh no, I'm sorry. 18,000 was the amount I put into my 401k, and then if I get squeezed a little bit, I can't put in that much, 16.2, and then if I have a good bonus this year, 19.8. Okay, so just basically budgeting, just so you see visually how everything shakes out here. I think that's a good exercise to undertake. Okay, so personal financial planning also involves saving and investing. We just saw budgeting. Let's take a look at saving and investing. It requires evaluating your personal financial goals, your risk tolerance, time horizon until you tap into your investment. You choose an appropriate investment strategies too, right? So some people are going to be a little bit more conservative, some are going to be a little bit more aggressive. That's fine. It's whatever makes you comfortable. If you are not comfortable in certain investment types of investments, equities, or very volatile stocks, you could pick something more conservative, maybe a mixture of CDs and some bonds and some stocks. It could be a bunch of different things, but you have to be comfortable with your preference for risk. Some people have an appetite for more risk. Some people have an appetite for less risk. Okay, so you know what you are, you have to comply with that. Otherwise, you're just going to be uncomfortable all the time, right? You're going to be afraid you're losing money or you're not making enough money, right? So it's really a personal decision. So let's look at savings and investing. Again, I'm going to capture some inputs from the user, savings, number of periods, number of years, and then growth rate. And let's look at the scenario. So hit Control Enter to run it. We go down here, and a lot of this is just plotting the chart and so on and so forth. The major things come from here, the inputs from the user, and then we're doing some basic compounding over here. Okay, and then any kind of adjustments go over here. Okay, so that's it. Pretty straightforward. I'm going to share all this code with you guys so you don't have to take notes and you don't have to write it down on a pencil and paper. I'm going to share all this with you when I post a video later today. So enter savings amount per period. Let's say, let's say I'm going to save $1,000 and number of periods in 1 month, 12 times a year. So number of periods per year, 12. So I'm going to save $1,000 per month, 12 months in a year. Number of years of savings, I'm going to pick 10. Okay, so we're going to save 10 times 12. This is 120 periods of savings. Okay, so 1,000 times 120, what is that? 120,000. Enter the growth rate as a percentage. Now I'm going to pick a number here. It's almost guaranteed it's not going to be the same consistent for 10 years. Okay, it's going to go up, it's going to go down because this is invested in the market. You can have good years and bad years. I'm going to say overall 5%, probably low. We'll probably exceed that threshold of 5%, but I think it's somewhat realistic. If you put in 2%, it's too low. If you put in 25% for 10 years, it's way too high. You're not gonna get that. Okay, there's gonna be bad years mixed in there. Okay, so here's our chart, and we have our savings over here. So the original savings was in yellow, and then take a haircut for the reds. Okay, so the reds look like this. If we zoom in, we have 174K, 176, so it's gone up a little bit, 178, 181, 183, and this red over here goes up to 185. Double click to get back to the original chart. So there you can see it goes up consistently and persistently. In reality, it's going to fluctuate a little bit. Okay, you can have good periods and bad periods, good years and bad years, good months and bad months. But this basically shows you what you can hypothetically expect over the course of time. Now, I should probably put in like some kind of randomizer in there and just make it a little bit more realistic because it's not going to increase consistently like that over time. There's going to be bad periods that drag down your portfolio, but um, let's leave that as an exception for right now. We'll just look at this. So the original savings in year one is this. This would be a lower cost scenario or lower lower interest scenario. Okay, you can call it whatever you want. And this is year two. This is period 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. I think we had 60, right? Let's get down to the end because wait, we had 12 times 10, 120. Oh, there it is, 120. So we put around 1,000 a month into this investment at 10 years. We have 195,000. And we put in basically, if you think about 120,000, so 195 minus 120 is about 75,000 in profit. The somewhat less risky alternative would be 185, and a more risky outcome would be 205,000. Okay, so that's how that works. So retirement planning is just straight up comprehensive retirement planning. Like we touched on budgeting, we touched on investing. Retirement planning is somewhat similar to those, but a little bit different, right? We basically need to save money to invest in the future to be able to accommodate the lifestyle that you want to engage with after you stop working, right? So it involves setting clear financial goals, estimating future living expenses, and considering factors like inflation, healthcare costs, life expectancy, and so on and so forth. Okay, and we have a few investment vehicles that can help us get there, right, to achieve our goals: 401ks, IRAs. There's SEPs, simples. There's a whole bunch of them, right? Some people qualify for some people don't qualify for some. So you have to see what you're eligible for. But in this scenario, we're not looking at SEPs and simples and IRAs and alphabet soup types of things. We're just looking at a retirement savings account, okay? And we're going to consider factors of growth, risk tolerance, and the timing of withdrawals to ensure that our financial goals are met to the greatest extent possible. Okay, so again, we have our inputs, starting balance, annual contribution, current age, retirement age, rate of return, and then the marginal tax rate. Though we're all paying taxes, you can't ignore taxes, you can't ignore inflation. These things aren't going away, so you might as well just accommodate that and bake that into your analysis. Otherwise, you're going to come up short, right? If you don't accommodate for inflation and for tax consequences that you will be subjected to no matter what, you will come up short. You might think, okay, all I need is 2 million to retire. Once you incorporate the taxes and the inflation, you might actually need 2.5 million, right? So let's get realistic here and bake those into the analysis here. So enter the savings amount per period. I'm gonna try like before 1,000. Annual contribution amount 12,000. I put in, whoops, yeah, well, not 120. That I wish that was it. So enter the annual contribution amount. And okay, so we start with 1,000. We put in 12,000 per year. So the 1,000 is just to kick it off. Enter your current age, right now 52. Yep, believe it or not, getting up there. Retirement age, I'm going to say 70. So I've got 18 years to go. Enter the expected rate of return. I will do 8. 8 is good. Over the next 18 years, I think 8 is fairly realistic. Marginal tax rate, probably 20%, probably give or take. When you're retired, your income dips and your marginal tax bracket is going to decrease, right? If you start taking money while you're still earning, if you start taking money out of your IRA or your 401k, I think you can. I think it's legal, but you really wouldn't want to touch it until you've stopped working. Because with some of those things, you could actually pay a penalty. Like if you're taking money out of the IRA, I think you could after age, what is it? 65 and a half, I think, or maybe 67 by now. They increase every few years. And I think by 70 or 72, you have to take it out. And the 401k is a little different. You're penalized if you're working, you take money out. So you wouldn't touch that until you retire. Let me put 20% for taxes. And here's the breakdown here. So we have total savings. You can see that's accumulating right here year over year for 18 years, 489,000, not bad. Almost a half a million taxable savings because this isn't a tax deferred vehicle, either an IRA or a 401k. They both offer tax deferred benefits. Your taxable savings is almost 100K. So we're saved 489. If I put the mouse over the bubble, there's that. And this is 97,870. And that's what you see there. Okay, so very nice. You can see this is the bar chart. This is the line chart increasing year by year. So 52, we start, this is 1 year out. It's always 1 year into the future. And then we stop at 70. So I see 489 that corresponds to this over here. And tax savings is kind of hard to read at 97K. That's what you see right there. So nice. So this is working excellent, just what we want. So now let's take a look at risk management. We've touched on a couple different topics of financial planning. Risk management pertains to a specific part of financial planning. Let's take a look and see what this is. Basically, we're identifying and assessing mitigating risks. Potential risks include negative impact to your financial well-being. Okay, if you have a catastrophic event, a car accident, a medical emergency, home burns down or gets destroyed by who knows what, a tsunami, a tornado, hurricane, or something like that. Your entire working career could be invested in your home, which is a major asset for most people. That's the number one most valuable asset. Could be wiped out very quickly, and in the blink of an eye, most of what you work for your career is gone. So you really want to have homeowners insurance. You want to have life insurance while you're working, earning income for your dependents. If you have stopped working and your dependents have left the house, now they're in college or post-college, they've graduated, you don't really need life insurance because that person or those people are not dependent on you anymore for financial gain, right? Or financial income, whatever you want to call it. If you lose your job, well, you have a disability that could affect your income stream severely, right? So disability insurance might be something that you should consider. You might have this to work. If you work for yourself, you might have to get a self-insured, not self-insured, like a separate carve-out plan or something like that. All right, so there could be a bunch of risks that we don't want to underwrite by ourselves we would want to offload this onto some type of insurance entity, right? Or some type of pooled insurance type of product, right? So let's take a look at this. We have risk management, life insurance. Here's the base rate, age factor, okay, and the term factor. And again, so these are real inputs, user inputs like I got before. This you'd have to put in for yourself. I'm saying 35, 20-year term. You could set this up as user inputs. I just did not. It's just a slightly different way of doing it. But again, you can put in whatever you want here. You just change this number. Unemployment insurance, if you want 60,000 coverage, this is what it would cost you most likely. And but shop around, right? Because all these insurance companies offer different rates. Sometimes they want your business, so they'll have a lower premium. Sometimes they don't want your business, so to discourage you, they will offer higher premium. Say, hey, if you want to be a sucker, we'll take your money, but we really don't want your business. We're not focused on that line of business, and we're not interested, right? So you have to kind of shop around and find the thing that suits you the most. So here we have disability insurance, and again, some hard coded numbers. You can set this to whatever you want. It got a little bit complicated when I tried to capture all the user inputs because we're doing all of this insurance um, like comprehensively at one time. If I broke it down into a bunch of different cells, you could certainly capture user inputs, or you could do it in this one large cell right here, the cell in Jupyter Notebook. But it gets a little bit convoluted, and I just thought this was not, like just neater and cleaner to do it this way. Okay, here's homeowners insurance. We have base risk, base rate, location, premium, and total premium. So let's go ahead and call all these functions. Okay, here's life insurance premium, and we're going to pass in those values. If I do Control F and go over here, there's the name of the function, right? If I go this, unemployment insurance premium, Control Paste, and overwrite that and go down, you see the next function is called right there. Okay, so let me go ahead and Control Enter. And again, if you want to change this, you go ahead and you manually make these updates right here, right here. Pretty straightforward, right? So we're saying the life insurance premium is 5,555. The unemployment insurance premium is 1,200. Disability is that. Health insurance is that, and homeowners insurance is that. So let's plot this down here. Control Enter to refresh the plot. Here is life insurance, unemployment. So here's the breakdown. The visual looks nice, I think. I always say a picture's worth 1,000 words. When you look at this thing right here, okay, that's nice. That's all true, right? But how does it look visually? I don't know, right? But if I plot it, then I know. And you can see easily life insurance is more than half of the total costs of the premiums for all the insurance. And here's the breakdown for the others. Health insurance is, oh, disability is the least. I thought it was health insurance. So disability is the least. And here's the others. And these plotly charts are pretty nice. If you click on this, you can expand it and explode it into different views, right? And then you can get the whole breakdown right there. So that's pretty nice there. So how about debt management? Let's talk about debt management for a minute. This is another part of your financial plan that involves creating strategies to manage or reduce debt in a way that aligns with your financial goals, right? So the less debt you have, the more capital you can save, right? And the quicker you're going to achieve your financial goals. So debt management should be a priority in any financial plan, okay? We're talking about credit card balances, student loans, mortgages, and any kind of debt that has some cost associated with it, which is almost everything, unless you have a 0% credit card, and those are just temporary. It only lasts for a year, maybe 18 months, 2 months if you're, 18 months or maybe 2 years if you're lucky, but beyond that, you're not going to find those. And those things are pretty rare too. So most people pay debt, right? So ultimately, the goal of debt management is to maintain decent financial health and ensure that debt does not hinder you from achieving your financial goals. Okay, so let us go ahead and capture some inputs from the user. Okay, just like we saw before the insurance example. Enter the loan principal. So how much are we going to borrow? Let's say it's a home loan. We're going to buy a house, 300K. Now, in New York City, nobody's buying houses for 300K. That doesn't exist. But let's say outside of New York City, this could be a realistic example, although home prices seem to have appreciated pretty significantly since the beginning of COVID. So even this might be low, but you know what? Let's just go with it. I think for our illustration purposes here, I think it's fine. Annual interest rate on a loan, let me put 7.5%. I think that's pretty realistic. The monthly payment amount, how much are we going to pay on this loan? Let's say I want to get this thing paid off. I'm going to pay I'm going to buckle down and save money and try to pay 5,000 per month. Okay, it's aggressive, but let's see if we can do it. And we get down to our colors here. So everything's plotted out. We got 300K. You can see it's going down. It's decreasing lower and lower and lower and lower and lower. Into month 62, we have 64,000 outstanding. And then it goes down to just about 1,000 here right at the end. And then we pay off the loan after month 75. Okay, so there it is, months to pay off loan, 76 months, and the total interest paid, $77,000. Okay, so it sounds like a lot, but it's actually over, how long was this? 76 months, 6.5, that looks like 6 years. I think it's about 6 years. So you paid 77,000 over 6 years, just over 10,000 per year. But let's say you bought the house for 300,000 and it's appreciated over 6 years to 400,000. So you paid 77 for the interest on the mortgage, but that interest is tax deductible, so it might be closer to 50,000. And if your house is worth 40,000, I'm sorry, 400,000, you made a $50,000 profit just for doing nothing, just for living in a house. You made 50,000. Congratulations, pat yourself on the back. So even though this looks like a big number, it's kind of intimidating, it's kind of scary. Um, Mortgage interest, if your house is appreciating in value, can be really your best friend in the world. Probably your house can be one of the best investments that you'll ever have in your entire life. So let's switch gears now and look at tax planning. This is another crucial aspect of financial planning, like debt planning, investment planning, retirement planning, budgeting. All these things are important, right? They all work together um, congruously. They're very congruent, right? So by understanding the tax laws of your local municipality, you might be able to, you might be eligible for certain deductions, credits, tax efficient investment strategies, all kinds of things. Solar panels on your house, you could receive a credit for that, really. So this is a case by case basis. You really have to understand some basics about tax laws. And this, again, this lecture that I'm doing now, this is not comprehensive. It's not a super deep dive or anything, but it's just a general exposure to a bunch of different topics in the world of financial planning. That's what it is. So we can't get into all the tax planning nuances here. My brother-in-law works as a tax attorney, and he's up to his eyeballs in work, and he only does tax. He doesn't work on estate planning, budgeting, financial planning, retirement planning, anything like that. And he has his hands full, right? So taxes are just a beast all on their own. But I think this is a good overview of how to be aware of your tax liabilities and what you are required to do. Okay, and then if there's some tax loopholes, by all means take it. If there's a way to um, reduce your tax liability, by all means take it. Anything that's legal, you're entitled to do. You can't do things that are illegal. But if you are eligible for it and you don't take that tax credit, you're just leaving money on the table, right? So you should be informed and knowledgeable about what you're entitled to. So here we have income, deductions, and credits. I'm going to run this. We have inputs from the user, just like before. So we have enter your income. Let me look at this a little closer now. I forgot what is this? This is income. Okay, let me see. My income is like 100,000, and enter your deductions. Okay, let's say I'm entitled to 20,000, and deductions. Your personal deduction. Deduction for a child or a dependent. You could have some charitable donations, donation to your church, things like this. Let's say it's $20,000, okay? And any tax credits. Let's say we get another tax credit of $10,000 for some solar panels we installed on the house, okay? So here's the breakdown. Taxable income is actually 80,000. It's 100,000 minus the 20. Tax liability is 90,000, right? Because we got a tax credit of 10,000, and let me see here, the original was 100. We got this down by the 20, right? So now we're down to 80. Tax liability is only 9 because you're paying 9%, 9 times 2, 72, a little over 9% on the 80,000, and the remaining income is the 100,000 minus the 9,000. Does that make sense? Okay, so you started with 100,000, subtract 20 because we had these tax deductions. Tax liability is 9, subtract 9 from 100, you have 91,000 remaining income. So taxes are scary, but honestly, like you're getting 91% of your money. So not a bad deal. Like everybody has to pay taxes. You have to pay for garbage cleanup, for police fire protection, for the municipality to plow the roads in the winter, to pave the roads in the summer, and so on and so forth. Parks and recreation maintenance if you live in an area that has that kind of thing. So the taxes go for a lot of things, but if you make 100,000, only pay 9,000. If you think about it, it's not that bad, guys. Zero would be better, but that's not realistic. Okay, so this might be the last piece of it here. I think this is. Let me see. Maybe there's one more. This could be the last one though. Now we're looking at cash flow planning. This is the process of ensuring that all your expenses, income sources, and everything give you enough liquidity to meet your financial obligations while saving for your future goals, right? So your obligations are food, rent, mortgage, whatever the case is, utilities, transportation, clothing, things like this, right? But you still want to be able to save up for your future. If you spend all your money on current necessities, you're not gonna have anything for the future, right? But you need some of these current necessities paid for, right? There's no free lunch here. So budgeting helps you identify the fixed and the variable expenses. Okay, so fixed is probably you could say mortgage is fixed, rent is fixed, right? It could go up at the end of the year, but during the year it's probably fixed. Your utilities might fluctuate a little bit, clothing, groceries might fluctuate a little bit. So you have some fixed, some fluctuating costs. But basically, we want to understand the planning and make sure that this is essential for achieving our long-term financial stability and ability to pay our debt and prepare for unexpected um, life events. Okay, like having a child, there's damage to your house, lightning strike, or whatever. Right? Life is not perfect, right? So things come up, and we have to sometimes break open the piggy bank and make payments for things that we didn't expect. But that's okay. Financial planning is going to help us prepare for these inevitable um, uncertainties. Okay, so let's hit Control Enter. You run it, and we will gather the input from our user just like before. Enter your initial monthly income. Okay, I'm gonna say 10,000. It's not really, but I like that number. Initial monthly expenses. So I'm gonna say the rent and the groceries and utility and all that. I don't think they parse it out at this one. I did the code yesterday. I already forgot what we're doing here. Enter the number of months for the projection. I'm going to say, 120 months. That's 12 months for 10 years, 120 months. Okay. And we see total income over 120 months at 10,000 per month. So 835, 1.18. So yeah, I think that makes sense. So it's about 120,000 per year. We're subtracting some out for expenses. Total expenses over the time period is 66,000. Total debt repayments, I said that is zero. Total investment contribution is 73,000. We're taking the difference between that and that, so we can put sorry. So we can put 73,000 into our savings account. And at the end of the 10 years, this is what we look like. We have the surplus that is purple, the expenses is red, and the income is in yellow, right? And it's increasing a little bit every year. So we get small bumps in our pay, little raises, and so on and so forth. So I think this is the last topic. Estate planning is a process of organizing and managing your assets during your lifetime and determining how they will be distributed after your death. We're all going to die someday. You, me, all of us are going to pass away from this world. We have the opportunity to prepare for it by doing estate planning, or you can ignore it. Ignoring the problem won't make it go away, so I think you should probably prepare for it. That's the stage thing to do. If you're wise, you're going to prepare for the inevitable. Okay, so the goal of this is to ensure that your wishes are honored, minimize the impact of estate taxes, and provide financial security for your loved ones after you pass away. Okay, so that's what estate planning is all about. Basically, consider potential estate taxes, try to minimize those taxes. And it can be substantial. If you do nothing, you're going to get slammed with taxes. There's stories about that. You hear it in the news all the time because people just fail to plan. Nobody in life plans to fail, but sometimes people fail to plan. Don't fail to plan because um, it's gonna come back. It's gonna come back and it's gonna bite you. So plan ahead can help reduce the burden of estate taxes. This will ensure assets are transferred efficiently to your um, loved ones and your, what was I gonna say, legacy survivors, okay, all these people, and you will avoid disputes among heirs, right? If everything is written up in the will, nobody can fight about it because that is a contract and it's non-negotiable. So here we have our estate planning scenario. We will collect some input from the user. Okay, and again, you don't have to worry about all the code at this point. A lot of this at the beginning is doing the compounding or the discounting. That's what this is. This is collecting input from the user. We're going to print the results and we're going to plot a small chart. That's what this figure is for. Okay, so I'll share all this code with you so you can copy and paste that into your own Jupyter notebook and run this and pull it apart, put it back together, and see how everything works. Okay, so here we are on the last part here, heading towards the finish line. Enter the inheritance estate value in dollars. Let's say 600K. Let me say 500K. Okay, my heirs were not as rich as I had hoped for. I'm the beneficiary. I'm going to get $500,000, not 600K. Enter the exemption limit in dollars. So sometimes you'll have exemptions. Some of it could come to you tax-free, but once you exceed a certain threshold, then you will have to pay. Okay, and there's exceptions. All states are different. All parts of the United States are different. It's really governed by state law. Most of this stuff, I think some of it might be federal law, but I think most of it is really controlled by the state. Maybe almost all of it is controlled by the state. Enter the tax bracket or the tax threshold. I'm going to say 20%, 0.2. It's 20%. It's going off the screen. What's it saying here? Please enter a valid tuple. Oh, I know why. Okay, let me do this again. Okay, so 500, 200 is exempt. So this is on, because we have a progressive tax in this country, that's what we're collecting here. I'm going to say 200,000. Okay, just and a comma 0.2. This is just a scenario. Whoops, 200 comma. Oh no, that was right. Comma 0.2. Okay, so we have a progressive tax in this country, so that's why we're doing it this way. This is a little bit different than just a straight tax. Enter any deductions, charitable donations, things like this. I'm going to say 50,000. I'm putting 50,000 into charity. So if I give this straight to charity, I don't have to pay taxes on that because I don't get to benefit from the asset. It goes straight to charity. If I don't touch the asset, I don't pay taxes on it. Enter the inflation rate. I am going to say 0.04. 0.04. Maybe it's a little bit low for today's inflationary environment, but kind of close. Enter the number of years for your projection. I'm going to say 20 years. I think it's fine. Okay, let's look at the result. Here's the chart. So the estate tax projection over time actually ends in 5 years. So because of the discounts over here, we got 200,000 off because we're under the threshold. We had another 200,000. Tax bracket is only 2, so that's like 40,000. Then we have to pay taxes on the rest. I put this out of the estate immediately. I didn't touch it, so I don't have to pay on that amount. And I made the chart a little bit colorful here, so it kind of looks like a rainbow. So the first year of taxes, I owe 8,400, then 6,736, 5,005, goes down to 3,205, and then 1,333, and then our tax liability is paid off. And here's a printout of the same. Okay, so it could go for 20 years if you're paying less. Like if you don't have these exemptions here, the time to pay off those estate taxes will take longer. And if you don't have that, it's going to take longer. But we had some benefits there, so it helped us to get into the black quicker. Okay, so wrapping up here, effective financial planning has several key benefits, including better control over your finances, clearer goals. You set goals, you establish your goals, and you reach your goals. Ability to navigate unexpected challenges, and there's no gotchas at the end, right? You're planning for everything, and you can anticipate everything, right? You have a comprehensive plan. Individuals can allocate resources effectively, reduce debt, save for the future, and invest wisely. Okay, that is very important. Invest wisely. It provides a roadmap for achieving both short-term and long-term financial goals while helping mitigate the risks such as unexpected expenses or market fluctuations. Unexpected expenses could be an insurance incident, your house gets destroyed or partially destroyed, a car accident, health condition, something like that, that can derail your financial plans really quick, right? So you want to have the proper insurance in place. And that is pretty much it, guys and girls. So hopefully that was beneficial. Hopefully you learned a couple new things. I learned a little bit putting this together. Actually, my first job out of school was financial planner. It was all salesy, lots and lots of sales. It wasn't a whole lot of planning, and it wasn't very technical like this stuff is. I really like this kind of stuff. It was all salesy and just meeting people and shaking hands and trying to create relationships. It really wasn't for me, so I didn't last too long. But I like the concept of financial planning. Just to work in a sales environment wasn't really my cup of tea, so I moved on pretty quickly. But I learned a ton. Hopefully, you guys learned something here in this exercise today. So I'm going to wrap it up here. I will post the video in just a bit, and I'm going to share all the notes with you too. Okay, so hopefully this was a good opportunity to drop some knowledge, and hopefully you guys can absorb some of this knowledge for your own benefit. Okay, thanks for everything, and have a great day. Goodbye. All right, guys and girls and everyone out there, I've got a really good one for you today. This is uh, an illustration of how to plot tree maps. Okay, and we're going to use some real financial data to show the representation of different hierarchies, basically different returns from different stocks over the past, what are we looking at? I think it's 1 week, quarter, month, quarter, and year. I think that's what it is. So we'll see in just a minute. So tree maps are great for visualizing any type of hierarchical data, parent-child relationships, boss-employee types of things. It shows different hierarchies or different patterns or relationships in data. Okay, and the tree map is basically a space filled in chart, typically rectangles and triangles. It's very efficient the way it's laid out. It actually is probably the most efficient use of space or close to it. Maybe a hexagon would be slightly more efficient. But basically, these rectangles and squares represent patterns of hierarchies or different levels of data in the entire data set, okay? And they're coded with numerical values. So tree maps are great for the following types of tasks: visualizing hierarchical data, we just discussed it, comparing parts to a whole, right? Any kind of color coding represents different information within the hierarchy or within the tree map, right? And this is an intuitive way to display potential relationships between the data, right? Proportional, pro. Do I have that? I guess that was spelled right. I don't even know. Okay, so we're going to go ahead and import data from this website. I like this website a lot. I've demoed this in a couple of my other videos. This right here is American Express, AXP. Okay, and this is just the first stock ticker here. We see Amgen, Apple. I believe BA is Boeing. Is it BA is Boeing? Let's take a quick look at this. BA, yes, okay. And what do we have here? Going a little bit slow. Yeah, Boeing, that's what I thought. Okay, so industrials and aerospace and defense, that's the sector, right? So we have this this financial data here. I demoed this in a couple of my other videos. We have market cap, a lot of fundamental data, income, sales, book to share, cash per share, price to earnings, PEG ratios, price to sales, price to book, price to cash flow, and so on and so forth. Let me get rid of this ad. The things that we're going to focus on in this video, and we will see that right over here. I am looking at these types of things. So, so performance for the week, performance for the month, performance for the quarter, and then performance for the year. Now, you can do these tree maps any number of different ways. I think this was pretty interesting. These 4 financial metrics I picked, that's why I went with this. But really, you can do anything you want. The sky's the limit. I'm going to just show you essentially how it works, and then you can go ahead and pull in any of those financial ratios that you want and build your very own tree map. Okay, so here's the tickers. We're going to loop through the entire list of tickers, and you create what's called a user agent to go ahead and screen scrape these. There's a few different ways of doing that. I like this user agent. It's headless. That means that there's no browser that pops up, and you can go ahead and just extract the raw data, which is all of this stuff in here pretty quickly and easily using the Mozilla header method. Okay, so we're going to go ahead and run this. I'll do Control Enter so you can see how this works. And I'm not just making this stuff up. This actually works when you click the button, right? So importing. I think these are the Dow 30 components, so I think they'll have 29 or 30. Should be 30, I guess. Okay, and then once this data is imported, sorry, inloaded, that's not even a word, I'm thinking. Once it's imported, we can see the head of the data frame. Okay, any NAs are filled in, and I'm just displaying the data frame right there. So that looks good. Let me go ahead and get rid of anything that's not a zero. We have 29 rows. Okay, so this is supposed to be the Dow 30. Am I missed one? I guess there's like 29 in the Dow right now, and 77 columns, right? So we have price to earnings, EPS, insider owned. This is the number of shares owned by the, I think by the institution itself. I forgot what the definition of that is. Sorry, but we are focusing on these types of things right here. Let me find this. What is this? Quick ratio, gross margin. No, I think it's over here. Oh, Oh, okay. So here's performance for the week. Okay, so that's one performance for the week, performance for the month, performance for the quarter, and then performance for the year is going to be right over here. Yeah. Okay. So performance for the year, and if I can find any of these tickers, AXP. Let me see what this looks like. Let me go ahead and clean up this data frame a little bit, just because I want to get rid of these percentage signs. I want everything very crisp and tight. I don't want these weird strings or characters in there. That's not going to help at all. Right? I want to convert everything to numerics. So we had billions in this column, market cap. Now market cap is, oh, where is it? Where's the market cap? Oh, I don't even see it. Okay, but the B's are gone and the percent signs are gone, right? So anything that's NA or gone is cleaned up, and anything that has a comma is deleted. And if we don't have at least 80% of the data frame filled in, I'm going to drop those columns. So I think we still have 29 rows here, so I think we're fine. I don't think we're missing too much. But every once in a while, you will see a couple missing values, right? So we want to clean that up. And this is, did I not do something? Maybe I had to run this first. Give me a second here, then run this, because everything was running fine yesterday when I did this. If melted, what's it saying? The following ID varies. Index. Index is not in the index. Oh, I think that makes a whole lot of sense. Let me run this one more time. This is literally just working yesterday when I did this. Let me go back here. Okay. I think I just missed a step. No, that doesn't work. Okay. Hang with me. Hang with me for a second. We're going to go back to the beginning. Okay. I think I missed a step there. You really have to do this in order, and you have to do it step by step. Otherwise, if you skip a step, you could get into a pitfall right here, like we just saw. So let me redo this. I think this is going to work. Literally 24 hours ago when I put this code together, everything was working fine. Okay, so that is okay. Let's go here. This is the next step. That's fine. Next step. That's fine. Clean. That's fine. Okay, go down here, and everything's fine. Yeah, so I don't know what that was. Some kind of glitch, but everything's fine now. Okay, so I will share all this code with you. I will post the code and I post a video a little bit later today. So again, these are the 4 metrics that we're looking at: performance week, performance month, quarter, and year. Okay, and when I go ahead and put everything into the chart, we have a very nice looking tree map. Okay, so if we look at INTC, the performance for the year is -60. Okay, I'm glad I'm not invested in that. That's pretty awful right there. Walmart. So let me see if I can find Walmart over here. WMT, no, I'm just looking at the head of these. XP, Amgen, Apple. XP, Amgen, Apple. I think we can get Apple pretty easy. Okay, so Apple, we see performance for the year. If I click on this thing, we can actually zoom into it. It's pretty nice, and zoom out when you click again. Any of these, you can zoom in, zoom out. So very dynamic, very interactive. Let me look at the performance for the year for Apple, and this is performance market value performance here. You can see perf year 32.33. So if we go over here to Apple, AAPL is right in the middle. Performance for the year. Perf year is, perf year is, come on, give me a perf year. Left. per quarter, per year. Okay. Yeah. 32.33, right? So right, it's right in the middle, 32.33. And it's exactly what we see here in blue, 32.33. Let me zoom out just a bit to get the others. We have performance quarter, 12.2. Okay, performance quarter, 12.2, right on the money. So exactly where we want to be. And if a couple of these are fine, then they're all fine. You just have to like QA one or two of them. Apple performance for the month, 8.73. Performance month. Let's get the performance month. 8.73. Okay, exactly right. Right down to the decimal place there, and 2.32 for performance metric. That is perf week, 2.32, up 2.32% for the week, and perf week, 2.32. Okay, so exactly on the money. So if one of these is right, they're all right. It's pretty, not standard, pretty, what's the word, not flexible, reliable. Okay, it's pretty reliable. Sorry about that. Momentary lapse of reason there. So we got a nice tree map here. Everything's working fine. So that's one way to do that. Again, tree maps with Plotly Express can render different hierarchies, right? The columns contain all the magnitudes, and it contain a wide variety or wide range of values. So when I was doing this, I actually had to taper this down just a little bit, because sometimes if you have these extreme values, it doesn't always plot correctly. So I had to try a couple different methods here. So in your data set, you could try this NP numpy clip. If anything is less than -50 or greater than 50, you can clip those off. Anything that it has extreme value, you can take a log of that value. So that can help standardize or normalize the data. And anything greater than 50 or less than 50, you could just filter out these values. So I ended up going with this right here, taking the absolute values, okay, and then I got the tree map to work. But at first, it just didn't work. I had to make a few attempts and finally got it to work. So here's a different way to represent kind of the same thing. This is performance week. You have month. This is an interactive chart similar to what you saw before, but it's broken out 4 different ways. So you have performance year, performance quarter, performance month, performance week. In Walmart, we can see a 77.05. Whoops, I didn't need to zoom in on that. 77.05. We go up here to Walmart. Not sure if that is showing. But that is fine. If I go over here to get rid of head and replot this, Control Enter. Where's my Walmart WMT? Okay, so Walmart 77.05. Let me go over here. Just want this row. And 77.04 performance year. I should probably just use these 4 columns and not have 77 columns in their performance year. So many things here. Performance month, performance quarter. Okay, we're getting close. Performance year. Come on, give me the year. Performance year. Performance next. Oh, performance year. Okay, so we have the column. We go down. And what was what? 77. WMT 77. Let's look at the first one. I'm sorry. This is probably just easier. I'm scrolling all over the place. You have to head. Add. Let's look for AXP. I think that's just easier here. Just to illustrate the point. AXP, where are you? Positive or negative? So you can see red is negative, positive is in blue. And this comes from this type of pattern over here. Where is it? Red, blue. If you want another pattern, yellow, green, red, green, yellow, blue, you can pick whatever you want. Triple M is 46.13. I just want to see one of these things. AXP, Amgen, Apple. Oh, let's look at. Oh, here's our Apple. Let's look at Caterpillar. And performance month negative 10.54. Where's CAT? CAT. I don't see it. Oh, I do see it. 26.48 for the year. Okay, let's just look at one. Caterpillar for the year, 26.48. Oh, perf year. Okay, 26.48. Where are you? probably drop all these columns except for the four I'm using, right? 26.48. Yeah. We'll find you. I will find you. Performance year 22.39. Okay, that's capital 22.39 for the year. Cat 2026. I think. I think there might be an issue with the rounding here or something. B of A. They have B of A over here. Sorry about this, guys. B of A. Here's B of A. Let's look at performance month 19.87. Oh, that's pretty good actually. 19.87 in 1 month. Wow. B of A performance month. B of A 19.9, and this is telling me 19.9. Yeah, that's right. Okay, so it's doing a little rounding. That's fine. It's fine. Okay, it's just rounding up to the nearest decimal right there. So, anyways, that's it. That's tree maps. You pick the columns that you want to plot right here, performance columns. Put that into a data frame. Convert everything to numerics, and you have a nice looking tree map right here that shows the month. The year, month, quarter, and week, right? And down here you have the same thing, year, month, quarter, week, but you just use the drop down control to select, and the chart updates according to whatever you pick here. So that's pretty much it, guys. I'm giving you a little more knowledge here, dropping just a little bit more knowledge with this website. This is kind of like the main website for all of the stuff relevant to Plotly and how to plot these tree maps and how to do all this stuff by yourself. Okay, so hopefully that was insightful and hopefully useful. I think so. I think this stuff is pretty cool. Very passionate about it. Really like this kind of stuff, and just wanted to share my knowledge with y'all. Okay, that's pretty much it. I'm going to wrap it up. Thanks for your time today. Enjoy the rest of your Saturday afternoon. Thank you, guys. Bye. All right, everybody, Ryan Schul here. Welcome to my channel. If you've been here before, then welcome back. So the topic for today is ranking all Dow 30 stocks based on fundamentals. So what is a fundamental? It's things like ROA, ROE, ROI, price to earnings, price to cash flow, price to sales, things like this, like things where we can do a fundamental analysis of financial ratios and try to understand the overall financial health of the company, okay? So some fundamentals are more favorable when they're lower: price to earnings, price to sales, price to book, long-term debt to equity. You want less debt versus equity, right? You want higher book and lower price. You want higher sales and lower price. You want higher earnings and lower price, right? So sometimes if the ratio is lower, it's better. Sometimes it's better when the ratio is higher. So higher next year earnings per sales, higher is better, right? Higher sales overall is better. Higher ROA, ROE, ROI. If these metrics are higher, these can be better, right? So it's not always higher is better. It's not always lower is better. It can flip. It really depends on the fundamental factor that you're looking at, right? So we can measure how not idealistic or how powerful, what's what I'm looking for, how nicely everything is going to work out for the stock, how favorable the stock is going to be for our portfolio. Let me just state it that way, based on z-scores, right? So we can put all the metrics in the same scale, and the z-score will help us to do that. It will help us to normalize or to standardize everything. The only thing we have to remember here is that z-score measures the value minus the mean that we're looking at. So the actual value of the price to earnings, price to sales, price to book, minus the mean of all of those, divided by the standard deviation of all of those, okay? And if lower is better, like for the example of PE, price to sales, price to book, we actually want a negative z-score, okay? So negative z is going to be better, but if higher is better for these metrics, then we want a positive z-score. So it gets a little bit complicated right out of the gate here. I'll admit that, but do some research. Google this if you don't understand it. I think you're going to learn a ton. So let's jump into it. Okay, so I'm going to go ahead and pull in data from this website. It's called FinViz. I've used this in a couple of my videos in the past. I'm a huge fan of this. I like this a lot. If you go over here, I can show you what this thing looks like. Basically, pretty cool the way they aggregate all the data here and quote. Let me see if I can just find it right off the bat. Okay, page not found. That's fine. I think we can go here. and look for Apple, AAPL, enter. Okay, so this is what I'm talking about when I say financial ratios here, okay? Or fundamental ratios, right? So here we have the index, market cap, income, sales is 400 billion, okay? Cash per share, so this is the total cash that the company earns or holds and it's on its books, divided by the number of shares outstanding. Here's the price to earnings, forward PE, PEG ratio, so price to earnings divided by growth, 3.84, price to sales, price to book, EPS, and over here we have ROA, ROE, ROIC, return on invested capital, short interest, performance year to date. Well, there's a lot of ads popping up. Okay, I can't control this. I can't control it. But so this is going to be the source of the data. So I wouldn't expect you to understand all these. I know a lot of these. I don't know every single one. But do some Googling if you're not familiar with these and get up to speed. I think it's very fascinating and very interesting what all of these fundamental ratios represent. So I'm going to use that as the source for my data. I'm going to hit Control Enter. That does take about 30 seconds to run. So I have a list here with tickers. I have I equals 1 just so I can increment and count what point we're doing the import here, just so I can keep up with it. I know there's about 30 in here. I'm using a user agent headless, okay, or headers as a Mozilla agent to go ahead and do the fetching of the data for me. And here is my my loop for URL and URL list. So you have URL list here. These are all the tickers, right? So TICK or TCKR comes from right here, right? And we have the base URL, which comes from here. So we're appending each ticker onto that base URL and then fetching the data from that, and then going to the next ticker, doing the append, doing the fetch, and then putting everything into a data list, which exists right here. And when this is done, here's the data list append, okay? D is the index of the data that we're looking at. And when everything is all done, we convert that to a data frame, and we can go take a look at the data frame right here. So this is it. So we have the index, price to earnings, earnings per share. We have the ticker symbol over here, AXP, AMGN, that's Amgen. This is Apple, this is Boeing, BofA. And here's all of the financial metrics here, right? So Apple, if we look at the PE, I have 30.83. Let me go back here, PE. Let me search for it. PE. 30.82. Okay, I think it's doing a little rounding thing. That's fine. It's fine. EPS, TTM, so trailing 12 months, 6.41. EPS, give me my EPS, please. EPS. TTM 6.41. Okay, and let me just check one more over there. Forward PE. So that's a big one. 25.38. Go here. Forward PE. 25.37. Okay, so I think there's a little rounding issue thing going on here. Either the site isn't representing everything and it's just displayed slightly off by a penny. I wouldn't worry about that. Or this over here is being rounded, but it's close enough for what we're trying to accomplish here. So that's the thing. We go to that website, do the fetch, pull back each ticker with all of the fundamental factors over here, or fundamental analysis features over here, append everything into a list and convert the list into a data frame. So we're in a good spot. We can move on here. Next, we'll copy the index to a new data frame and drop the index column. And we're going to do a little cleanup on the data. So if you look close, you can see an M over here that represents millions, 2.06%. So that's okay, you know, when we're looking at it. Well, when we want to do some real analysis, that is not going to work for the computer. The computer doesn't know what percents are. It doesn't know what M's are. I think I saw some B's over here. B represents a billion. Okay, so there's a B, but it doesn't know what these numbers are, right? So we have to tell it, just chop those off, cut those off, because when we do some analytic work on these features, the computer isn't going to be able to handle it and it's going to crash, right? So we do a little data refinement, a little data cleaning. One more thing I want to do over here is look at the columns in data frame, because I noticed not all the columns come in with actual data. Sometimes you'll have a column name and everything in the whole column is all zeros. So I'm only looking at 30 different tickers here. So presumably if you go outside of this universe of 30, if you go to a much bigger universe, then the column will probably be populated with something. I don't think it makes sense to have a column with no data, but in some cases, it just doesn't have anything for these tickers, right? So we have 76 columns. If I drop any column that has all zeros, because the zero is not going to add any value to the analysis whatsoever, then I end up with 68, right? So I'm printing the DF shape over here, dropping anything that contains all zeros, right? And I end up with 68 columns. So it looks like we lost 6 plus 2. It looks like we lost 8 columns, but no biggie, okay? We still have what we need. So I'm going to hit Control Enter here. I built a small dictionary of factors. So this has price to earnings, earnings per share next year, sales, price to book, ROA, ROE, ROIC, and long-term debt to equity. Now remember, some of these, we want these to be low. We want low price to earnings because it means the denominator is bigger and the numerator is smaller. So overall, the ratio is going to be lower, right? So we want a lower price, higher earnings. That's going to be a better fundamental factor for all of these stocks across the board, okay? If your earnings, not the earnings, if the price is lower and the earnings is higher, that's more desirable, right? Same thing for price to sales. If the price is lower and sales is higher, that's good. Price to book, price is lower, book is higher, that's good. ROA is return on assets. So we want ROA to be higher, right? We want higher return on our assets. Same for ROE, the return on the equity of the company. We want that to be higher. Remember, the company is comprised of assets plus liabilities, or assets minus liabilities plus owner's equity, right? So we want higher equity, higher return on the equity, or higher return, right? So that is a feature that we want to look for that is going to be higher, okay? So I'm going to go ahead and use my z-score methodology over here, okay? So I have standard scalar. I'm taking all of this and scaling it. My factors are basically this data frame. If I hit Control F to search, you'll see the factors go over here. I'm using a scalar over here. If I do Control F over here, the scalar is used to help me get all the z-scores, okay? So I'm looking at all of the data frames selected. If I go over here, this is coming from here. These are all the factors, right? So you can see how this builds. It kind of cascades down from one level to another. Then I can go ahead and calculate all my z-scores, and I can create a composite score and then rank all of these composite scores. So that is the ultimate goal over here, okay? So created the dictionary after doing the cleaning. Remember, we had to do the cleaning. We're standardizing everything and then creating z-scores based on that, okay? So again, what did I say originally? Lower gets a negative z-score, right? And yes, and higher, we want to see a positive z-score, okay? So I think that is in good shape. So let me see, I just ran it. Okay, I ran it. I got the composite score, and I'm doing a ranking based on the composite score, right? So we have dot rank right here, and I'm assigning that to this column. And the composite score comes from z-scores. Z-scores comes from over here, okay? So it's a little convoluted, but just try to bear with it. I think the payoff is going to be huge here, okay? So we have the original data frame with all the tickers over here, Apple, United Healthcare, down to Amgen, right? And we have all the original fundamental features over here. So I created two new columns called composite score and rank. So I want to see what this composite score looks like. So a higher composite score equals a higher rank. So this is actually number 1, 2, 3. We go down to 29. Okay, I might have missed one. So I know there's 30 in the Dow, or there's supposed to be. There's not always 30. They could have dropped one. There could be 30, 31. There could be 29. But most of the time, I think it is 30. So I might have dropped one. No biggie. We got the ranks. We got the composite scores. So higher composite score is better. Lower ranking is better. Lower composite score is worse, and that deserves a lower ranking. Okay, so I'm going to go ahead and pull in data from Yahoo Finance. So I want this time series data. Remember, we got the fundamental data that has all the fundamental features in it, but it doesn't have any kind of pricing information built in, right? So we have to get pricing information from Yahoo Finance. Okay. So let me go down here. So we have price data here, and we're going to calculate returns. Okay, so returns based on price data that columns and price data that comes from here. So this is why I love Python so much. So price data, 1 month return is literally just price data dot percent change 21. So it's 21 days on average in a trading month. There is about 63 trading days because you have to subtract out the weekends, right? And we have about 11 non open exchange holidays, right? So the exchange is closed for Christmas, for New Year's Day, I think for Memorial Day, 4th of July, Thanksgiving, and there's a few others. Labor Day, Memorial Day, they say those. I think those are the main ones, and there's a handful of others. Maybe President's Day, it's close. So on average, that's 30 days in a month, but for trading days, we're looking at 21. In 3 months, it's around 363. 6 months, 126, and in 12 months, about 252. Obviously, there's 365 days in a year, but you have to subtract out every Saturday and Sunday, plus those 11 non-open, non-trading days, right? So we can go ahead and get the returns. So very efficient, one line of Python script will give us the returns for 12 month, and we have the 1, 3, 6, and 12 right here. So these are the returns for all of our stocks. So this looks fine. We're going to go ahead and match returns with the composite score and the ranking that we did previously, right? So remember getting the composite score from the Z score, and then the rank was based on the composite source. So we ranked the composite score in descending order. So this is what everything looks like when we join it together. Okay, so we have composite scoring ranking, and then we have the 1 month return, 3 month, 6 and 12 month return. So Apple seems to be the best pick, and these are the historical returns for that stock. Down here, Amgen came in dead last. This was ranked 29th, negative 6.76 for composite score, and the returns are actually positive. So at the beginning, like when I was looking at this, I had to think about it. Why would we have some negative returns over here and get a higher composite score and higher ranking, and have a few positive returns over here, but this is ranked last, right? Let me get to that in just a minute. Let me get just a truncated view here. So it's a lot to look at. We're looking at 29 stocks. If I just pick the top 10, it's not even 10 because we don't have 10 that make the cut, but I can apply a filter and get rank less than 10. Remember, the higher the better. So I'm looking at the top 10 here. There's actually only 4 that meet this criteria. 3 month return greater than 0, and 6 month return greater than 0, right? So this gets kicked out. Apple gets kicked out because the 3 month return is not greater than 0. All right, if I change it a little bit to -1 or something, and that to -1, would probably get, all 10. Let me see. Yeah, I think we got all 10 there. So, but I really want to apply a filter to show me really the true top stocks, right? So if we have negative returns, it just doesn't seem like it's a good investment. But why do we get negative returns and we get like the high quality ranking, but the company doesn't seem to be performing well? Basically, Apple is ranked number 1 fundamentally, so all the fundamental features add up to number 1 ranking, but its recent return is actually negative, which might indicate that the market hasn't responded yet to the positive fundamental factors, right? So the market could have a lag, there could be inefficiencies, there could be other factors at play here that are pushing down the returns for Apple, right? We're just looking at fundamental factors, and we're looking at basically technical factors because we're looking at price changes over time. So we're looking at both fundamentals and technical, but maybe the market hasn't picked up on the better fundamentals. Maybe there's other features here that are pushing down the stock price, slumping sales. Maybe overseas, there's some issue with some manufacturing plant. I believe most of the phones are made in China. Maybe there's some turmoil or unrest in China that the market has picked up on. That's not in our data set here, right? So we're not analyzing everything in the universe. We're looking at some fundamentals and some technicals, right? But not every single thing is here. So valuation-based strategies take time, and value stocks often underperform before they revert. So Apple could be an excellent opportunity. It seems like for the past 12 months, every one of the periods we looked at, 1, 3, 6, and 12 months, The stock was down, but again, excellent fundamentals. So maybe this is a good pick for a stock that is about to pop and generate some serious capital returns here. So let me look at the composite score versus the 12-month return over time and plot everything together. I always say a picture is worth 1,000 words, right? So if we can look at the whole universe of stocks and see how everything plays against everything else, you can see the 12-month return is actually negative, and the composite score goes from about -6 to 4, right? So here's Apple, that's the highest. Amgen was the lowest. We saw that before. And based on 12-month return, IBM was actually the highest, and UNH was the lowest. So -36%. IBM was up 71%. Wow, that's a lot, actually. So if we go over here, IBM, where's my IBM? Yeah, 71%. We can see that. And what was Amgen? No, UNH. I think it was UNH that we saw. And UNH is over here down 36%. Okay, just so we can comprehensively look at everything all in one spot, all at the same time. So now I want to look at momentum score and then total score. So I'm going to hit Control Enter and take the mean of 1 month, 3 month, and 6 month returns. Just take the average of those three to get the momentum score. So is the momentum of the stock trending up? Is it trending down? Is it not moving at all? Here's the momentum score. It's slightly negative. This is negative. This is positive 14, positive just slightly, and negative 0.08. So now we can assign a total score here based on the composite score and the momentum score. So remember, the composite score is the first thing we calculated based on z-score. Then we ranked all those composite scores. That's how we got the rank. We just calculated the momentum score to see, is the stock price trending up or is it trending down over time? And we're adding the momentum score and the composite score to get a total score over here. So I think we're in good shape. We are about 2/3 done. Hang with me here. So now we're joining the returns with the DF ranked. So DF ranked was one of the data frames that we used back towards the beginning, and the returns was one of the data frames that we got from Yahoo Finance. We're calculating all the returns over time. Okay, I'm just looking at the returns, not really doing a whole lot right there. I want to see what the correlation between the 12-month return, between all 12-month returns and all the fundamental factors that we're looking at. So a 12-month return is correlated to itself perfectly, right? Whenever you look at a correlation, anything against itself is going to be perfect. So performance for the year has a very high correlation to the 12-month return, right? So that should make sense. If you're looking at 12-month return and performance for the year, they should be almost the same thing, right? So 52-week high, so high correlation. So now we're starting to see patterns here, like what features are actually really driving the 12-month return, right? So originally we looked at things like price of earnings, price of sales, price of book, ROA, ROE, things like this. But actually what's driving the 12-month return is very different than what I initially thought it was going to be, right? So that's why we have to do different types of analysis and come at this from a different perspective sometimes, just to understand like comprehensively what's going on. So let's create a heat map of this correlation plot just to visually see where the highest correlations are. So anything dark blue is going to have a high correlation. So performance for the month is going to be highly correlated with which ones are we looking at? The 1 month, 3, 6, and 12. So it makes sense, right? Performance for the month. And performance for the quarter, again, quarter and 3-month return, almost the same thing. So anything dark blue, you'll see that you'll have a high correlation. Performance for the half year, right? And this one for the year. So high correlations. So if you have a dark red, it's high negative correlation. Okay, so price to free cash flow and EPS past 5 years has negative correlations. We see kind of a larger negative correlation here, ROA, negative correlation. So let's do something a little bit more sophisticated and apply some machine learning to try to solve this problem. Again, which features have the highest importance in terms of statistical influence on the target variable? So I have several videos on my channel here describing the X and Y variable. The X is independent, the Y is dependent. We're using these independent variables to try to predict the dependent variable. So I want to know, of these independent variables right here, which has the highest statistical impact on the target, which is the Y variable. So we're going to look at the importance of each of these features in terms of driving that target variable. So performance for the year was number 1, 52-week high is number 2, insider transactions. 0.2, so 2% performance for the quarter. PEG ratio, so that's price earnings growth. And then they kind of get smaller and smaller over here. So if it has a really small influence, I'm not too concerned about that. It really has almost no impact. So here is a plot of the same thing, 0.692 performance for the year. That's exactly what we see here. And the next largest was 0.11, 52-week high. That's what we see here. So we're in good shape. The next thing I want to look at is rebuilding a composite score using only these predictive features. So originally we used totally different features like ROA, ROE, ROI. But let's look at these features because this ML model is telling us these are the top predictors for that we should consider for the composite index, right? So again, refined rank. Did I spell that wrong? Refined rank. Where's error exactly? Okay, bear with me here. Display correlations for refined rank. I'm calculating the refined rank, right? So that should be fine. Maybe I misspelled it. I don't see it though. Right, try it again. So I will just do this. I'll just go to my eyes are getting worse and worse as I get old. I have to get glasses pretty soon. So maybe there was a misspelling there. I didn't see that, but it's the only thing I can think of because everything else looks totally fine. So, okay, anyways, we have the refined composite score based on these independent features, right? These independent fundamental features. And we have a refined composite score. And we're based on that, we're assigning rank again, dot rank, and creating a refined rank. So if we go over to the side, we can see what the results are. So this was the original composite score, original rank, refined composite score, refined rank, right? So everything looks fine. It looks like we're doing pretty good over here. Now we can check correlations with future returns. So I'm going to merge returns with the original data frame that we used, doing a left index join. So we're joining on the index was the stock ticker. Remember, this is the stock ticker. You can tell because it says index over here, and it's sort of like depreciated by level, right? So it would be, if this was not an index, if we had an index like 0, 1, 2, 3, then it would be at the level of the fundamental features, but we're using the ticker as the feature. So that's how we're doing the merge. So anything that comes from the returns data frame, that has the same index, and anything that has that index is joined together, right, based on the ticker symbol. So we can see refined composite score, 3-month return is 0.84, the 12-month return is 0.81, 6-month is 0.54, and 1 month is 0.12. So let's plot that on this scatter plot over here. Okay, and we can see over here refined composite score versus 12-month return, and it's pretty tight fit over here between the return and the composite score. But let's go ahead and do a quick regression test just to make sure. We're looking for higher R squared. Higher is better. So I see 0.93, so it's pretty decent in the machine learning world. You want at least 0.7. So 0.7 means 70% accurate. The machine is going to make accurate predictions about 70% of the time. You want at least 70%. If not, you have to go back and pick a different model, or grab more features, or grab a deeper data set, or tune your hyperparameters different, right? There's a bunch of ways to get the R squared up. This is 0.93, so 93% of the time, the model is making accurate predictions into the future. For what we're doing now, that is totally fine. Higher is better. I would like to see 96, 97, 98, but we can live with 0.93 for this demo. So return target, I'm looking at the 1-month return, 3-month, 6, and the 12, and I want to know the R squared and the mean R squared right here. So 0.604 negative for the 1 month, 0.862. So that's pretty decent. This is negative 0.58, and this is 0.93. So the 3-month return is good enough for me. I'm going to go with that. It has 0.86. The 12 is actually a little bit better, but That mimics this one over here, but I think we're fine with that. So let's look at the ability of the model to predict a 3-month return. Or we can do 12 because 12 actually is higher. It's 0.393. 12, predict, 12, 12, control enter. And here you have it. So these are all the predictions of 12-month return with 93% accuracy, right? So based on these features that we picked over here, okay, these features right here, we can predict which stocks are going to have the highest and best returns for the year. And remember, that came from the random forest regressor, where we're using these features to predict the 12-month return, right? So it's a combination of returns and fundamental features, and these are the best investments that we can come up with, right? So we should get 63% return, 48%, 47%, and the lower ones would be UNH, negative 35. So probably just pick the top 10, I would say, for diversification purposes. Is that 10? I don't even know. 2, 3, 4, 5, 6, 7, 8, 9, 10. Looks like this Disney would be the cutoff, I think. I think that's 10. And we can avoid overfitting here. We don't want to overfit the model. Overfitting is when the model learns all the noise, but it doesn't abstract or learn how to make predictions onto data that it hasn't seen yet. You don't want to overfit. You don't want to underfit, but we can prevent overfitting by keeping the features set small and high signal and avoiding multicollinearity inputs that has high correlations between the features, right? So remember, we looked at this view over here, correlations of fundamental factors with returns. So that's a little bit different kind of concept, but we want to avoid high correlations, fundamental features that have high correlations with other fundamental features, right? So you want to drop those out so you don't have multicollinearity, and the model thinks, okay, these features are more important because they have a higher correlation. Then you're going to run into trouble with overfitting and potentially other things too. You want to try to avoid that, right? So that's pretty much it, guys. The last thing I'll say is this is not investment advice. I can't predict for sure with 100% certainty that IBM is going to go up 63% in the next 12 months. Cisco is going to go up 48%, and JP Morgan is going to go up 47%. There's too many influences on the market: geopolitical, the price of oil, wars, even things like the outstanding American U.S. Debt now, which is I think $37 trillion. There's other conditions on the domestic front in this country and other countries internationally that can certainly have an impact on stock prices. So this is not investment advice. All I'm telling you is statistically and mathematically how these principles work, right? So this is how to do ranking of Dow stocks, how to understand finance, both fundamental and technical finance, how to apply statistics, how to apply mathematics to solve these types of problems. It's not investment advice. So if you invest in IBM and it doesn't go up 63%, don't try to sue me, okay? Because I'm not going to go down like that. But I'm just telling you from math, stats, computer science, and finance perspective, this is how it works, okay? So, and there's some data science and machine learning mixed in there too, right? So it's a bunch of different disciplines. So I'm going to wrap it up here. That took about 31 minutes. That's one of the longer videos, although I had one that went over an hour, so I don't want to suck up all your time here. But thanks for sticking with me to the end. Hopefully this was informative and useful for you. Send me comments in the comment section if you want to see more like this. I definitely learned some new tricks putting this together, and hopefully you guys were able to learn a thing or two as well. Okay, so I'm going to save this file. I'll share it with you guys a little bit later today when I post the video, and I'll see you guys in the next video. Talk to you soon. Bye. Hey there, everyone. Ryan Schul here. Welcome to my channel. So if you'll notice, the narrative is shifting a little bit over time. At the beginning, when I started this journey a little bit over a year ago, I focused mostly, almost exclusively on data science topics. Now I'm starting to branch out into other things. I kind of like discovered pretty much everything I think that I could discover in the data science space. So I'm trying to make some pivots here and branch out into other areas, specifically finance. I'm going to focus on financial analytics for a while and see how that goes. So in the project today, the narrative will be about smart portfolio rebalancing. Okay, we're going to look at how to build a dynamic target weight and rebalance when risk or trends suggest that we have to do this rebalancing. Okay, and we're going to change or charge transaction costs to make this a realistic rebalancing scenario, and then we're going to log decisions and produce simple plots at the end of this. And I'm going to show you how to create a trade blotter too, so you can see all the details of all the trades in this whole universe right here. So we're going to import data from Yahoo Finance for all these tickers. I'm going back about 5 years, just picking an arbitrary date here. This is January 1st, 2020. Today is August 20th, 2025. So a little bit less than 5 years, but pretty close. So the interval days is going to be 1 day. This is daily, but the frequency of rebalancing and the frequency of trades, which is kind of the same thing, is going to be done monthly. Okay, so if you do it too frequently, you basically trade on noise and you actually generate a lower Sharpe ratio. We're going to do monthly rebalancing because the Sharpe ratio is actually pretty impressive at the end. So that's the setup here. We are going to look at monthly frequency. Weekly would be 52 days. We're actually going to get 252 days of trading data per year. The reason we get 252 is because this is when the market is open. Well, the number of days the market is open, you subtract out all the Saturdays and Sundays from 365 days on the calendar, and there's about 11, I believe there's 11 non-trade days. These are holidays in the United States. So Christmas, Easter is one, 4th of July, Memorial Day, Labor Day, Thanksgiving, things like this, right? January 1st. So this is actually, there's not going to be any data for this, but the request to fetch this data just skips this day. Okay, so the market's closed, but we get the very next day that the market trades. So here I have some parameters that I'm working with. There's some constraints that I'm applying. This is giving a minimum tilt of 0%. This is a maximum weight, or maximum weight, yeah, I'll call it a weight. This isn't a tilt. The tilt comes next. Maximum weight of 60%. So we don't put too much into the portfolio into one asset, right? We want to have a diversified portfolio. If one stock is really outperforming all the others, that's fantastic. But I don't want to invest 100% of the portfolio in just one stock. Then you have concentration risk. So we guarantee diversification by setting an upper threshold. And if the stock isn't good, we're not going to allocate anything. That's the minimum threshold. The tilt strength is going to give the optimizer an extra 25% boost towards assets that have stronger recent performance. Okay, so there's recency emphasis here. The target volume is going to be 12, so this is 12% annualized target volume. We're going to try to beat that. Okay, that's what the model is going to try to outdo. The volume total is going to be around 30%. Drift per asset is about 3%. Drift sum is about 0.09. Right, so 9%, and the MOM is momentum. Regime flip is 2. We have a cooldown bar of 2, minimum trade of 2%, turnover cap of 20, smooth target alpha. Alpha is above and beyond what we can generate just from normal trading or just from trading in the S&P 500. We want positive alpha, right? Positive returns. Trade only month end. This is going to guarantee that we have month end trading. Again, that's better than daily, better than weekly. Month end seems to be the best, producing the best sort of Sharpe ratio. I'll show you that in a few minutes how that works. We have a couple more parameters down here. Total basis points is 2 and slippage is 0. Okay, so I created a few different user-defined functions over here and set some parameters for these. We're looking for Yahoo tickers that have a minimum number of observations. If there's too few observations, we're just going to skip it. But these are all Dow 30 components, okay? So you definitely have sufficient historical data for these going back to 2020. I believe all of these will go back 5 years, right? These are big blue chip companies, so they should all go back 5 years. I'd be surprised if any of them don't. When I'm looking at the list, pretty sure they do. Just in case you pick some stocks, because you can put in whatever you want. My stock or my ticker, PKR, whatever, if that's what you want to do, that's fine. But if it doesn't have sufficient data, it's not going to cause them all to crash or fail, right? It's just going to skip those. So that's the point of that. And by the way, of course, you can change this date. You can change any of these stocks to be whatever you want, right? So it's pretty scalable, pretty flexible. You can change all these controls over here, right? So these are sort of guardrails or sort of parameters I'm defining over here. I think this makes sense in this kind of scenario, the strategy that we're exploring today, doing this portfolio rebalancing. But again, these are just parameters that you can change. So if you feel obligated to do that, by all means, go ahead and dissect that. So here's some basic parameters. Some user-defined functions that I'm setting up to go ahead and pull down the data, right? And then to get the closing price, and anything that looks kind of weird or something gets dropped off here. Okay, good, keeping it dropped, just gets dropped off here. And we are going to go ahead and forward fill any missing data. So this comes from Yahoo Finance. I wouldn't expect any missing data, but if there is some weird freaky thing where there was a bad data point or something, it just gets forward filled. Okay, so I wouldn't expect any, certainly in this list of tickers, but who knows, there could be some weird anomaly thing that pops up. And if you start picking some tickers that don't have a deep history or that somehow could have missing data points, and that's a nice feature to have, just to add that in. It's just a one-liner. I think it's nice to have that. So here's a couple more UDFs down here. These are user-defined functions. I'm going ahead and calculating the volume and then the weights. I don't really have time to get into all of these, like a deep dive into the description of all of these UDFs, but you know what? Do some Googling online if you feel compelled to use ChatGPT, right, to help you answer questions. If you have very specific questions, you can post those in the comment section, or any insights you like the work or whatever. Okay, post that in the comments. If you have any general things, you would probably get a much faster response posting that on Google or ChatGPT than in the comment section below. But maybe that's up to you. So we're calculating the momentum signal right here, the momentum tilt. Remember, that is how much more that we're going to put into high performing assets. I think I set that to 25%. If I go back and look, yeah, 25%. So there can be an extra bias towards stronger performing stocks. Okay, so we're going to pick that. We're going to pick up on that. Build target weights. So this is momentum. These are the weights for the returns, weights for the target. Okay, then we define the portfolio volume. Again, we're looking at weights and returns. So we're picking up all the weights, all the volumes, all the momentum. So we're in good shape here. Drift trigger. So now we're looking at things like differences over time. Is the difference, is it increasing? Is it decreasing? Things like that. We're trying to understand how these stock prices are moving over time. We're picking up the volume trigger. Okay, and the momentum flip trigger. Okay, so just a very basic couple of lines of logic here. If momentum previous is none, then do the flip. Otherwise, flip and take the integer of the momentum. Okay, so we have a smart rebalancer backtest. So we collected all this information, right? We have the historical time series data. We have some triggers. We have momentum, returns. What else did we get? Volume, right? So now we're going to take all of this and bake this into our calculation engine right here. Okay, so that's what this logic is doing right here. We're getting history, portfolio returns, anything held in cash, anything that gets logged. We're going to collect all these logs as a list. Okay, so there's basically four types of data types in Python. You have lists. I use lists a lot. That's what we're looking at here. Anything with square brackets. A tuple will have curly brackets. A dictionary, or dict, it's pronounced dict, will have kind of like wavy curly brackets, and then data frames, right? That's those are the four main types of objects in Python, and there might be a couple of others that aren't used that often. I'm not sure, but those are the major ones. So we go ahead and do all the calculations down here based on the momentum, based on the target raw, the target previous. Okay, and we collect all of those, and we want to append that into our logs. So when we get down here, this is the log list, right? So I just told you about the list. We create the list over here. Then we start to do all the appending into the list. So we're doing all the calculations, right? All the trading, should we trade, should we not trade, when do we do the trades, which tickers are we trading on, right? And which dates are being traded. So we collect all this information and append it to the log. So we collect the date, event, right? Drift, volume, momentum, anything like that, turnover, drift, L1, maximum performance, volatility, low, high, and flips. So everything gets into the momentum. This is now preserved, and we're taking a copy of what we just created above, right? So I always like to take copies. I think that is good practice. Control V. Okay, so the momentum now, we take a copy and create a new object, which is identical copy of the original one, right? So now everything has been collected, calculated, and we could go ahead and convert this into a data frame, right? So remember I said that there's like 4 major types of objects in Python, right? The data frame is probably the most frequent, for at least for myself. I use lists a lot. I use data frames most frequently, dictionaries once in a while, and tuples every once in a while. That's very, very infrequent, but I guess there's a time and a place for that. So let me go ahead and run this logic, and you can see how it works. Okay. Actually, let me stop that. I'm not sure if I captured the first part. I think so, because it's running and it's not showing me any errors. So I think it did pick up on this, but let me just make sure. So jumping the gun a little bit there. Okay, so everything is set up. We can go ahead and do the download for the data, apply all the functions, right? All the UDFs are going to run, and we're going to get our performance printouts right here. I want to look at prices, backtesting, and number of rebalances. So a rebalance is basically when the calculation engine decides to go ahead and make adjustments to the weights of those stocks in the portfolio based on the trades, which is coupled with the logic that I just showed you, right? So daily rebalancing is too frequent. It creates a lot of noise and a lower Sharpe ratio. I tested weekly. It lifted the Sharpe a little bit, but not substantially. I tested monthly, and the Sharpe went up quite a bit, and I stuck with the monthly. So the number of rebalances total is 19. That's 19 times that the weights in the portfolio are rebalanced. Again, the maximum would be 60%. The minimum would be 0% if the stock isn't performing well. And based on all that, we can go ahead and create a report too. So we have the final NAV. This is the net asset value, 2.164. So just a little more than 2 times boost in the NAV. We start at 1.0, so basically 0. So it goes up 2 times. That's 200%. Annual return on this strategy is 16%. Annual volatility is 16%. And the Sharpe is 1.0. So it's pretty decent Sharpe. Number of rebalances we saw before was 19. Total turnover was 3.8 times. And total cost is 7.6 basis points. Okay, so I think the portfolio is in pretty good shape, and I'll show you why. We got the Sharpe ratio right here. So this is the risk to return. This is the return on the portfolio minus the risk-free rate of return, right? So that would be the borrowing cost, or the cost to borrow funds. If you have to invest those funds, it's going to be pretty low, maybe close to 1%, maybe hovering around 1% these days. Might be a little bit higher actually. 1.5%, but these are pretty low. So you're looking at the returns that you generate minus the risk-free rate and divide by the standard deviation of the portfolio, and that's how you get your Sharpe. So this is a Sharpe for ARK. This is Kathy Wood's Sharpe. I'm looking at 5 years of data. So her ARK fund has 0.13. We have 1.0. So really blowing away that ARK fund right here with this strategy. So pretty happy to see that. Here, 0.15, right? We have 1.0. So I don't know how many times more that is. Six times more, approximate. And here's definition. Anything greater than 1.0 is considered good. Anything 2.0 and higher is very good. 3.0 is excellent, and under 1.0 is suboptimal, right? So that's one thing I don't understand. Like, everybody's talking about how great an investor Kathy Wood is, but that Sharpe ratio is like pretty, it's pretty low. Okay, so I'm not sure what's going on there, and that is pretty low too. So So anyways, the portfolio is outperforming, right? Beating expectations. So we're looking good there. So I like that graph. I'm a big fan of Plotly graphs. I'm going to go ahead and replot the whole thing using Plotly. You can see again, the NAV is 2.16, right? Over here, 2.16. So that's looking good. And if we go down here a little bit further, we can go ahead and create some logic to just show you all the details of all those trades, all the trade dates, the tickers that were traded, the price, the buys and sells, and then the overall cumulative return. Okay, so that's what this is doing. And again, I'm creating all the rows, doing the append to that list that I created above, right? So this is pretty typical in Python to create the list, do all the appends, then convert the list to a data frame. That's very common. You see that a lot. And in this list, I have date symbol, decide either buy or sell, right? Price, weighted, the weighted delta, the notional traded principal, number of shares traded, and realized P&L. When we go down here, we can see what the totals are. Ending NAV was 2.164. So this is a net asset value. That looks good to me. 2 times gain on the NAV. Total P&L is 1.16 mil. So we took some losses, right? We took some hits. Not every trade is going to be profitable. Obviously, you're going to have some losses. There's no portfolio that only generates gains. That's impossible, right? So we took 1.063 million losses, but we generated returns of 2.27 million, right? On 1 million invested. If I go over here, look at the top, 000. So we should find that right here. So capital, beginning capital was 1 million. So we converted 1 million into a profit of 1.16 million. So basically doubling, right? And the total unrealized gains, this is gains still inside the portfolio. We haven't traded out of these positions. This is realized P&L, right? So we traded all the bad stocks, got rid of those, and there's going to be some losers no matter what. This is a cumulative return that we see over time in the last column, and here's all the details here, right? So you see the portfolio started on January 1st of 2020, right? But the first trade date is 9/30 because it takes about 9 months for the strategy to build up, for the model to detect what needs to happen and to build up what the trading engine needs to do. I can't just trade day number 1. It has to see, based on some time series data, in this case it's 9 months of data, it has to see what's going on. Then it can start to make buy and sell recommendations. So this first sell is Goldman. This was the price. This is the weight, the notional, the number of shares traded. So because it's a sell, it's negative. Over here, this is the buy, so this is positive, right? So positive, positive, sell, negative, buy, positive, right? So number of shares traded, price, and then the cumulative unrealized P&L, right? So if I go down here, P&L 2.169. So again, positive, we started with $1 million, now we have 2 million, so a little bit more than double. And if I go ahead and hit this, we have a Plotly chart now that shows the NAV, the total P&L. That's what we saw before. We saw that before. We saw that before. This is just a plot of everything, right? So all the worst stocks, all the traders were basically dumped out of the portfolio, and we got rid of those losers. But you will have some losses, right? You can't have only gains. That's impossible. The total P&L, all the losses minus the gains here, and all the gains show up over here, okay? Or at least the unrealized P&L. This is what's still on the books. This is what has been sold off, okay? So basically, this is the takeaway. What does the script do? It pulls clean market data from Yahoo Finance. It computes the returns and the risk stats, right? It builds a baseline target weight. That's why it takes 9 months. I told you that before. So the first trade comes in, I think it was September 30, 2020. You have to build up the baseline target weights and build up your strategy over time, right? You can't just start trading day number 1. But when you go back in time like that, now you have the model up and running, right? It has to have some start point, and it has to have a little time to train. Now it's all been trained, it's ready to go. So you will have a period of time where for 9 months in this case, nothing happens, right? But going forward, the model's all trained, it's ready to go. It's all warmed up, right? So targets portfolio volatility. We saw the volatility, right? 12%. We try to minimize that volatility, maximize the gains, and that's going to maximize our Sharpe ratio. So that looks good. We rebalance only when needed using the triggers that were defined, right? Weight drift, volatility outside a tolerance around the target, and momentum regime flips. I'm going to change that formatting just a bit. I like this better. Okay, controls trading frequency, right? And we have the maximum 60% in one asset, minimum 0%. What else? The trades are frugal, right? So it's not trading high frequency or too much, and it's generating a lot of tax consequences or a lot of trading costs, right? We try to minimize that, and that improves our overall performance or overall gains. We account for all costs using basis points and any kind of slippage. Slippage is when the trade isn't executed exactly like you want. If you do any trading in your life, you'll see maybe the bid price is 100. You always look at the bid and ask, right? The bid price is 100. The ask is slightly higher, and the market maker is going to keep what's in between. But you might get just a slightly different, not performance, slightly different like entry point for that trade. It might be off by a couple of basis points or a couple of pennies. That's slippage, right? And overall, the performance is reported in these charts that I just showed you, right? And I showcased all the trading activity over here. This is called the trade blotter. So you can see all the activities here, including the date, signal, buy or sell price, delta notional, which is the beginning, shares traded, and the the cumulative unrealized P&L. So that's it, guys. That's everything in this smart portfolio rebalancer. Everything is done automatically. Just clicking in the cell, hitting Control Enter. You can set this up to run all in one cell. Just run it and you're done. I split the cells to make it a little bit easier to understand and to step through this a little bit. You know, when you're first doing this the first time, you don't want to have one giant script in one cell. If you have an error or a bug in there, it's going to be harder to find. If you break it into different cells, it's just easier to troubleshoot, right? But at this point, everything's up and running. I'm pretty confident that the model is performing like it's supposed to. So if you wanted to, you can copy and paste everything into one cell. Like right here, just copy and paste all that code into one cell, delete everything above it, and you can run that if that's your preference. The last thing I'll say is this is an investment strategy. I can't say go ahead and follow this and you're going to make a ton of money. I don't want to mislead people. And by the way, don't try to sue me or whatever, because I have no money, so I can't even be sued. Like nothing would even happen anyways. But this is the stock market, right? You have to use good judgment. You have to be careful. You can get whiplash. You can get, it's called whipsawed, right? You buy high and sell low or something like that. The objective is to buy low and sell high, or sell high and buy low if you're doing shorts, right? But you can do the opposite and lose a lot of money very quickly, right? So there's no guarantees in the stock market, so just be careful. The strategy does work. It is profitable, but don't get angry with me if you don't make a ton of money using this strategy, right? That's not my fault. I don't control the market. I don't control these things. This is just an illustration of finance, financial engineering, what else? Mathematics, statistics, some computer science, a little bit of data science baked in there too, probably at some point. So that's it, guys. That's Smart Portfolio Rebalancer. That's it. I'm going to save this code. I'll share it with everybody so you have an example of the scripts here. And I'll load that when I load the video a little bit later today. So you can just copy and paste my code, run it in your own Jupyter environment, and you are good to go with that. If you have any questions, let me know in the comment section. If anything doesn't make sense, that's totally understandable. Some of this stuff is dense. It's complicated. I understand that. It took me years to master this stuff, years and years and years. And I'm still learning, new things all the time. So my point is, if there's something you don't understand, Google it, Chat GPT. If it's very, very specialized or specific question, why did I pick this strategy or why did I do this, then you can post that in the comment section. But if it's a general thing, I think you'll get a response much quicker if you Google it than if you put that in the comment section. But if you have any interesting comments, you like the material, you have ideas for similar but somewhat different types of analyses, and let me know in the comment section, okay? Hit the subscribe button. I'm going to drop this video pretty soon, and I'll share all the code with you when I post the video, okay? That's it, guys. I'm going to wrap up here. Thanks for your time. Appreciate it, and I'll see you in the next one. Goodbye for now. Hey there, everyone. My name is Ryan Schul. Welcome to my data science channel. So on the project today, I want to talk about stock price divergence and convergence for highly correlated and highly co-integrated stocks. So basically, what does this mean? So if McDonald's and Burger King are pretty similar, we know they are. Microsoft and Apple are pretty similar. We know they are. If these stock prices diverge, one's going up and one's going down, eventually, if the businesses are essentially similar, have similar profits, similar um, sales and things like this, if the businesses are fundamentally similar and one's going up and one's going down, there must be a temporary reason for that. There's some kind of price dislocation in the market. And these two, although they are diverging, one's going up, one's going down, they have to converge at some point. They're going to meet up again in the middle because the stock that's going down is going to become cheaper and cheaper. People are going to recognize that and they're going to buy it and push it up. And one that's climbing up, eventually people are going to say, this thing is too expensive. I'm getting out, I'm dumping shares, and the price is going to go down, right? So that's the whole theory here. We're going to dive in and see if we can prove this and understand the theory and see if we can prove the outcome, right? So this creates market neutral strategies, right? Hedging our assets, creating opportunities for capital gains, pairs trading. That's what this thing is called. That's the nickname for this. And it bets that the spread between the historically correlated stocks, if they're highly correlated and co-integrated and they move together, typically they diverge, right? One goes up, one goes down. They're going to converge at some point. So this exploits temporary inefficiencies in the market, almost like what's it called? Not an anomaly, oh my God, I forgot the name. Sorry. Arbitrage, almost like an arbitrage. It's not real arbitrage, right? But there's almost like an opportunity to exploit the inefficiencies in the market here, right? This is quantitatively based and rule based as well. This is used by hedge funds and prop trading desks. There's not as much prop trading done these days as there was, a couple decades ago. That was pretty popular, but it's still done. Not big banks. There's so much compliance and regulation around that. Not too much, but definitely at smaller independent outfits. Convergence is predictable. Divergence is predictable as well, right? So we can exploit these opportunities, and low correlations with trend following strategies is easy to understand and explain to other people, right? So you can get buy-in for your shareholders and from your investors. So I'm going to go ahead and import our historical stock price information here. This is very easy. If you've seen a few of my videos, I do this all the time. Go into Yahoo Finance, right? This is the API endpoint and pull in this data right now. We're going back 1 year in time. That's sufficient. That's all we need. And this is the start date, and the end date is actually today. And the start date comes from today minus 1 year ago. So we have the start, we have the end. It's pretty dynamic. We pulled in the information here and we calculated the correlation. So we're looking at the correlations, right? We have to look at the correlations between these stocks. Correlations mean if one thing, it doesn't even have to be a stock. If things are correlated, one thing happens and it moves in a certain direction, and another thing moves in the same direction at the same rate, the same pace, at the same momentum, then those are correlated, right? If one thing moves up and one thing moves down, then they're negatively correlated, right? So there's positive correlations and there's negative correlations. So that's how this works, okay? So we're going to look for correlated pairs and look for chances of finding spurious correlation. So it could be a correlation, right? But the correlation might not have really any real value, right? So in the summertime, more people buy ice cream, more people go to the beach and go swimming, and there could be an increase in shark attacks at the beach. But does the probability, I guess, of buying ice cream increase shark attacks? No, there's a high correlation between ice cream sales and shark attacks in the summertime, but there's no incidence or cause and effect between those two. They're totally independent, right? So we're looking at the correlations and looking at the pairs, but we also have to find the co-integrations between these pairs, okay? So I can go ahead and refresh this right here and put together this little matrix right here. So correlation greater than 0.9, very strong, excellent for co-integration filtering. Greater than 0.75, strong correlation, safe for testing. 0.5, moderate correlation, may include noisy pairs. That's what I was talking about, the ice creams and the sharks, right? No real cause and effect there. 0.3, weak correlation, likely too low to make a profit from, probably meaningless. It's basically useless. Less than 3, there's no correlation, not worth testing, okay? So now let's look for co-integrated pairs here, and plot the results. If we find any, we set up signals, and we're looking for z-scores. So z-score is basically the spread, the average of the spread, and we're dividing by the standard deviation, right? If you want to look for a z-score, you can go ahead and Google it. I've got several videos that explains how this works. Z-score. You can just Google that, right? So it's a way of standardizing everything so you can compare everything to everything in the whole universe. I just put out a couple of videos recently about how this works. So it's the item minus the average of all the items divided by the standard deviation, right? So we take that and just, it helps us standardize everything and compare everything relative to everything else. So I just ran that. So we have the plot over here, and you can see the time series from 2024-07. We're going back in time 1 year. Now it is July 18th, 2025, right? So we go back to last year, July, to start the analysis. We can see the z-scores over here in the spreads, and this we actually found one. So we found one instance of correlation and co-integration, right? So we're looking at PG, Procter & Gamble, and KO. This is Coca-Cola. So the stock pair that we just found is Procter & Gamble and Coca-Cola. This correlation is 0.52. It's moderate correlation, or 0.592, almost 0.6 moderate correlation. Not super strong, but it will illustrate the point here. I set this correlation over here a little bit higher. Now, where is it? I think it was in the previous step. I set this to 0.7. Really, you want this like 0.7, 0.8, 0.9 ideally. But if you go that high, I didn't find any. You can put in different stocks, right? I'm just looking at the Dow 30 here. You can try this with the S&P 500. You can put in the Russell 2000, right? So you can put in whatever stocks you want. You can go back in time for a longer duration. I went back 1 year. That's it. So I'm just trying to illustrate the point of how this thing works. But you can go ahead and reset those variables to anything you want. The co-integration p-value is 0.0338. So this is significant at the 5% level. Again, we're a little bit low, but if I set these thresholds too high, we would have nothing to work with. So I'm a big fan of let's have something, let's produce something. I've worked on teams where they'll work for 6 months, 9 months, a year. Nothing gets done. There's no proof of concept. Nothing happened. You look back in time, well, what did we do for the last year? Like nothing happened. I hate that. Okay. Let's just get something done and have a minimum viable product, MVP, minimum POC, proof of concept. Just get something done and something on the table, some kind of deliverable, so we can make a presentation and talk to our stakeholders, right? If you come up with nothing after 1 year, there's really no excuse for that. I wasn't a team lead on that, thank God. But these things happen, right? But I'm a big fan of just making something happen and getting something done rather than nothing. Something's better than nothing. Average convergence when z-score deviates z greater than 1, it takes about 16.25 days on average to converge and go back to z less than 0.05. Okay, the number of divergences in the cycle is about 8 per year. These are all the z-scores right here, so we can print these out. Okay, and again, we're looking for z-scores probably greater than 1.0 or less than 1.0. So let's go down here and compute the actual spread and the z-score. Okay, so we know the tickers. I just put these in. I hard coded it. You can actually pick that up from over here because we know stock 1 and stock 2. In this case, it's very straightforward. It's very simple. So I just plug that in right there. So again, we're looking for signals and the entry price and then the exit price. That's the goal right here. Okay, and we're going to append everything to durations. So if I do Control-C, Control-F, you can see durations append date minus entry date in terms of days. So I'm appending everything to this list. In the Python world, anything with square brackets is a list. Anything with curly brackets, if you have the squiggle brackets, that is a dictionary with key value pairs. And if you have the kind of like nice curly brackets, that is a tuple, right? So we're using a list here and we're doing an append into the list. And the final outcome here is the average convergence time is about 23.25 days on average when there's a divergence, and it's going to converge in about 23.5 days, so close to a month. Total profits from this pair trade is $5,720. Number of trades is 9, and the average profit per trade is $635. So I went ahead and plotted this in a Plotly chart down here. Whoops, I'm not sure what happened to the plot. I just ran this before. I think as I put in more days, I think it got a little bit wackadoodle there. But it was supposed to go up to, let me fix this, 2578. I'll fix this thing, 2578, because that number right here, if I zoom in, 2578 matches this. 5720. I'm sorry. I just ran this before. I'm not sure what happened here, but let me go back and fix this up because I was running right before I added in the average convergence number of days. I'll fix that up when I send out the video later. But basically, we're stepping into pairs trading execution based on the mean reversion using the z-score spread between PG and KO, so Procter & Gamble and Coca-Cola, kind of the same types of businesses, right? And remember, if the z-score is greater than 1, the spread is wide. So you short Procter & Gamble and you buy Coca-Cola. If the z-score is less than -1, then the spread is wide. And you go the other way. You go long Procter & Gamble, you buy Procter & Gamble, and you short KO, okay? And the z-score total profit, and you can see over here is 5720, okay? And the average convergence time is 23.25 days. So I don't know what happened to that chart. It got a little wackadoodle at the end. I'll fix that up. I'll look into that. I don't want to waste a lot of your time. And I honestly don't know how to do edits in these things. One of these days I have to learn how to do an edit. You cut it, and then you make whatever you have to make, and then you append the edit to that thing. I'm not sure how to do that. Like, my background is not video editing by any means, but let me look into that. I'll fix it up. That's it. I'm going to wrap it up here. I'll share the code after I fix it up. I promise to fix it. So when you get it, it's going to be nice and clean. Everything will work perfect. Thank you so much for your time today. Appreciate that. Enjoy the rest of your day, and I'll see you soon when I put up the next video. Take care. Bye.